Greetings, traders. It is I, Abdul Shabazz. And this is some real change stock options trading journey. And today, April the 8th, trading during the first day of a ceasefire. Loving it. Loving it. Right at the area yesterday I wanted to buy. She closed in that area and it took off post market. Remember, I had an alarm at 6:59. I don't even think it hit. But you remember from the diagram that I had this drop. Matter of fact, the plans are still up here. The plans are still here. Right there. To buy at the 660 level. And then watch it go and take profits all the way to 666. Well, this morning she's at 676. So the whole move that I called out and anticipated, it took place, but it took place in the time frame that we cannot trade options. I know, it sucks. I can't believe it.
Liftoff of mission 41B, the first flight of the orbital Discovery, and the shuttle has cleared the tower.
Leads me to wonder about a swing position, possibly.
Every four computers now have primary control of critical vehicle functions.
Just want to think about how in the future I'm not taken out of a move that I see coming. And I miss out on it because the move takes place post or pre-market during the times when we can't trade options. It's happened to me about 3 times so far this year. About 3 times so far this year. So now, let's figure out what the next move is going to be. Well, looks like we're approaching the top of the algo, so naturally, you're going to have bulls take profits up there at that 676.5 area. We're at 676.48 now, so 676.5 area. You're going to have profit takers there. Want to be careful and watch out for the mistakes of the novice trader. Chasing this, being the liquidity that other people are selling into. So this is what took place. Okay. This is what took place post-market. But it now has us at the top of the algo. Okay. We've also gone back green for the month. This is what is taking place. Post-market. And now pre-market. I'm going to take a look at that here shortly. I'm just going to have to observe today. I'm going to have to observe. The move that I called, it worked, but it did not work in a manner that I was able to take the trade, because we can't trade after hours or pre-hours. And crazy, because I also called out a weekly call that has already been in place. 661 strike, April 10th expiration. Get in at the 662. Okay, add at the 666. First profit taken 672. All of this has hit during the post and pre-market. So even the position I wanted to take for a weekly call also got hit. Both plays. The call that I wanted to take yesterday didn't happen until the post market, as well as you see the W here, the weekly. I don't even have anything for a weekly put. The weekly call, believing that if this was going to happen, not only will we hit that 672.4, which we already have hit. But believe we can also even possibly hit the 680.5. From either two of these, I'll look for a healthy pullback. The question is, the average retail trader who doesn't have the vision to see these areas of profit taking may think by mistake that they're areas to buy the market. But your buying will be someone else's exit. As it was my plan, but I wasn't able to execute because it took place during hours that we cannot trade options. I'm open to suggestions to anyone. It happened to me on the daily and the weekly position simply because it just happened during a time that we couldn't trade. The market yesterday closed at 659. Look at this right here. The market closed at 659.2. My entry is what? 660. That's the discipline of only trading your rules, but that just would be, I don't know. Just to say I'm going to take a call just because it's close enough to my area, per se, Your Honor. And then this could roll over into that, and that could roll over into this. I don't know. But oh well. I missed a great trade. Yes, I did. Missed the one at the 660 for the call daily, and missed my weekly 662. Missed my entry, missed my ad, and missed the first profit target. But I'm thankful and grateful enough that I was able to see it, to recognize it. And inshallah, one day I will get paid hundreds of thousands off this one particular move like this. Believe it. Believe it. Laughing all the way to the bank. Take a move like this with 100 contracts. Yeah. Going straight to the Lamborghini dealership. You dig? Alright, now, more importantly, what are we going to do today? It is what it is. What is taking place is taking place. I'm still grateful that I knew the area based upon the market, what the market showed us, knew the area would happen in. Just could not control the time that it happened. And as we always say, the market does not need us at all. You see how much takes place during post and pre-market, even before retail can even get in the game. Looking at where we at right now, again, we are still at the top of this overall algo. Let me show that to you. Let me back it up. Let me show it to you. I'm gonna make it easy on your eyes. All right, starting. Man, see, I'm giving up that sauce right now. This is that sauce. This is that splat. I'm giving y'all that splat right now. You feel me? This is that splat. So you have computer generated algos in all time frames. Doesn't matter the time frame. They exist in all time frames. And then so here you see this controlled selling, okay, and this is weekly, week by week by week by week. And then now, all of a sudden, after we hit a very severe low, where the market then came in and found that appealing, because don't forget, this is the SPY. So even when you take a step back and look even further, the SPY is always going up. So even with this pullback, this was a very healthy pullback. We've seen this in years past, in recent past, where the SPY will have a correction only to come back and ascend to new highs, because this is the United States of America, and the SPY will always and has always gone up. So even when you back it all the way up, I'm looking at 2 years out. Okay, you can all go back to 3 years out. Okay, you can go all the way back to 2022. Higher high, higher low, higher high, higher low. Every pullback, okay, has been met and been used, okay, to take the market to new highs. Every pullback has been used as liquidity for those bears who overstayed. The first initial pullback are these bulls taking profit, and then you have bears thinking there's going to be a change in the market. Some bad news come out as we went through COVID, as we went through the financial crisis of 2008. The market always comes back no matter what happens. So much so, after that deep pullback that we had in April of last year, where the market came all the way back down to 513, we then went on to hit new all-time highs. Okay? And then we came down from those all-time highs after we got to that 697. Okay? Now, understanding that, now we're breaking it on down. You're talking about top-down analysis. It don't get no more top-down than that. I just done went all the way back to 2022. Okay? You did. You ain't topping more down than that. So understanding that even this healthy retracement, okay, was only a nice setup to potentially take the market higher. Now, we don't know what's going to happen up in this area here. Is it going to break out of this algo? Is it going to double top? Who knows? We'll have to see if we get back up to the 695 area. That will be an area. But there's still $20 between that and where we are now. So also keep in mind that there's going to be another critical and crucial area at the 686, because this is where we went red for the year. And you can see I have the writing here. Let me go ahead and stretch it out for you so you can see. Okay, right here. Let me go ahead and circle it for those who can't see. See that right there? Red for the year. It's in that area right there, the 685. Let's just say it's 686. Well, we went red for the year. So there is a lot of overhead resistance on the way back up. Also, this is a healthy profit-taking area for bears who made money on the way down. They're putting a little money in their pocket, and there's nothing wrong with that. And in the process of doing so, they have broken outside of this controlled selling algo and have now flipped control where we were all red to finally a green. Not only that, but this is the first green month that we've had. First green week, rather, that we've had in a while. and the first green month that we've had in a while. Let's go to the monthly chart. Okay, when the market opens, this candle will flip. Okay, the change came at 672 and we're now at 676. So when the market opens, this candle will flip green. Okay, and weekly, this is the first green weekly candle that we've had in a long while, as you can see. So now let's bring us back to what is going to be our game plan for today. We still have to keep in mind where we at and what's going on in the largest of scales. So now, we were just in that, this is up closer now. That control was selling algo, and now we've broken out of it, okay? And whenever we break out of an algo, there's going to be some people covering, and that covering, in this case, turned into squeezing. So I can't wait to see what happens when market opens, as there still are some bears who probably believe that this was going to come back down into this larger algo. So I will be watching, but nonetheless, we're still at the top of this controlled buying algo now, even with that large move. So I do expect at market open a little bit of retracement possibly before we attempt to carry on. Now you also got to think about the human psychology. What are the novices going to do? The bandwaggers, those who wake up and see that the market has jumped up $20, and they're like, oh my goodness, the market's back, the war is over, let me go ahead and place an order with my broker. When the market opens, you're gonna have that effect when the market opens as well. It's very it would be very irresponsible for me to call anything right here. I have nothing to go on. I have levels. And I'm grateful for that. I have levels. So let's build off the levels. That's one thing that we can do for sure. Build off levels. I found ya. I found ya. I found ya. Let's go off these levels. I found ya. Alright, let's go off these levels. This is gonna be fun. Let's have some fun. If there's a pullback, expect a pullback to the 672.5. First profit target will be the 675. I do like the 672.5. Okay, let's think bigger. Let's think bigger. 672.5, first profit target. $670, second profit target. And you get in it at 675. I think contracts will be expensive today. So we're going to go with 676. But you did, those contracts will be expensive today on that. So what that'll look like, per se, Your Honor, that'll look like something like this. Breaking this algo. That, and then possibly coming right there. Something like that. That's what that'll look like. Because we're also at the top of this larger buying algo. But I realize what is taking place post and pre-market. So I'll be looking for this algo to get broken. Possibly, like I said, looking for a break and retest. Using that whole dollar amount of 675 on a break and retest to come on down to the 672.4. I said 672.5, that's fine. And then a 670, because that's a whole dollar amount as well. You gotta respect whole and half dollar amounts in unknown territory. The only call I would take would be on a pullback. On a pullback to the 672.4 area. So that would look like, even with expensive contracts, that would look like a 671 strike with a 672 break and retest 7. I told you about that. To retest back to where she is right now with the 676. You gotta take what your mama gave you. You know what I mean? You don't know what'll come after that. I don't know what'll come after that. Don't know. But that pullback call is definitely feasible. You know what I'm saying? Pull back to this area and then, grab the call right here. And take it right back to where she is right there. That's easy money. That's easy money. And it's still a $4 move. You know what I'm saying? But I still believe we need to let the market stabilize itself. You don't need to jump out the window. Have your plan, stick to your plan. As you can see, I definitely had a plan. Had a plan for the daily and had a plan for the weekly. Just want to figure out now, work on how to execute my plan even better. I had already called out 661. Googity Bob, 661 strike. You understand me? First profit target 672.4. Ran right through that. We're at 676 right now. Second profit target is 680.5. Well, there we go, sir. Refer to. Look at that. Look how that worked out now. Using that same 672.4, which was the first profit target for the weekly call. Using that now for today as an entry after a break and retest of that area. Okay. Using where we are now, 676.5. Okay. For the first profit target off of that call. Second profit target would be what? The same thing that the weekly had here. So now we do know. That'll be 680. We're just gonna say 680. Leave it at that. Yes, sir. Good job, sir. Let's go ahead and put that up on the big chart. See what it look like on the big chart. Alrighty, I know it's a funny looking chart, but it is what it is. Alright. Just take it over here. Up. See my buy alarm yesterday. She never even got triggered. Look at that. Still on the screen. Yeah, buddy. Oh, we knew. Called it out yesterday. We talked about it yesterday. Look at that. Wow. We even spoke about yesterday's demand area as the market came to it not once, not twice, 3 times, put in a beautiful green hammer, and then took off. Googity Bob. Beautiful price action. Oh, look at it. Tiptoeing on the bottom of that algo. Man, I gotta blow that up to look at that. Man, I gotta blow that up to look at that. Yesterday's action, tiptoeing on the doggone line of the hour. Tip putting in two beautiful bullish reversal signals. Bam, bam. This is the 15-minute chart. Yes, sir. It was a rough man. If you did not have this overall control buying algo, you would have missed it. You wouldn't have seen that these was areas to buy in because it's bouncing off of the bottom of the control buying algo. You would have missed it. Big facts. Heck of a day today. Definitely having a clear chart today as far as a larger time frame. And again, pulling up the daily chart. We had already identified it on the daily chart as well, that we were in that control buying algo even off the daily chart. So you saw us break it down to the 15-minute chart. But look what was even happening even on the larger time frame. That's what makes it so beautiful. Wouldn't you agree? Went through 1, 2, 3, 4, 5 resistance levels. Bananas. Bananas. Went through 5 resistance levels. This right here, though, however, I have to say, when it comes to having true support and resistance lines, just a thing of beauty to watch them come into play and watch them come into effect. You know, this is a whole lot deeper than just trying to track yesterday's high, previous day low. What do you do when that gets blown out the market? Where your lines at then? That is the beauty of going at one step further. Seeing this monthly area of support. And I got one towards resistance. Resistance, it stood as resistance, it got blown through, and then it stood as support. Same, another area of resistance. It stood as resistance and it was turned into support. The same level was tested once and then tested twice. And here we are now at the top of another resistance level. There is no previous day high, previous day low you can use when things like this happen. You definitely have to go one step further in your market research, in your market analysis. And also don't forget, we are still also at the top of that controlled buying algo as well. A lot going on in this area. A lot is going on in this area. Get hip quick. Show you on 2 minute. Look at that. Right here. Thing of beauty. This is what we expect to see. Is the market pulling back initially from this area. But if you know you want a pullback to enter in a long position, if you know, you know. Interest to see right now the emotions of retail traders. See what the emotions of the retail traders will be like. Again, let's step back because we have to. Big shout out to the team. Todd Macon, Jesse Swanson, Dan the Man, Jared Lewis. Thank you all for being here. Thank you for the Kick family for tuning in. Reform Mister and Lil Nige. It's a 5-minute chart right here in the middle. The daily chart here in the top right, and as I stated, Not only are we at an area of resistance, but we're also at the top of that control buying algo. And it doesn't matter if it's a 2-minute, the 5-minute, the 30-minute, or even the daily. The algos will be respected. This is some of that early action that I was looking for. As you know, I said I would love, let's come on down, get into that 675. Give me some of that 675 action. But we see what's happening right here, 675.5. We see the bulls understand. And they are coming on back in, trying to not give it up to these bears. The bulls understand the assignment, so they're buying in at the 675.5. So I like below the 675 for a nice entry for a put. If that happens. Put a clear area there. Let's go ahead and put an alarm there as well, being responsible. If you notice, I don't even like a call till we get on down to a profit-taking area after this put. So I would like to see the put come on down to the 672, take profits from the put, and then get in a call. Indubitably. It's not gonna be easy. It's not gonna be easy. Show you my height. This is my trading view chart. Since the market opened, they went ahead, put the candle in there for me. So I can take this squiggly diggly off the line here. Alrighty. So there you have it. Let me fix this a little bit. So again, this is what I want to see. Let's see it come back down to 675. Break and retest at 675. Come on down to the 672, and then when she gets here at the 672, that'll possibly be towards the inside of this bottom of this control buying algo, and also catch it at this level and take it right back to where it is right now pre-market. So that is the short-term game plan. Take a put on down to a profit target area and then switch sides. Go ahead and let the market play out. See what it does. Wow, look at that candle on the weekly when the market opened that it put in. Amazing. Look at that. Let's take a look at that. That's what you call breaking outside of that algo. Beautiful work. Look at that. Too bad it happened when we couldn't trade it. Beautiful action. Just beautiful. That we were able to see it, call it, recognize it. Spot on. Congratulations to the team. We still saw it. Very interesting. Dr. JB, what you gonna do here, Dr. JB? She coming to my area for sure. She already there. Look at that. Right to my line and then bounce. And she come through it now. Let's go. Don't fool me. No, sir. We got rules and regulations around here. Too early. We ain't even make it to the ORB candle yet at 9:45. Yes, sir. Thank you, Jesse, for reminding everybody. Please hit the like button if you don't mind. Doesn't cost a thing. That was a serious flip right there. A very serious flip, red to green. Very serious flip, red to green. That's the one you want to get in on. But I'm going to be patient. We're not looking for confirmation. We're looking for continuation. We see that the market can potentially be coming down right now. But is it sustainable? Is it a trap? Is it a trick? Well, we know that the market is definitely like a train. Once it starts going in a direction, she will pick up steam in that direction. All right, Jesse said he's waiting for the 200 MA reaction. Okay. And this is what I was afraid of. Right here, the volume. That's why I didn't jump also, guys. Remember what I told you about the volume? If the current candle is larger than the previous candle, then you can expect the market to continue in that direction. So I was looking for the 935 candle to be larger than the 930 candle, a bigger red candle, for me to be more convinced. Nothing like patience. Patience pays. Which is also why I tell the team that we have to refer to the larger time frames. We look for setups on the larger time frames. We look for entries on the smaller time frames. Do not look for setups on the smaller time frames, especially if they're contradictory to the larger time frames. Meaning, don't go against the 30-minute chart, the 30-minute candle. In the morning, give the market an opportunity to show you what it wants to do. We already understood the potential and the possibility of the market coming down. Some opportunities are just better than others. And as we waited for that 15-minute candle to close, as Dan the Man has always instructed us to do, being a dynamite teammate, let the candle close. Doesn't matter where the candle trades. It only matters where the candle closes. And then once we saw that, the candle coming down was our confirmation. Letting the candle close, going and seeing what the next candle does, that would be our continuation. And that is what we trade off of. And in doing so, we have been spared simply by following our rules of making a very foolish trade by simply referring to the larger time frame, allowing the candle to close, not just having confirmation, but looking to see if there's continuation. Here, there was no continuation. In fact, it's nothing but frustration. And I'm so glad that I'm not part of that demonstration. Going back to the lesson of volume, guys, this is very important. If the current candle, here at 940, if the current candle is not larger than the previous candle, then there is a very great possibility that the market is not going to continue in that direction. We have that example right here. And as Dr. J would say, you don't want to be the first person out of the plane. Not the first one. Thank you guys for tuning in. Appreciate you. Big Band is in the building. Yes, sir. Glad you're not trapped already. Yes, sir. We understood the air. We understood it. We came with a game plan now. No doubt about it. We said, give us that what? Give us that 675. That's what we asked for. Give us a 675. Don't come down there and tease us. Please us. What we're going to do now is reset that alarm. Like the soldiers. It's that discipline. Overall, great day to be a trader. Great day to be an American. Great day to be alive. To be able to go outside and smell the fresh air and the trees. Things that you take for granted, please don't take them for granted. Whatever you profess to believe in, you still have the ability to believe it. Every day is a great day. Some days are just better than others. In the trade, in the put, Beautiful all the way around. Beautiful all the way around. Even looking at the larger time frame, we had a reversal where we had a complete green to red move. So looking at the larger time frame, you saw a beautiful green to red move.
There's a look at the breadth of the NASDAQ 100 this morning, coming off the opening highs, but still up almost 3% today as we have pretty good gains in just about every sector except, Jim, for energy and utilities.
Yeah, look, I mean, it's still a little down from where it was, say, when Morgan Brennan started her show, but it's the airlines that are carrying everything. Airlines and travel, that bull market is most definitely back.
We'll take a short break. Be back in a minute.
Profit target 672.5. We'll take some profits before 10 o'clock. We know how volume, the 10 o'clock volume comes in. Should have took some profit at the end of that 9:55 candle. Again, looking at the larger time frame candles, not looking at the 2 minute, looking at the 5 minute, looking at the 15 minute.
Jim, what's on Matt tonight?
You know, Carl, the person who many people feel was the first to be aware of what's going on and how dangerous this anthropic could be was George Kurtz. He brought it to my attention when I just thought it was fanciful. There could be anything wrong. I didn't understand how powerful it was. He understands the data. He's got it at the endpoints. He has a Project Charlotte that he thinks is perfect for this. So I have him on tonight. Visionary about what can go wrong. Besides, David, what else? George Kurtz.
Le Mans.
Thank you.
Yes.
Le Mans.
Yes.
One Le Mans.
Palantir's the sharpshooter.
Yep.
CrowdStrike is the driver.
Yes.
Right? We associate our CEOs with their hobbies.
That's right. And I think that George is remarkable. He's won in a lot of places that, even some of the smaller ones, people really get a kick out of. Sebring.
Yeah. Look forward to it, Jim. Crowd strike with almost 2.5-month high this morning.
It's good.
Along with, of course, the markets trying to repair what's been lost in the last month. S&P just south of 67.70. Don't go away.
All right, I'm gonna be taking some of this off for 10 o'clock. All right, I just took it all off. I knew I didn't want to be around for 10 o'clock. So even though it didn't hit my stop, I didn't like what it was doing. And that was enough for me to just take a scratch trade rather than just a loss. Don't usually just take a loss when I can see that the market's going to do
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber. We are live as always at Post 9 of the New York Stock Exchange. Stocks are surging and oil is tanking on news of this 2-week ceasefire with Iran, with outsized gains for airlines, semiconductor equipment, and discretionary stocks, which all got beat up over the last few weeks. Coming up this hour, Evercore's Roger Altman with us to talk about the major relief rally and why he's advising investors to be cautious. Plus, we'll break down Delta's results as that stock jumps despite the CEO warning of a meaningful cut to growth plans. And the CEO of Levi's with us as shares get a big boost on results driven by strong direct-to-consumer sales. But guys, this is a big market move, and there are macro implications of this move as well that I just wanted to point out, which is lower oil prices, 5-year break-even inflation rates come down. This is the market expectations of inflation. And you can see directly there's already they were rising a little bit on the back of these higher oil prices. They're coming down sharply. Look at the 10-year break even as well. Again, there was nothing really hugely worrisome in the last few weeks on the oil rise, but you can see just the dramatic pullback that we're seeing this morning. And along with that, there are now increased odds of a Federal Reserve cutting rates and not hiking rates. I mean, the market has really flipped its positioning on this one. You can see it in the 2-year yield, which, yields are coming down right now, which implies that the Federal Reserve can be easier. They don't have to worry as much about inflation and these higher oil. We do have a chart here, thank you, Peter Bookbar, that shows just what we're looking at going down the road. And as you can see, the market is really excited about cuts going into 2027. This year now, there's about 50% odds that the Federal Reserve cuts rates by December. That's a big change. That was at 0 on Monday, David. So we've gone from 0% of a cut on Monday in December to 50% now odds of a cut, because that's the magic of lower oil prices. And then this is the outlook for the next few years, I would say, next few months and years. And the market's expecting
If in fact
cuts.
things change geopolitically, could we expect that this will change as quickly?
Yeah, I mean, clearly oil prices were what was standing in the way of the Federal Reserve cuts and at least the market expectations. And it's not just in the U.S. Look what's happening in Europe. The 2-year yields in places like Germany and France and the UK. I mean, these are big moves that we've seen just overnight.
Yeah.
Because, in Europe, they were expecting as much as potentially 3 rate increases to deal with the higher inflation. They've got a single mandate around inflation. And just to tell you just how much a move like this changes the economic outlook out there, Ed Yardeni, who we follow of Yardeni Research, he's even, taken down his recession odds on the back of what's happened here. He says we are lowering the risk of recession back down to 20% from 35%. Recently released data suggests the U.S. economy was on a resilient growth path heading into the latest oil price shock. And even through March, when the war was raging, the labor market seems to be improving by some measure. So, look, things are looking a lot better this morning. But there's a big if, and that's, if the ceasefire holds, if the ships continue to pass through the strait, all of this is riding on this reduced price in oil and completely better outlook.
Yeah, we got to keep a close eye on the satellite pictures or data we get in terms of straits through the ships through the strait. Excuse me, Carl.
No, I mean, we're in the mode now where we're on the lookout for tail risks as a result of this. Hapag-Lloyd, the big shipper, said even if this is a clean ceasefire from here, it'll take 6 weeks to get shipping back on track from where it was prior to hostilities.
But the market is jumping on the positive today that once they pass through, the 1,000 ships that are waiting to pass through at any given company maybe can start moving. But, Vice President Vance called it a fragile ceasefire. So let's wait and see. I mean, this could be a violent reversal if things go the other way.
Oh, absolutely. As you just indicated, things have changed a great deal overnight. All right, let's get to Megan Casella. She's in D.C., of course, has the latest on where things stand right now involving the U.S. and Iran. Megan.
Guys, good morning. That's right from the White House, where we're tracking a lot of moving pieces over what exactly has been agreed to and implemented so far as part of this 2-week ceasefire. There are questions around whether it will hold and what the path forward will look like from here. So far this morning, Sarah, you just mentioned Vice President J.D. Vance called the agreement a fragile truce. And the chairman of the Joint Chiefs of Staff is emphasizing that the military remains ready to resume combat operations if needed. The state of the Strait of Hormuz is somewhat unclear at this point. Defense Secretary Pete Hegseth says commerce will be flowing through the strait, but Iran says that reopening will be limited and that passage will require coordination with its military. Iran also says that in-person negotiations will begin in Islamabad on Friday, but the White House says nothing is official until it has been announced from here. And despite the ceasefire, there's also reports of attacks across the region overnight, including in Iran, the UAE, and Kuwait. Iranian state media Fars News now is reporting that Iran believes Israel violated the ceasefire and says it's preparing a deterrent operation against the Israeli military. So a lot could happen in the next few hours that will determine the next steps from here. And then in the meantime, President Trump is also saying this morning that any country supplying military weapons to Iran will see a new 50% tariff on its exports to the U.S. I've asked the White House for details on what authority the president will use to do this, but it seems to be a direct shot at China, could lead potentially to steep new tariffs on Chinese imports, guys, just over a month out from that bilateral summit in Beijing.
Megan, is the White House saying anything about this 10-point peace plan that Iranian state media released, which I don't know how trustworthy it is, but I don't see anything that it seems like the U.S. would agree to on that?
Absolutely. That's the key question right here is what's going to happen with that 10-point plan. President Trump, in his initial post last night, said that that was a workable basis on which to start negotiations, pointing directly to the 10-point plan that the Iranians put out. What the Iranians say is in that plan, though, as you say, there's not much that it looks like the U.S. would agree to. It involves lifting all sanctions against Iran, removing all U.S. military from the region, allowing Iran to maintain control over that strait and keep some military escorts required, possibly opening the door to charging tolls and that sort of thing. All of those on their own, that's just 3 of the points, don't seem to be something that the U.S. would agree to. But what we're hearing from the president, sometimes he calls it a 10-point plan, other times he says it's the 15-point U.S. plan that they're working off of. He says a number of the points have already been agreed to. We just don't have specifics on what they are just yet.
Yeah, the phrase acceptance of enrichment in the Farsi language version is raising some eyebrows, not in the English version, Megan. We'll talk all morning long as we get closer to the presser. Yeah.
And another point is ending IAEA resolutions and nuclear oversight measures on that enrichment.
Right.
Yeah.
Megan Casella in D.C. For more on this post-ceasefire rally that we got going this morning, let's bring in Roger Altman, founder and senior chairman of Evercore. Man, are we ever grateful to get you today. Roger, thanks for the help.
Good morning, Carl. Thanks for having me.
So ceasefires are always a little porous in the early days. But we do have the Saudis intercepting drones. Israel's hammering Lebanon today. The Iranian Navy says you either get our permission to cross the
Back to a nothing burger. Back to a nothing burger. My teammate Benz echoes my sentiment exactly. Should have took profit at the end of the 955 candle. But in a nothing burger right now. Waiting to see what the market does. Let me clear this up a little bit. Hold on, team.
I know I can be successful.
Welcome back. Stocks are rallying today. Oil plunging after news of the ceasefire with Iran. Watching to see if it holds. Let's bring in CNBC senior markets commentator Mike Santoli. Market definitely wants to believe that it will, Mike.
For sure, Carl. I mean, we've talked so much in the past few weeks about how the market in general has not wanted to get too far away from just this possibility that we do get the cessation of hostilities for whatever period of time. You take re-escalation off the table, you get some relief on oil prices and treasury yields, and then it's a matter of regrouping and figuring out, what the enduring trend is. And now, in terms of the character of this bounce, it's a pretty strong and broad rally, but I think it's the time where you want to scrutinize as to whether you're seeing a real burst of momentum happening in this market. It's very telling, probably, that the S&P 500 has popped right back up to levels where everybody would look at the chart and say, there could be resistance right here. It's the 50-day moving average. It's not necessarily suggesting immediate escape velocity. You're not getting 90% of upside volume on the New York Stock Exchange. All those things are just the absence of potential positives that would have said this is the start of a decisive move higher. It does make sense to me, though. Financial conditions easing. It's a step in the process. And I do think it's now a question of, we did have these pre-existing conditions, so to speak, before the Iran conflict, which were concerns over private credit, which were, is the AI investment phase going to be fruitful? All those things. And we've taken a long time in trying to digest them. So now it's time for the market to tell us whether we've actually kind of rationalized all of that. We're at the S&P's at levels we first got to in October. Let's keep that in mind. There's been a lot of sideways correction through time, as well as price and valuation has become mitigated over that period of time. So I think that's where we sit right now. This market is not acting today like this is, essentially an all clear indefinitely from this point.
I was going to say, forward PE is what, just south of 20 on the S&P,
with this
Mike?
bump, it's probably around 20, exactly, yeah. So
but
we did.
In October, we were above 23. You think we get back there?
Just about 23. It's unclear to me if we really go back to those highs. That's been the upper end of the range for this move. I don't think anybody thinks 20 is cheap, but it has been one of those situations where for this bull market, that's been around the bottom of the range. For context, in the bottom in April 2025 in the tariff panic, you got down to 18 or thereabouts. We did not get as washed out by any measure this pullback relative to the way we did in April of 2025. So presumably that means we don't have the kind of open-ended upside in a recovery scenario that we did back then. Also, keep in mind, we were talking rate cuts before this all started. We got those off the table. Oil's not going to necessarily retrace the whole move higher. So I do think you're going to have some friction. And so the market, again, is going to have to reconcile all those things. But Wall Street likes nothing better than pain before gain narratives. In other words, oh, the numbers are going to be messy. We're going to have to get through this period. But that de-risks the economic and earnings data, in my view, in the near term, because everybody could say, oh, don't worry about that. That's conflict related, and that's something that we're going to get through over the next several months.
When you're talking about rationalizing AI, Mike, explain to me what you mean. I mean, it's not like we're going to stop debating whether software companies are going to get slaughtered by AI or the value of NVIDIA, what the value of NVIDIA should be.
You're not going to stop talking about it, David. My point is that those stocks didn't kind of hold up in the downturn. So in other words, they've also had their the hurdle rates go down arguably. Now, one difference is memory's ripping today. That's been the one area. That's kind of like people keep retreating to smaller patches of high ground, and that's where it is right now. So I don't think that you've decided that the Mag 7 is going to be coming back and is going to lead this market higher. In fact, that's a big open question right now because that predated the conflict. Starting in October, we had the peak in Bitcoin, in relative performance of Mag 7, and in AI enthusiasm. So since then, those have all come way off the boil. And the question is, have we repriced enough to make the risk reward better in that scenario? Or are we in a world of waiting for massive IPOs to test the market's appetite and waiting maybe for some of these big companies to moderate their CapEx because that's the way out of the free cash flow trap?
Yeah. Well, we haven't seen any moderation as yet. And of course, it's going to be nice to be able to lead with AI again, at least for me, Mike.
Yeah, for sure.
Not you. At least hopefully for the next couple of weeks, if not for a longer period. Mike, thank you. Yep. Mike Santoli. Time for a CNBC News update. Contessa Brewer has that for us. Contessa.
Hi there, David. Israel has launched a surprise attack at Beirut today, striking several commercial and residential areas. According to Lebanon's health ministry, dozens were killed, hundreds more wounded. Israel said that ceasefire with Iran does not extend to its war with Iranian-backed Hezbollah in Lebanon. The former architect accused of serial killing spree on Long Island for over nearly 2 decades is expected to change his plea in court today. According to multiple reports, Rex Heuermann, alleged to be the so-called Gilgo Beach killer, will change his plea to guilty after maintaining his innocence since his 2023 arrest. He's expected to plead guilty to murdering at least 7 women. And the Trump administration reportedly has rejected requests from Ford for relief from aluminum tariffs after a fire at a supplier's plant created a bottleneck. The Wall Street Journal reports that Ford petitioned the government last week asking for relief until the factory's back online. But the supplier has been making up for lost production with aluminum from overseas, and those imports, remember, are subject to a 50% tariff. So this is a fire that has been very costly for Ford.
That's going to hurt. All right. Thank you, Contessa Brewer. Coming up, an exclusive interview with the CEO of Levi Strauss. Shares surging today on a top and bottom line beat, up 11%. Plus, Anthropic limiting its newest AI rollout, claiming it's too dangerous for wide release. We've got the details when Squawk on the Street comes right back.
Oil computers now have primary control of critical vehicle functions.
Welcome back. An important development in the world of cybersecurity late yesterday into overnight. It's called Project Glasswing, and it is an initiative that has been announced by Anthropic. And the reason for the announcement, and I'll get to the project in a minute, is because of capabilities that they observed in a new frontier model that they were developing and training this is Anthropic, believed could reshape cybersecurity. It's called Mythos Preview, and it is a general purpose, unreleased frontier model that they say reveals a stark fact, namely that AI models have reached a level of coding capability where they can surpass all but the most skilled humans at finding and exploiting software vulnerabilities. In other words, if they had released this frontier model, all hell might have broken loose, because bad actors could also get a hold of it conceivably. And what it can do, again, according to Anthropic, is pretty significant. They did not release it. In fact, instead, they have gone with an initiative that includes Amazon Web Services, Apple, Broadcom, Cisco, CrowdStrike, Palo Alto Networks, Microsoft, NVIDIA, JP Morgan Chase, and the Linux Foundation, all of which is designed basically to have these companies and partnerships use this tool to find vulnerabilities that otherwise might have been found had it been released in a different way or released at all. At some point, it will be included in an update of Claude Code down the road when they have put in the appropriate safety protocols. But Sarah, what it goes to is the enormous power of these models, these new frontier models, and this one in particular, what it might have done. It's a good sign in many ways, I think, that Anthropic chose to hold it back, bring these companies together and say, we need to use it. But when they point to, and again, this is them, some of the use cases that it could have done or already is doing if it had been in the hands of bad actors, I mean, you know, it's pretty shocking in terms of
scary stuff.
What it was able to do. It acts fully autonomously, and it, for example, it discovered a 16-year-old vulnerability in in FFmpeg. That's a software that encodes and decodes video. It found a 27-year-old vulnerability in OpenBSD, which has a reputation as being one of the most secure hardened operating systems in the world, and on from there. Just shows you the power again of these frontier models.
But also the power of discretion at the top of these companies, right? I mean, Anthropic has been in the news recently with this fight with the U.S. government, and this is something that I would think that they would want to share with the U.S. government and have discussions around, certainly around the CISA office of cybersecurity. But they're, you know, still in this sort of legal limbo as they've been blacklisted.
And it also goes to this, we were having this conversation a bit with Representative Gottheimer earlier this week. This is a private company that made this decision.
Right.
They didn't have to make this decision, right, to your point.
They've got a lot of discretion.
And a lot, because there's no regulation. And so they made the decision here that conceivably on the face of it is a good one and one that will help for cybersecurity safety.
Right.
But one wonders, as this technology continues to advance, broadly speaking, whether others will make the same different and decisions within the same framework. Yeah.
I mean, they've painted themselves as the sort of responsible actor on AI, but we're starting to see differences, right, across some of these companies.
Coming up next, the CEO of Levi's with us as that stock jumps on these strong results. As we go to break, watch some gainers on the NDX, losing a little steam here as the VIX is back close to 22 and oil's once again within $5 of 100.
Welcome back. Levi's reporting a strong beat and raise quarter. Revenue was up double digits. Broad-based growth across regions and channels and continued momentum in direct-to-consumer sales. Joining us now in a CNBC exclusive is Levi's President and CEO Michelle Gass. Nice to have you here at Post 9. Thank you for being here.
Great to be here. Thank you.
You said on the call that we are becoming a more DTC-first denim lifestyle company. What does that mean, and why is that leading to what you said is more consistent and faster growth?
Yeah, so that is the core of our strategy. So really, I mean, we've been setting the foundation in the last couple of years to make this pretty big pivot. You know, Levi's has been around for 170 years and largely has been a denim bottoms business. And strategy number one is to really evolve that from just denim bottoms to head to toe, what we call denim lifestyle, but really playing in the full apparel category, which dramatically expands our addressable market, as you might imagine. And then secondly, traditionally the company has sold our jeans through others, and we're making this pivot to become a direct-to-consumer retailer. And this year, for the first year ever, our sales will be more than half in direct-to-consumer. That is the momentum that's fueling this business and why we put up such great numbers.
Well, so it will exceed brick and mortar for the first time, and again, to
brick and mortar
DTC
and e-commerce. So those two combined will exceed 50%.
You raised your guidance, and you said you feel very confident, which is why you're raising it. There's plenty of things going on in the world. I don't think I need to tell you that conceivably could impact the consumer. Just curious as to why you made the decision to raise guidance and what that confidence is built on.
Yeah, say a couple things. I mean, number one, you know, we had a very strong beat. I mean, our sales were up 9%, significantly ahead of what we had guided. And so while we did raise our guidance, we didn't take the full beat through. So that does give us a little bit of cushion, if you will, depending on how things play out. And we're staying really close. I mean, I would tell you from a brand standpoint that our strategies are working, but we're a brand who's been around a long time. We've weathered lots of uncertainties over time. And usually at times like this, consumers go to brands that they love, that they trust, high quality brands with durability, and certainly Levi's is one of those brands. So the fact that our consumer is proving so resilient, we had a great quarter. You know, early part of this quarter, as we shared yesterday with investors, we're off to a good start. So we'll stay close, but we're confident.
And you have pricing power as well?
We do. You know, one of the things as we think about the pricing strategy is it really is about elevating and premiumizing the Levi's brand. And we've been on this journey here for the last year, which is taking less promotions, less discounting, more full price selling, pricing for innovation. I mean, we are a great value if you think about Levi's. We also have a segmentation strategy. So our core red tab, which is the bulk of our business, we do have a value brand called Signature. And that brand's priced in the $20 range, and that business was up 16% in the quarter. And then we're going high. We have a new line called Blue Tab for that premium consumer. That grew like 40% in the quarter. So we're really covering all bases of the market, however the consumer wants to shop.
I feel like, I mean, analysts write about the denim cycle. To me, that's just, you know, jeans are in right now and lots of different styles. Like we're wearing wide leg, we're doing 90s jeans like Carolyn Bessette, right? There's a lot, people are buying jeans because the styles are changing. How much of that is a tailwind, and how reliable is that to last?
Well, what I tell you is we're the category leader, so we're helping to fuel those trends. I love that you brought up the 90s trend, because that is happening everywhere. We're fueling it. I mean, if you go into our stores right now, we call it grunge prep, but we're leaning into the fits, the finishes, you know, back in the day, the jerseys, the polos, et cetera, rugby shirts, and they're working. And, you know, it's interesting you bring up Carolyn Bessette. I mean, she was known for wearing our 517 Levi's, and they're prominently featured in the story Love Story, but not just her. I mean, pop culture, center of culture, you know, that's another reason why the brand is so relevant right now. We're shaping culture. We're hitting our stride, and so whether it is the Carolyn Bessette piece, Harry Styles, he's wearing 501s on his album cover, his dancers were wearing them at the Brit Awards, to even us hosting the Super Bowl at Levi's Stadium, you know, just recently, and doing a commercial on the Super Bowl for the first time in 20 years, launching our brand campaign for the year. So it is about driving that innovation, product relevancy, brand heat, you know, coming all together to fuel the demand.
But that doesn't always, I mean, that can go in and out, right? A few years ago, it was all about sweatpants.
You know, denim's been around a long time.
Longer than athleisure?
Longer than athleisure. Hey, we've been around around 170 years. And actually, if you look at the data, the denim category right now is outperforming overall apparel, and that's expected to continue over the next few years as we look at the data. We see that the denim category is expected to grow both in the U.S. and also globally.
What do you think happens to the wholesale model? I mean, how small of a piece do you think it can get for you guys?
Yeah, so as I shared, it's about 50-50 right now. Wholesale will continue to be an important part of our business because as much as we're going to build lots of stores over the next few years, we're not going to get everywhere. And so it's important to amplify the brand and to meet consumers where they are. Wholesale grew this quarter as well. So, we see DTC being that primary growth engine because we have lots of upside in building stores and comp growth and e-commerce. But it's an important channel, and while our DTC was up 10% in the quarter, wholesale was up 8%. And our wholesale customers and consumers are responding to what our DTC consumers are. This shifting to head-to-toe apparel, always grounded in denim. We call it denim lifestyle, but that means getting into categories like tops and dresses and skirts and jumpsuits, and they're all working. I mean, those categories were up 13% for the quarter, outperforming the overall business. So it just says that even as a denim bottoms company, there's a lot of room to grow as we look out in the next 5-10 years.
You mentioned the Super Bowl, higher marketing spending. You seem to obviously getting a bang for the buck. Do you want to continue that, or does that slow at any point?
Yeah, no, we are very much a brand-led company, and we connect with consumers. When we think about even the campaign we launched, so we did advertise in the Super Bowl, but it was much more about a launch of a campaign, both globally and locally, and doing what Levi's does best, really bringing together music and sports, fashion, and that was our campaign's all about, and tapping into local and global influencers like Doechii, Rosie from Blackpink, 90 million followers. And in fact, we're following that success by launching a collaboration with her in Asia, which also had a great quarter and plans to continue.
I was going to ask you about international, how it compares to North America, and whether there's any sort of ancillary friction because of what's going on in the world, anything like that?
No, we're not seeing it. I mean, Levi's is very much seen as a global brand, and our international business is really strong. It was up 12% for the quarter, and we saw strength across the board. So we, staying close, but we think that tailwind will continue.
Where are the jeans made, and how big of a factor are tariffs for you?
Yeah, so our jeans are made overseas, largely from Asia. And I'm glad you asked that question because still even within our guidance, we have baked in, I'd say, the more aggressive tariff policy, which was that upwards of 20% reciprocal tariffs. We have not baked in now this reduction to 10%. So that's, again, a little bit of a contingency depending on how things sort of play out. But we know it's still an uncertain time. So, if we do take to the bank that reduction in tariffs, that's probably worth about $35 million to us, about 7 cents to EPS.
Are you going to try to claim tariffs with the Supreme Court?
Yeah, well, that's another thing,
Tariff
right?
revenue?
So separate and aside from the reduction is, the
Receipts.
The receipts. For us, it's worth about $80 million. It's a big number, but we're just holding tight. Again, there's been a lot of fluidity in the situation, so we'll see how it plays out.
Michelle, appreciate you joining us. Thank you.
Thank you.
Michelle Goss, CEO of Levi's.
We do have some breaking news to get to here on Iran. Let's get back to Megan Casella in Washington. Megan.
Guys, this is about the Strait of Hormuz and whether it's open or not. Iran's state-run Fars news agency is saying just now that simultaneous with Israel's attacks on Lebanon, the passage of oil tankers through the Strait of Hormuz has been stopped. Guys, we were just talking earlier in the hour about there's questions about whether Israel's ceasefire does apply to the fighting in Lebanon. Israel, of course, not agreeing to the idea that they need to halt those military activities in Lebanon. Iran now saying that because those military activities are continuing, that they are stopping passage of oil tankers through the Strait of Hormuz. Now, no official response from the White House yet on this, just breaking in the last few minutes. But earlier in the hour, a few minutes before this, the president did speak with PBS News, and he was asked why Lebanon was still being hit. He told the reporter Lebanon was not included in the deal because of Hezbollah, but that will get taken care of too. He said it's all right. So brushing off concerns there about Israel continuing to attack Lebanon, although now we know major repercussions. Iran now saying they are shutting down passage of oil through the Strait because of it. Guys.
Well, all right, so Megan, we've got the president saying it wasn't included in the deal. At least that is what he apparently said to PBS. And we have the Iranians conceivably indicating that they believe it is included in the deal.
The Iranians do believe that there has to be a cessation of all fighting, including in Lebanon. Israel has been straightforward that they don't agree that it has to include that fighting over with Hezbollah in Lebanon, and we saw their heaviest wave of attacks yet just overnight. So that obviously continuing, they believe that that was not part of it. The White House had told me Israel had agreed to the ceasefire last night, but clearly perhaps not over this one branch. Now we're seeing the consequences of that.
Megan, thank you. We'll stay on top of it with your help. Our Megan Casella. Speaking of all this volatility, the volatility index plunged to its lowest level since the war began. Let's bring in Michael Palmer today, VIX options trader at Group 1 Trading, live from SIBO Global Markets in Chicago. Michael, thanks for the help today. Good to see you.
Thanks for having me.
Almost got to teenager level on the VIX, up a little bit right now. What's it telling you?
I mean, we've had a big pullback in volatility. Obviously, we're trading 30. We're down to 20. The real question the market's asking right now is, are we going to return back to, if this deal holds, are we going to return back to the market that we saw just 2 months ago? That market was noted by very low correlation. We saw Amazon up. We'd see Tesla down. That would mute overall index volatility. But since this conflict broke out, we started seeing stocks correlate. We saw the VIX spike, and we just generally saw a higher baseline for the VIX. So I think really the question is will we see dispersion amongst the components of the S&P 500? Or will they be correlated because we're driven by macro news?
Right. What's your view on that?
Well, my thought right now is there will be news, right? We're sitting in an environment right now where we have new news every day. Each one of these rallies, we have a huge move up overnight today, and it feels like a very decisive rally. But what we've seen in the tariffs debate, in variety of debates that we had in the past, is that the news tends to drive the day. And what feels like a decisive rally one day is something entirely different the next day. So I think this is a place to be nimble. I don't know if this deal will hold. I don't know exactly what's going to happen next. But I do know that there will be news, and we will see movement in both the VIX and the S&P 500 as a result.
And it's not just geopolitics, of course. So we're going to get CPI Friday. I wonder if you think the upcoming round of either macro data or earnings will feel stale. But to your point, if we still are in a very uncertain geopolitical environment, maybe those readings on, say, inflation are still quite valid.
I think they're very valid, and they can be very salient if the number runs as hot as people are thinking right now. And I think it's important to kind of contrast what we saw 2 months ago, and that is a very non-correlated market with what could be a correlated market. We actually saw this in 2022. Markets were driven by inflation and rates. They were obsessed with what the market and the Fed was going to do as they reacted to various news and inflation, and that is a macro-driven environment. If inflation comes in hot, if earnings seem to be very poor or very positive, that will be an environment where we're driven by sort of a correlation to the market. So CPI on Friday is an important number, but it's just really one data point in what is going to drive this market going forward, and that's really uncertain at the moment.
Well, I mean, the data has taken a back seat lately to the headlines on Iran, and we're just getting new ones, right, with the questions about whether the strait is open or not. I'm curious what you think is in the driver's seat now. I was thinking with the ceasefire, maybe the market would pay closer attention to CPI on Friday.
You know, that is if this deal holds. I think right now people really do look at oil. Oil has been the driver for markets. It obviously has some kind of correlation for how we think about inflation. Inflation was the big driver. I think it's kind of all everybody's like thinking about inflation, thinking about rates. How does that affect the markets? What is the Fed going to do? They've been pushing out rates for some time now. A rate drop, that is, for some time now. I don't know, though, if this deal holds, whether or not what we're going to be talking about. We could be going back to talking about Iran in 2 weeks or 1 day's time. CPI would be really important had this never happened right now, because we were talking about inflation. So it was a very interesting market prior to this Iran conflict. We were talking about inflation. We were talking about rates prior to this. If we get this in the rearview mirror, I do think things like CPI, inflation numbers, earnings are going to be big drivers for how people think about the market. But for the time being, we're still in the midst of this conflict, despite the big news we had yesterday.
Yeah. Really appreciate it, Michael. Great stuff as we work our way through this important week. Michael Palmer, Group 1 at the SIBO. Thanks so much. Still to come this morning, former Energy Secretary Ernie Moniz will join us, break down this drop in energy prices today as Money Movers begins in just a couple of minutes.
Good Wednesday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, the 2-week pause fueling a relief rally on Wall Street. But we're joined by one top strategist who says investors might be getting ahead of their skis when it comes to pricing the end of the war in Iran.
What are the diplomatic and military options left for the White House? We'll ask one former State Department official under President Bush who says Iran got the best of us in this deal.
And energy markets breathing a sigh of relief on hopes of moving past the peak supply shock. Former Energy Secretary Ernie Moniz will join us to explain why he thinks Iran's control of the Strait of Hormuz may now be its biggest deterrent against future military strikes.
Trying to hang on to the best of the open so far today. We're off maybe 0.5% from the highs. NASDAQ up 2.5%. S&P up a little better than 2%. Crude's been creeping a little higher this morning. We got to 91 last night, close to 96 right now. Certainly overseas, though, Japan, South Korea putting together gains of 5 or 6%.
Remember, these are the importers of oil. They need oil more than we need oil. And so when prices come down, it's a big relief for their economies.
Yeah. Let's begin with the latest in Iran. Still some major questions remaining about this 2-week ceasefire. Our Megan Cassell has been tracking developments all morning long outside the White House. Hi again, Megan.
Hey again, Carl. That's right. Major questions, both about whether this 2-week ceasefire will be able to hold, and then, of course, about whether there's any room for a broader, more permanent peace agreement, given what each side is saying it is demanding. So Iran has laid out 10 points that it says the U.S. has fundamentally committed to, or at the very least would have to be part of any deal. And a number of them would seem to raise some flags. The biggest question right now being over the Strait of Hormuz. Iran saying that it will need to retain control over the strait, and that passage will be limited and require military coordination. That seeming to conflict with the president calling for a complete reopening. Acceptance of enrichment is another bullet point here, seemingly incompatible with the U.S.'s goal of limiting Iran's nuclear program, and cessation of war on all fronts, including in Lebanon. Israel disagrees with the idea that the ceasefire includes Lebanon. We saw its heaviest wave of attacks overnight, and just in the last few minutes, Iran's state-run media now saying that passage of oil tankers through the strait has been stopped as a result of those attacks in Lebanon. And guys, the last we heard from the White House on this 10-point plan was the president calling it a workable basis on which to negotiate. Clearly some conflicts here, though. We'll see if that remains true through the rest of today and through the rest of this 2-week ceasefire. Guys.
Megan, will await the presser at 1. And then this meeting with the Secretary, the General of NATO. I wonder whether or not he's actually been quite supportive of U.S. policy in recent months.
He has been. He's been supportive of U.S. policy. He's been trying to stay on the good side of President Trump. As of now, we're not expecting to see the two men together on camera. That could always change, but of course, quite a day for the head of NATO to be here when the president has not held back any of his criticisms for the organization, musing about withdrawing from it, saying that he did all of this in Iran without their help and suggesting they should have been there to help him. So we'll see what we get from the two of them. He will be at the White House later today.
The president said in the social media post, Megan, that the U.S. will work with Iran to dig up and remove the country's nuclear material. So, I mean, why the mixed messaging here?
So much mixed messaging. And we have seen that since the start of this war, Sarah, both President Trump to some extent, as well as the Iranians certainly speaking to a domestic audience, and both sides trying to gin up support at home. And therefore, that might be a reason for part of the mixed messaging here. But what's not clear is, are they on the same page at any point? We are even hearing mixed things about in-person negotiations. The Iranians and the Pakistanis saying that in-person talks will start in Pakistan on Friday. The White House not confirming that, saying they haven't announced anything just yet. So are they even going to be sitting down together this week? We don't know that yet. And is there much in either Iran's 10-point plan or the U.S.'s 15-point plan that they can agree on? It's hard to see an agreement at this point where both sides feel like they have notched a win and that the other side is ceding to some of the demands.
Yeah, and we don't know who exactly the White House is negotiating with yet, do we?
We don't know a lot of that. There's been some reporting that Steve Witkoff has been talking with Iran's foreign minister. We also know the mediating countries seem to be doing a lot of the heavy lifting here. Pakistan in particular, Turkey's been involved to some extent. So is it just the mediating countries that are sort of being the intermediaries here? How much direct contact is there? That's been up in the air. Steve Witkoff, J.D. Vance, the vice president, Jared Kushner, the president's son-in-law, seem to be leading things for the U.S. side. We just don't know exactly what the communication looks like.
No, it's so hard to understand how to cut through some of the posturing, especially on the Iranian side, and whether, their state media is even connected with their state. Thank you, Megan. Megan Cassella. For more on the market reaction to the Iran war ceasefire, let's bring in Rosenberg Research founder David Rosenberg. David, it's good to have you. What do you think of the price action today? You know, very steep declines in oil prices, down 17, 18%. Rally for bonds, rally for stocks. It's a celebration of maybe the worst of the inflation fears ending. Do you buy into it?
Well, I think that it's a classic knee-jerk reaction by the market. You know, the question you could also ask is, you know, how come the market didn't tank, you know, in the past couple of weeks with all the bellicose statements and the war intensifying? And I think to some extent, the markets were thinking all along that Donald Trump was actually looking for some sort of off-ramp. So, you know, today you've got a massive reaction, especially in the equity market. I mean, yeah, WTI is down to $95 a barrel, but you know, before the war it was just over 60, so we're still 50% above where we were, and the stock market is rallying size. In fact, rallying more than the bond market is. You talked about, you know, inflation expectations possibly coming down and the Fed. But you know what we have is a ceasefire, right? We have a 2-week ceasefire. And it seems to me the risk is that the markets are going to start to price in that this is going to be the touch-off point for a grand peace plan, which I'm very skeptical on. A ceasefire is just that. I mean, Israel and Hamas have had 8 ceasefires in the past 2 decades. And where did that get us? So we've priced in a lot right now. And the question is, what happens after 2 weeks?
Well, you noted the resilience of the equity market, and yes, we're only now less than 3.5% away from the highs. So it's been resilient throughout and is rallying here. And I sense you sort of disagree with this, but part of the story there is that, you know, the earnings outlook still looks strong and the underlying economy still looks strong. And we've had recent signals like jobs and others showing that, you know, going into this at least, the economy was on solid footing. I know you disagree.
Well, I mean, how could I not disagree? I mean, the Atlanta Fed was not too long ago, you know, call it roughly 3% for first quarter growth. We're going to get all these income tax refunds, and now it's down to 1.6%. So I guess if your definition of a solid footing is 1.6%, I guess we have to redefine what solid footing is. You and I went back and forth with some of your recent interviews on the non-farm payroll number, and the question I would pose to you is, why do you believe the 178,000 number that came out on Friday, when there's a 100% chance that number's going to get revised, and the pattern of the past years suggests that it's over a 90% chance that number's going to get revised lower? And what isn't mentioned is that for the second month in a row, we had a negative reading on household employment, and that companies, well, you could argue added bodies. In March, they cut the work week by 0.3%, which is a big down move in 1 month. So no, I would take umbrage with the view that the labor market is as healthy as you would suggest. And the economy.
It's not that I'm sorry to cut you off, David.
Yeah.
It's not that I believe necessarily, and for sure, they always get revised lower. What I note is that we had a negative payrolls number the month before, and now we had a sharply positive payrolls number. So that would suggest that momentum has become better.
Yeah, but Sarah, if you look last year, there were probably 4 or 5 months where the number was like the number we just had in March. And then you look at the second revision and it all got revised away. So this is like a classic case of Einstein's definition of insanity. Like I think what me and you should do is come back in 2 months, and then we'll talk about what the March number really was. Yeah. But the reality is that total labor input into the economy, which is hours worked in bodies, aggregate hours worked index, was negative 0.2%, negative 0.2. Average weekly income was negative 0.1. Those two things going down together in the same month is a 1 in 10 event. So I know that it's popular to just talk about the headline. You know, I keep saying if the headline is all that's important with these employment data, the BLS should just have one number and forget about publishing a whole report. Like, it is a whole report. And then if you go to the JOLTS data and you look at the hiring rate, the quits rate, and the job opening rate, they're all down significantly. And in fact, when you look at the totality of the JOLT survey, which tells you what's happening underneath the surface of the labor market, and these data were for February, it was the worst month for JOLTs since April 2020. So I'm confused when I hear about how strong the labor market is. If the labor market's that strong, why is nominal wage growth decelerating? Yeah. It was 4.2% a year ago. It's 3.5 right now. It's the slowest nominal wage growth in 5 years. And if we have a tight labor market, like, I'm rolling my eyes at some of the people at the Fed with their PhDs in economics. Don't they realize that if nominal wage growth is decelerating, by definition, you do not have a tight labor market? Like, what economic school do you go to draw a different conclusion than that? But yeah, I'm pushing back on the view that the economy is as, quotes, hot as the popular narrative is right now.
And we're not even really getting to where we would be ex-healthcare and, say, social assistance. The labor market resting almost entirely on those areas of business. The other side, David, is energy, food, transports, airfares, and insurance. There's a third of CPI right there. Do you think headline gets to 4+?
It probably could in the next few months, but look, if this ceasefire holds, if this turns into something much bigger, then the markets are going to look through it, because they will view this as just a multi-month shock, and then we'll revert back to the norm. Now, I just want to say that what was the norm? The norm was basically close to the 2% target, because when you go back to Jay Powell last week on his panel, he said that when you strip out the effects of the tariff file on goods, it was adding something like between 0.5 and 0.75 of a percentage point to the inflation rate. Well, that takes you down to 2%. So if we can get through this, and let's hope that this ceasefire proves to be something more durable than that, I think people will be surprised that underlying inflation and headline gets down to target quicker than people think, despite all the other pressures you mentioned. Don't forget that a third of the CPI is residential rents. And when you're taking a look at actual rents and you're taking a look at home prices, which are now showing decay, that's really where the rubber meets the road. That's the canary in the coal mine for where the inflation rate's going to go. And it's far bigger than everything else, including food and energy. And that's one of the reasons why the rental disinflation is finally breaking to the downside. And I think that's going to be a defining feature that's going to surprise a lot of people between now and the end of the year.
So is your best bet now, because you always extrapolate it into markets from the economy, is it bonds? Is it gold? I mean, how are you expressing this view where you think that the economic narrative is too rosy and inflation may be coming down?
Yeah, well, I mean, I still like gold. You know, the gold miners got beaten up really badly. I mean, we talk incessantly about software and how that's related to private credit, but I think that gold is it got sold off because of all the collateral calls and the margin calls, and so investors were selling their winners to meet those requirements. So that was a fund flow shock. The same thing happened, by the way, you know, after 9/11 and after Lehman collapsed in September of 2008. People didn't know why gold was getting hit. Well, this does happen actually during the immediate aftermath of a crisis, and then gold is a great buying opportunity. I still view gold as in a secular bull market that actually began in December of 1999, and there's been probably 20 corrections along the way, but that is a secular bull market that I've identified. So I like gold. I like the gold miners. Do I like bonds? I can't say that I like long bonds right now, because there's going to be this enduring fiscal premium, as if there wasn't one already, because of the need to, you know, fund all the depleted armaments to fight this war. So that fiscal premium is going to be frustrating for the long end of the curve, but I really like the front end of the curve. I really like 2-year notes. I think that the Fed will not be hiking rates. I think they'll be cutting rates, I think, at least 2 times between now and the end of the year, and it might be backloaded towards the end of the year. But I think the economy is going to be in weaker shape. I'm not saying there's necessarily going to be a recession, but it's going to be in weaker shape. And I think that when I dive into the details and the leading indicators on inflation, and I'm looking at the labor market, which beneath the surface, by the way, beyond the U3 unemployment rate, the labor market is showing growing signs of slack. So wage growth, and we're seeing it in real time, is slowing down. So I think that is going to give the Fed the leeway to pivot. And look, some people are already there, like Powell and Williams are there. It's the rest of the group. But I think the Fed will be cutting rates. And I think your safest bet's probably going to be at the front end of the Treasury curve.
Okay. Well, that's certainly not what the market is telling us right now, David. Thank you for joining us. Always good to hear from you. For an alternate take, David Rosenberg of Rosenberg Research.
Still to come this hour, former Assistant Secretary of State for Political Military Affairs, retired General Mark Kimmett, why he says Iran got the best of the U.S. in this ceasefire deal.
Plus, we'll speak with former Energy Secretary Ernie Moniz, key negotiator in the 2015 Iran nuclear deal under President Obama. More on the reopening on the Strait as well, with questions about what's moving right now, with some new reports from the Iranian media. We'll be right back.
Welcome back. The U.S. and Iran agreeing to a 2-week ceasefire contingent upon the reopening of the Strait of Hormuz, though Iran's state-run media just saying now passage of oil tankers through the strait has been stopped as a result of attacks in Lebanon. Joining us this morning, retired Army Brigadier General, former U.S. Assistant Secretary of State for Political Military Affairs, Mark Kimmett. General, it's great to have you back. Thanks for the help. We set this up by saying you believe maybe the Iranians benefited a little bit more than our side in this ceasefire. Can you explain?
Well, they certainly feel that way. And I think it's important to understand that that 10-point plan that we have all agreed upon sets the bounds of the negotiations. We're not going to be talking about anything outside of that 10-point plan. Our objective in this war was to end their nuclear program, end their ballistic missile program, end their proxy program. And of note, not one of those three issues are mentioned in negotiation. The focus seemed to be on the Strait of Hormuz. So it would appear to me that the Iranians have successfully taken us off our goals, and now they're focused on their goals.
Do you think, I mean, some are arguing that we have essentially formalized their control over the strait in ways that didn't exist before, and that they've essentially been made a fourth center of power in the world. Is that too aggressive?
Well, again, I think the logic that people would say, no, Kimmett, you're wrong, this is what we're going to negotiate, and all of these issues will be negotiated on the table. That's not how the Iranians work. And the fact that they have already stopped transit through the Strait of Hormuz because of what's happening in Lebanon, they want to make that permanent. They want to become the toll gate on the Strait of Hormuz, and it's going to be hard to talk them out of that view.
So what ultimately do you think happens here? Because that 10-point plan you referenced, I mean, there's a lot in there that the U.S. would not appear to be on board with.
Yeah, especially the withdrawal of all troops out of the Middle East. I don't think we're on board with that, and I don't think our Gulf allies are on board with that. What do I think happens in the short term? I think we go back and forth. I think in the intermediate term, what happens is we somewhat formalize the ceasefire, which means we've really accomplished nothing. And it just means that, as I've seen so often in the Middle East with Israel, sometime in the future, we're just going to have to go back and mow the grass again.
I'm curious what you think the Chinese are thinking today. There's a view that because they worked with the Pakistanis to set some of the terms here, their relevance has been lifted at our expense. Do you agree with that?
No, I really do. It's not just their work with the Pakistanis, but I would note that the Pakistanis have become much, much closer to the United States in the last year because of Field Marshal Munir. But China does have great influence, always had in Pakistan, but I'm more concerned about the increasing influence of China inside of Iran.
The defense secretary today said only about 10% of military capacity was spent, although we've been talking a lot about Raytheon and 850 Tomahawks being used, years of supply. Is that a concern for you?
I've seen the numbers as well, and this is a time we've got to thank the American taxpayer for the money they put into these weapons, because all indications are we've got sufficient not only to continue the fight in Iran, but to meet our other worldwide contingencies, except in a very few cases.
I do wonder if one of the upshots of this will be, a change in attitude and posture and sense of urgency from the Gulf, the rest of the Gulf, the UAE and Kuwait and Saudi Arabia, who all got attacked in this. And whether, can they come up with an alternative to the Strait of Hormuz and just how reliant the world is on it?
Well, some of the countries are already building trans-regional pipelines. For example, most of the Saudi oil doesn't go through the Gulf anymore. It goes over to the Red Sea. Of course, the Red Sea is no secure location either, but all of them are building alternative methods of getting that oil out of the Gulf without going through the Strait of Hormuz.
Yeah, FT with the piece today that east-west pipeline was attacked by a drone. We don't know a whole lot more about that, but I do wonder, and we've been talking about the Houthis for 5 weeks, do you still see them as a threat in the wings?
Carl, the most surprising thing of this war has been that the Houthis didn't join into the war on day one. They're very, very connected to Iran. They're supplied by Iran. Their views haven't changed at all, and the fact that they're waiting till now to start this is the only surprising part of this. I think they'll be a big factor going forward.
What do you think Israel's trying to accomplish in Lebanon when it comes to Hezbollah? How much damage can they do?
They can do a lot, but I would remind them, and this is prescient for Iran, in 2006, after the Second Intifada, when they had basically raised the southern Lebanon ground to almost nothing and the place was rubble, they pulled out, and Hassan Nasrallah came out of his hole and declared victory. And the next day, there was a 100,000-man march in South Beirut proclaiming victory. So, unfortunately, I think what Israel is trying to do is finish the job so they don't have to mow the grass in the future. I would say they're doing a great job at it, but they will not get help. They will not succeed until they get help from the formal government inside of Beirut, which they're not.
So ultimately, what happens there? I mean, it sounds like the U.S. and Israel do not think this is part of the ceasefire, but Iran does, and now is blocking the strait.
Unfortunately, I think we're going to see more and more of this. And it's not just the particular issue of Lebanon. Iran is not only concerned about Lebanon, but it's concerned about quickly and clearly establishing their dominance over the Gulf and the Strait of Hormuz. And if we allow that to stand, anytime there's a disagreement in the United States and inside the United Nations, pressing something against Iran, they'll close off the Strait of Hormuz again. So it's vital that we do not let this control over the Strait of Hormuz fall to Iran.
Certainly that is the number one key for markets, that they don't play that card repeatedly in the coming months and years. General, talk soon, I hope. Thank you so much. General Mark Timmett.
Markets still rallying. Dow's up 1,000 points. We're going to have much more on this move in crude oil, which is also sharply in decline. WTI down 14%. The ripple effects on the economy. Former Energy Secretary Ernie Moniz helps us look at that.
Then Anthropic in their new AI model, might it be too powerful for the general public? We'll look at what the company is branding as one of the largest breakthroughs ever in cybersecurity in a moment. Rally holding in there for the most part, although you want to keep your eye on breadth today. Stocks surging to the upside this morning with about 80% of companies in the green. Take a look at some of the gainers on the S&P right now. A lot of travel names, United, Carnival, SanDisk, some techs in there. Cruise lines especially, with Carnival at the top. As for the laggards, definitely some selling in energy and some materials like fertilizers. Energy is actually the only sector that's lower at the moment by almost 5%. Kramer had said earlier in the week might be time to sell some of these high-flying fertilizer stocks. That's definitely paying a good call at this point.
The reversal of the Iran trade. But, you know, some of the big winners are the big tech companies that seemingly weren't in the crosshairs, like a Micron is back on top after a little bit of a sell-off in the last few weeks. Apple, Amazon, NVIDIA, Meta, Google. I mean, that is ultimately what's leading us higher, as Mike Santoli said, perhaps on the idea that just getting swept up in the overall market sell-off, they were looking cheap. Today is a big relief rally, up 1,000.
Let's get a news update with our Christina Partsinevelos. Hi, Christina.
Hi, Carl. The Department of Justice said today that Pam Bondi will not appear for a deposition in the Jeffrey Epstein investigation because she's no longer the Attorney General. The DOJ also asked for the subpoena to be withdrawn. A spokesperson for the committee told CNN they will contact Bondi's personal lawyer to reschedule the deposition. The Associated Press declared Republican Clay Fuller the winner of a tightly contested runoff election in Georgia just yesterday to take the congressional seat vacated by Marjorie Taylor Greene. Fuller, a former DA and Trump ally, defeated moderate Democrat Sean Harris. The victory returns one seat to the GOP's razor-thin majority in the House. And an employee of the company that operated a distribution center for Kimberly-Clark under arrest today after a massive fire at a facility in California. The 1.2 million square foot warehouse engulfed in flames by what police say was an arson attack. Authorities say the 6-alarm blaze took about 175 firefighters to get it under control. Kimberly-Clark says it's taking action to mitigate the impact and keep deliveries flowing. Back with you guys.
Christina, thanks. When we come back, former Energy Secretary Ernie Moniz, a key negotiator in the 2015 Iran nuclear deal. We'll talk about what comes next in the energy markets with oil prices down today.
Plus, do not miss CNBC's Invest in America Forum. It's happening next week. We're going to be joined by top government officials and CEOs from all sorts of industries. The Treasury Secretary, the CEO of FedEx, GE Vernova, ARM, Cross Industries, Franklin Templeton, happening April 15th. CNBC.com, CNBCevents.com to learn more. We'll be right back.
Crude prices are plunging this morning on the U.S.-Iran ceasefire, but the ability of ships to transit the Strait of Hormuz is still a major question. Our Pippa Stevens is looking into that this morning. Hey, Pippa.
Hey, Carl. Well, Iranian state media is saying in the last half hour, 72, but that is still more than 90% below pre-war levels. Now, 172 million barrels of oil and crude products do remain trapped on the water in the Persian Gulf, which will take time to clear, but it would certainly help alleviate some of the stress in product markets, especially if those ships can exit. It will also be key to watch not just ships leaving the Persian Gulf, but whether we start to see ships entering as well. Now, the situation does remain precarious. I just got off the phone with a shipping executive who has ships stuck in the Persian Gulf, who told me they have no information about how they could transit during the ceasefire, and they are not in touch with Iranian authorities. Now, the big price drop in oil today indicating the market taking this as a sign of relief. But Rystad Energy noting while paper markets can reprice the relief almost instantly, physical differentials are likely to remain sticky. That comes after dated Brent hit a nominal record yesterday of $144 per barrel. Sarah?
Okay, Pippa, thank you for the reporting. Pippa Stevens. For more on the energy market, let's bring in former Energy Secretary under the Obama administration, Ernie Moniz. Ernie helped negotiate the 2015 Iran nuclear agreement with the then Secretary of State John Kerry. Secretary Moniz, it's great to have you back. What do you make of all the back and forth now around what's happening in the Strait?
Well, I think it remains very confusing, frankly. We've heard conflicting stories from Iran, the United States, Pakistan. As you just reported, there remains a lot of uncertainty among shippers in terms of what the rules are for going through the straits. I would say one thing, however, about the Strait of Hormuz, and that is that in the long term, I think there's no doubt that the Iranian influence over the Strait of Hormuz has become their principal means of deterrence. We always associated that with the nuclear program, and right now, I would say their chokehold on the energy markets and the commodity markets more broadly, like fertilizer and helium and sulfur, et cetera, really are a new deterrent. That's not going to go away, I don't believe.
I think can that go away?
It'll be a while.
Can there be alternatives?
Well, I think for oil, there are alternatives. For example, I think the Saudis and the Emiratis, I'd be very surprised if they didn't build more pipeline capacity to go to the Red Sea or the Gulf of Oman. But for a lot of those commodities, I think there's really no alternative to Hormuz. And some of the effects, LNG, for example, I think we'll see a little bit of relief now, but I don't think we're going to see major relief for quite a while until shippers have confidence, until the LNG facilities themselves reopen with confidence. And some effects will be months away. For example, will the price increase in fertilizers be reflected many, many months down the road in terms of poor crop yields and food problems? So lots of open questions. Clearly, some form of ceasefire is good news, but we don't really know how sustained that will be.
Where, Mr. Secretary, does that leave some of the countries in Asia where we were measuring their LNG reserves in weeks, not months? Can they afford to not go forward with some either rationing or shorter work weeks or driving restrictions?
I think that they will need to, first of all, they're going to have to pay a higher price for a while for some gas, but I believe they will do as much substitution as possible. For example, I anticipate a very large shift in the power sector away from gas and to coal in Asia, and I don't think that's going to be just a short time move. So I think we will see a lot of coal. We're going to see a lot more carbon emissions from that coal, I think that there will be some uses that will be very hard to substitute for example, in industry, in countries that need gas for heating, home heating, et cetera. But I think we'll see a lot of substitution and a lot of changed behavior, as you say, like, for example, more work at a distance, for example, to cut down commute times and the like.
I wanted to ask about your nuclear expertise here, because part of this, of course, this was the impetus for why we why we launched this war. And President Trump last night did say there will be no enrichment of uranium, and the United States will be working with Iran, dig up and remove all of the deeply buried B-2 bombers' nuclear dust. Is that possible to do?
Well, first of all, of course, having no enrichment in Iran is possible. On the other hand, I haven't heard Iran say that. In fact, Iran in the past has said just the opposite, that they will never agree to a deal with zero enrichment. That's where the deal that was struck in 2015 was pretty unique in the sense that it allowed a pretty low level of enrichment, but had other guardrails in place to make sure that there would be no misuse of nuclear material to make a bomb, for example. In the past, the attempts to get zero enrichment, frankly, have not worked out very well, and that's one reason why in the negotiations in 2015, we were faced with 19,000 Iranian centrifuges that had to be dialed back. Now, another major nuclear issue relevant to the enrichment story is the fact that since 2021, Iran has accumulated almost half a ton of 60% enriched uranium. There's a misconception that because that 60% uranium is not fully weapons grade, typically defined as 90%, that somehow they are short of a bomb. It's not true. 60% uranium can be directly used in a nuclear explosive. In fact, by the way, the Hiroshima bomb, for example, in 1945 was not weapons grade by today's definition. So finding that material, understanding where it is, understanding how it can be disposed of as a threat, I think is the highest priority. It does not require further enrichment to make a nuclear explosive. So we still have a lot of work ahead of us, and I'm hoping that the conflicting enrichment statements do not unravel this whole deal, because I think everyone is best served if we can find a diplomatic way out of this conundrum.
But in retrospect, I mean, they lied about the missiles in that war. They were given a lot of money to spread terror around the region. I mean, in retrospect, you really think that deal would have been successful and prevented something like this?
Well, look, the 2015 deal, everyone agrees, was successful in the sense that it was being complied with by all parties until 2019. President Trump backed out of the deal in 2018, but Iran did carry on its provisions for an extra year. Now, the problems in 2015 were no different from the problems today. That is, nuclear was one of three major problems. The others were missiles, and I would add drones to that today, and regional proxies doing Iran's bidding. Hezbollah may be primary among them. In 2015, President Obama made the choice to address those issues sequentially. So nuclear was first, and in the next administration, the hope was that after a few years of compliance, probably missiles would have come next, for example. Currently, the military operation clearly is trying to resolve, or tried to resolve, all three at once. We will see if it's successful. Right now, I would have to say it doesn't look great. For example, for resolving all three of those issues. Indeed, we've seen that even though Iran's capabilities on the missile front have been diminished very considerably, the reality is they have remained effective in being able to target at least soft targets like energy infrastructure, civilian infrastructure in the Gulf countries. So I would say school is still out as to how all this will be resolved. But we certainly need to solve the uranium threat issue and the missile issue and the proxy issues for the long term. And I believe only a diplomatic approach will be able to put that in place in a stable way.
Yeah. Questions about who can conduct those diplomatic efforts on the Iranian side. Secretary Moniz, thank you for joining us and for your perspective.
Correct.
Always good to have you.
Thank you. Bye.
When we come back, how America's largest companies are working to mitigate risk from geopolitical uncertainty to some of these private credit fears. We'll hear from one of the top players in that space after the break. Welcome back. Risk mitigation now more important than ever for the CEOs of the world's largest companies, whether that's geopolitics or some of these fears in private credit. Marsh, one of the firms helping companies manage those risks, and our Contessa Brewer sat down with the CEO. Must have been a fascinating conversation.
It's one of the biggest global brokers. Their job is to help companies manage their exposure to risk. And of course, the war has just been so disruptive to, say, global travel, to oil markets, to business in and around the Middle East. Marsh's CEO, John Doyle, says his team has fielded a lot of phone calls about the impact of the ceasefire, but right now, it's still a matter of life and death.
Certainly welcome news overnight for our clients, ship owners amongst them, of course. But, at this point, it's not an insurance issue. It's obviously very early in the ceasefire. And so safety and security of crews and of course, the assets in the Gulf are the primary issue at the moment. But soon enough, hopefully, if things hold and negotiations move forward in a positive way, we'll have we'll have goods moving through the Gulf again. Yeah, one of the things that I worry a bit about is cyber risk. So we're clearly in a period of elevated cyber risk as a result of the growing geopolitical conflicts, not just in the Middle East, but in other parts of the world as well. And so we have to be very, very mindful of those risks. And I think AI will present some real opportunities for companies to play defense, but it's also going to create some opportunities, for some folks that are looking to create disruption in the world's economy.
Doyle told me all this volatility, all this uncertainty is not going away, whether from geopolitics, from climate, or AI. But there has been a shift in attitude over the past 2 years, he says. Clients no longer willing just to play defense. Marsh just released a survey from its subsidiary, Oliver Wyman, and the New York Stock Exchange today that shows 65% of CEOs see disruption now as an opportunity to play offense, which of course then provides Marsh business opportunities and its competitors to guide clients through this risk. Its shares, though, are down year to date. I'm looking at this here. It looks like they're down about 5.5%. So the question is, can you afford to sit on the sidelines and wait for things to settle down? Or is it imperative to grab the reins and start to make plans for using disruption as your opportunity for growth?
And what they're seeing from clients is
that very big companies are doing it very well. They're saying that they're deploying AI already. They're seeing returns on their investment. A lot of this has to do with efficiencies of those entry-level workers. Small companies are doing it at a greater pace, but the mid-sized companies are the ones that are sitting back and they have pilot programs, and we're going to see how this shapes up, and we're studying the issue. And it may not be in their best interest to sit back and try to game the system so much.
All right. Contessa, thank you for bringing us those comments. Sure. Anthropic saying its latest AI model could be one of the largest breakthroughs of all time in cybersecurity. But for now, the tech is too powerful to put it in the hands of the general public. We'll explain coming up. An AI model too powerful for public use? That's how Anthropic is selling its latest advanced AI model, Mythos. Kate Rooney has the story for today's Tech Check. Kate.
Hi, Sarah. So this really is unprecedented. Anthropic is going to be restricting public access to start. Its newest AI model is only available to a handful of tech partners who the company says can get what they describe as a head start on any bad actors out there with nefarious plans for ramped up versions of this technology. It's going to be called Claude Mythos Preview. So Anthropic CEO Dario Amodei says that they actually trained it to be good at code, but as a side effect, it's also good at cyber. It is rolling out to 40 companies. You've got Apple, Google, Microsoft, NVIDIA, AWS, called Project Glasswing. Anthropic says the model already has autonomously found thousands of high-severity vulnerabilities, including in every major operating system and web browser. They even cite some examples that were 30 years old, guys. So they also warn of certain vulnerabilities in corporate networks out there, healthcare systems, energy infrastructure, and then state-sponsored attacks from Iran and other adversaries. Cybersecurity stocks did take a hit on that initial report that we saw that this model was going to be coming out, but today it's actually the opposite. Some of its partners are getting a boost. You got Palo Alto Networks and CrowdStrike that are part of this initial rollout. JP Morgan, calling out those partners as beneficiaries, calls this model a significant leap forward versus prior models, says that these cyber names are, quote, essential layers in the defense stack rather than competitive targets in this effort. They describe it as AI or fighting AI with AI. The company said yesterday they have already spoken to officials across the U.S. government. They've offered to collaborate, but it does come at an extremely tense time for Anthropic, locked in this legal battle with the Pentagon over its designation as a supply chain risk by the Pentagon, guys.
Yeah, I was making the point earlier. This would be something that I would think they would want to bring to the U.S. government to decide.
Right. Well, this dual-use technology is really important for government use. As even the guest you guys had on with Contessa mentioned, there's so much upside. We talk about the possibilities in software and coding, but this is a reminder of a lot of the downside and negative potential of this technology. But that is one big open question: if the government has access, if they want access, and that head start that I mentioned of getting ahead of some of the bad actors here.
Fascinating. Not the last we'll discuss it, Kate. Thank you, Kate Rooney, as we hang on to these pretty sturdy levels here, and oil in this range between 91 and 96. We'll get GDP tomorrow, revised for Q4.
Yeah, inflation, then big CPI report on Friday.
Let's get to the judge.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. You know the story today, surging stocks on the ceasefire news. Oil's plunging, bond yields are down. We discuss what to do now with the investment committee. Joining me for the hour, Joe Terranova, Shannon Sakosha, Jason Snipe, and Stephen Weiss. Let's check the markets because we've moved back higher now. We're about 1,200 or so up on the Dow. We're better than 2.5% on the NASDAQ. The Dow, the S&P is just about there, but there's the move in crude below 95 bucks. Ed Yardeni reiterating his 7,700 target now. He says apocalypse now, not. Fundstrat's Mark Newton, he's the technician there, says, I expect the S&P to push back to new all-time highs in the months to come. Could rally to 7,300 into August. Joe, you get the first crack at this today.
Yeah, you probably will see those price levels in the interim. I think you're going to have continued elevated volatility for sure. If you look at the various exchanges today, which had been trading higher leading into yesterday, they're a little bit lower. I'll take the other side of that and suggest to all of you allocate in that direction. But I think what's important about today is a growth story. It is a momentum story. It is not a value story. It is not a broadening out story. It's not the S&P equal weight versus the S&P market cap. S&P equal weight is actually underperforming. Significant outperformance in growth today. 125 basis points. Technology, but it's semiconductors. That's where the momentum has been. Momentum has not been in software. You're not seeing a dramatic revival in performance from software itself. So I think you want to focus on that element of the story. The fact that it is a return to momentum, the fact that it is a return to growth, and then the Mag 7, I mentioned yesterday, Alphabet, made it my final trade. We finally have a Mag 7 name that is higher for 2026. It is Alphabet.
Don't you? I mean, look, almost everything is up, right?
To certain degrees, for sure.
Are the banks in your value box or no?
So
they're up a lot.
The banks
are industrials in your value box because they're up a lot.
So industrials are in the momentum box. Everything starts with momentum today. Throw up momentum. Look, I don't talk a lot about the performance of Joe T on the show. You can see where Joe T is relative to everything else today. Why? It's momentum and it's growth. Look at the momentum ETF. That's higher. So to your question, in financials, yes, financials were the momentum sector coming into 2026. All the momentum funds were allocated in that direction. So seeing the significant recovery rally that we're seeing in a lot of the banks, as you mentioned, that benefits momentum. Industrials, that's where momentum resided. Momentum was not in software coming into the month of March. So today, it's benefiting from not having that allocation. Software's underperforming.
All right, Shan, 7,700 now from Yardeni, reiterating that. Are we, I don't want to say like all clear, because there are obvious risks that still exist. No one's suggesting, hey, everything's back to complete normal, but maybe we're trending towards getting to the other side. So what do I do in that scenario?
Well, I think that our view is that looking beyond this conflict, and though it sounds naive on any given day, given the uncertainty around policy announcements and the likelihood of continued geopolitical tension in the Middle East. I mean, I think when we talk about beyond the conflict, one thing I do want to acknowledge is that there was essentially a premium in oil prices coming into this conflict, and we believe that some of that premium will remain. And so there are going to continue to be dialogue narrative around oil prices. But in terms of looking at coming into the year and going back to the fundamental opportunities that we saw, those areas that you just talked about and that Joe mentioned from a momentum perspective, areas like technology and financials and parts of the industrial sector, those were areas where we felt those valuations were vulnerable in, June, July, August of last year. Those have become more attractive, consistent and coincident with continued economic momentum. The economy in the U.S. continues to grow, and Scott, strong earnings expectations for this year. So this opportunity that's being presented is to kind of come back into potentially U.S. large caps, find some of those opportunities and invest, and perhaps take some of that capital that you may have had diversified away from technology and financials. That's an opportunity to potentially move back into some of those names as we start to see the relative attractiveness of U.S. large caps come back to the fore.
We'll get to specific positioning in a moment. Jason, 67.67 was the 50-day moving average for the S&P 500. So we're back above that now. We did get above it off the open. We dropped down below it because we've had a little volatility on some headlines about the Strait of Hormuz, but now we are back above that level again. What are you watching most of all today?
So for me, it's definitely growth. It's definitely tech. It's a lot of what Joe already said in terms of momentum and turning the page to the earnings story, right? So in earnest, we know that 12% earnings growth expected for Q1. Q2, 17% earnings growth. Q3, 19%, Q4, 18%. So we know the earnings story is relatively strong going forward. I think for me, and this is something that you have talked about a lot over the last couple of weeks, is this post-war playbook that I think is very important from a tactical perspective. So if I look at the Mag 7 multiple, the compression that we've seen over the last several weeks, I mean, the multiple is now below what staples are trading for. We know relatively, from a relative perspective, staples are always expensive, but this is an opportunity in that space, and I think that's where my eyeballs will be.
NASDAQ's ripping, obviously. We're about a 3% gain, just shy, Weiss, of that. So put everything into context in your own mind. Many of the calls out today assume now the worst is past. Risks are obviously still there. No one's naive, suggesting otherwise. Right. But the fact that if the worst is in fact in the rear view, how does that shape your investing mindset?
Very positively, and I believe it is. And yes, there will be fits and starts but Trump was clearly looking for an off-ramp. For the last couple of weeks. He got the off-ramp. I don't believe, well, there may be some bluster. I just don't believe we go back to the depths of worries that we had. So that's really an all clear. So now what we're facing is a robust earnings season up close to 15%. Guidance that should be the very least, relief and not focus on oil, focus on oil coming down. So I think it sets up very positively for the market to move higher. The question is, and Joe partially addressed this, and you know, while momentum strategy is clearly strategy, and obviously I'm a firm believer in invest in Joe T, that's not how I look at it. I'm not trying to discern, is it going to be momentum, is it going to be growth? I'm strictly bottoms-up fundamental. And what I still see, the laggards I see today, I still see Microsoft up, you know, half of what the indices are. Puzzlingly,
I got you, Palantir's red. It's not like every single stock.
Yeah, Salesforce.
Exactly.
Here,
you know, United
Netflix
Health is down a little bit, but it was up 15% or so yesterday. So I get that. Netflix hasn't moved.
Yep.
So I still think when all this goes away, whether we're up 2.5% or 3.5%, or on some stocks a lot more, it's eventually going to go back to that trite saying stock pickers market. And that's where we'll wind up.
Okay, so let's go specific positioning here. At the very least, is it time to bounce the things that ran up the most during the war, like you did today with CF?
Yesterday. It's a big
or whatever.
difference.
Yesterday, today.
Well, no, that's a big difference
I understand.
in price.
I understand. There's a huge difference in price, but the chart is making the case of why I'm even asking the question.
So the answer to your question is, and I said this yesterday, if you had hedges on against the conflict, yesterday was the time to take off the hedges, or at least reduce that positioning. And I feel even stronger about that today. What were the hedges? The hedges were areas of the energy market where you could see alternate production, whether it was Suncor or Petrobras. In fertilizer, it was CF Industries, which yesterday I sold half in the morning, I sold half when the announcement came out later in the day. The hedges are what you wanted to identify, and you wanted to reduce those yesterday, and after last evening, I think you want to take those off.
Everybody agree with that, Shannon? I mean, do you all the big energy names, let's cycle through some of them. Exxon, Chevron, you know the biggest names. They're the biggest losers on a day like today. Guys, show those if you can, please. So there's some of the names which show you exactly what I'm talking about. Go. Yeah, whatever. You can do that or show a board of. It makes the same. It makes
a longer-term chart would be helpful also on these.
Well, sure, but this is why we're asking the question.
Yeah.
If you, like you said, if Steve's right and this is kind of an all clear, which he said, do you sell these names?
I mean, number one, I think there's a lot of people that have very little exposure to these names as it is. I mean, energy is a very small part of the index, and so many people may have bought in more recently. I think, Scott, there's also, as I mentioned, we're not going back to October energy prices either, though. So it just depends on your positioning and how much you bought into this. So could there still be opportunities in areas like refiners, perhaps? Is there going to be near-term pressure on integrateds, which generally don't capture the up move and really, generally don't tend to capture as much of the down move, but still move in sentiment? I think the challenge is here, Scott, is that there is likely to continue to be volatility, and so you could be a bit more tactical in playing some of these names over the next 6 to 8 weeks. The bottom line is that there has been some supply destruction, and so if you're looking at that break-even price for oil where you feel comfortable owning an energy company, that is, you're at a point where that's probably not going to go below that in the near term. Longer term, however, there are probably better opportunities to be adding to some of these more cyclical areas, as I discussed earlier, with the acceleration of the U.S. economy.
Didn't you have exposure here, and you no longer do?
I no longer do, and I think
was it Exxon? What was it?
No, it was actually Chevron. Chevron and XLE. And I think to Shannon's point, I mean, oil, particularly for the fully integrated, I don't know if it's a complete sell it out completely. I think it's definitely offloading a significant piece of your position, particularly if you came in overweight. But to Shannon's point, I mean, it's a very small piece of the indice. But as crude come down, which is down 16%, that's obviously a proxy for the fully integrated names. For me, I would be less than market weight, which again is a small position.
Within energy, I think you want to keep your positioning with the refiners. They've run up significantly. They were already outperforming the rest of the energy sector over the last 6 months. You're still going to have challenges as it relates to diesel. You still have domestic challenges on refiners. Keep that there. If you're looking at Exxon, you're looking at Chevron, you want to moderate the positioning, where do you go? You go to the oil field services name. Stephanie and I talked about this yesterday. She maintained some of her positioning, I believe, in Schlumberger. Very smart move. We hold in the ETF, Schlumberger and Baker Hughes. We're being rewarded for that today. The flow of oil through the strait is good for the oil field services
100%.
name. If you want comprehensive exposure, you own the OIH.
Yeah, I think that's right. But I also think you can go to a Honeywell where there's exposure in oil field equipment.
100%.
Because,
Flow serve.
Look, who knows? I think it's doubtful that we all of a sudden partner with Iran and remove all sanctions. But oil, aside from the temporary disruptions, they'll be cured. Then I think oil takes another leg down. But for the oil service stocks, for the oil equipment providers, I think that's particularly very fertile ground.
If some of these names, like the oil ones, if they become a source of funds, in like they're obviously today in some respects, where's that money going to flow to growth?
I see it going to growth. Yes, I see it growing to growth. I see it going to semiconductors. I see it going back into the AI infrastructure story, because that's where you get the reliable growth. Like, the earnings season's coming up, and where am I going to find and where have I been rewarded for investing into the growth? 100%. And it's the AI infrastructure story. That's where the industrials, and it's a lot of semis.
Shannon doesn't agree with you. I know it. I can tell by the way. I can tell by the way she was listening, and not exactly a full-blown facial expression. However, there was enough vibe being given off because I think you still believe in the big broadening trade that we had that worked real well off the beginning of the year.
I believe there's still more room to run there. Where I would agree with Joe, though.
Go to disagree first.
Okay. Where I would disagree.
Go Red Sox.
I set you up. Don't give me the agree. I want the disagree.
I think that there are still a lot of places that are very reasonably valued, and cyclicality. You look at manufacturing numbers. You look at the continued resilience of the consumer. There is still a lot of opportunity in this broadening out trade that hasn't been fully captured in the last 3 years of trailing returns. And yes, could we see a bounce? But there's also, if you think about technology in terms of the Mag 7 or the Mega 8 or whatever you want to call it, there's still a lot of dispersion there. And so I feel like you have to be selective and prescriptive within that universe. And so for me, it's not a kind of a full-blown momentum move back into all of technology. And again, not semis versus software, but even within those large cap tech companies, I think that there still is dispersion ahead.
Let's talk about one of those large cap tech companies right now. Throw up Meta. Intraday, stock's ripping. It's up right now 6%. I think I see it. They debut the story just moving. Bloomberg's got a story that Meta debuts its first AI model from its prize superintelligence group. That story just hit a few minutes ago. Look, say it again. Oh, good. Okay, Julia Borson has this news actually for us. Julia, what do we know here? Because it's obviously moving the stock.
Yes, we have the news, Scott. Meta launching its long-awaited new AI model called Muse Spark. This was originally codenamed Avocado. It's launching on the Meta AI app and website today, rolling out to its other apps and AI glasses in coming weeks. Now, Meta says Muse Spark is its most powerful model yet, but instead of launching with a massive, sophisticated model to compete with the likes of ChatGPT or Gemini, which many expected given Meta's spending, this is a more limited release as Meta's Superintelligence Lab's chief Alex Wang slowly rolls out his work. Now, Muse Spark seems initially focused on custom uses for Meta's apps with a special mode for shopping, surfacing ideas from creators that users already follow, and visual coding tools to create websites or mini games to play with friends. Now, Muse Spark is the product of Wang's 9 months of building Meta's Superintelligence Labs, along with hundreds of billions of dollars of investment in AI infrastructure following the disappointment of Meta's prior AI models. Now, Meta seems to be trying to lower expectations and address potential criticism given Meta's AI spending, saying that this is only the start and we have larger models in development, including a more sophisticated contemplating mode, which Meta says is competitive with frontier models such as Gemini DeepThink and GPT Pro. That model, they say, will roll out later. Notably, Meta is also opening the door to a new AI revenue stream, saying it plans to eventually offer paid access to this model's API like Anthropic's Claude and Google's Gemini do. Meta shares now up about 6.5%. Scott?
Yeah, they are ripping on this news. Julia, thank you so much for that. It's Julia Borsten. Steve Weiss, you own the name.
Yeah, and then now it's back to my largest position given the performance today. Look, you're going to see more of this, not just from Meta, but just see from others, as they now get a return on the investment, the major investment they made in AI. And what this does is it creates or it strengthens the moat around them, and then gives them more products for advertising, for subscription fees. So you're seeing the transformation real time today, and I believe it's going to continue. I do not believe that Meta, given their market leading position in their area, is inexpensive here. And if I didn't have such a full position, I don't know that I'd buy it today, but I would definitely add to it.
I mean, Amazon and Alphabet are also up better than 3.5%. Amazon's target to 260 at Cantor. Alphabet, top pick also at Cantor. Jay, stocks are just, I mean, I understand everything's up, but you get a sense that investors are dying to ride these things again.
100%.
And maybe they want to do it before earnings season really gets hot and heavy for these names.
Right, 100%. And I mean, you know, we were talking about earnings earlier. I mean, 45% year-over-year growth for tech. Right? These are significant numbers. And as it relates to Amazon, in my opinion, I mean, this is a name, again, retail has held in. There's been resiliency in the consumer. AWS has re-accelerated 20+% north growth rate. Operation margins are coming back online in a very meaningful way. So I like that name, and especially with the multiple coming in with all of them, but Amazon in particular, I like that one.
Speaking of multiples coming in, they had come in to a reasonable degree in cyber. Some of those names, certainly year to date, if you want to cycle through some of the charts. So you got the big Anthropic news today, Project Glasswing with CrowdStrike and Palo Alto as key partners. The narrative around cyber hasn't been great, and that AI is going to displace a lot of this and make it easier for, you know, smaller companies to develop sort of their own systems using artificial intelligence. So this is a big deal that's been moving some of these names. Can we show, guys, some of the names today off of that? And show that. Jason, you bought more Palo Alto. Can we show Palo Alto, please?
I did.
Thank you.
And guess what? Obviously, this Project Glasswing story is a huge catalyst for the entire group. But a lot of the names obviously been falling in this kind of software slide. But for me, aside from the Project Glasswing news, which I think is a major catalyst and very important to mention, you know, they've been in acquisition mode for several quarters, right? Koi, Chronosphere, CyberArk, they spent almost $30 billion. And then you heard from Aurora just a couple weeks ago in terms of him making a capital investment of $10 million and buying some of the shares. So he's clearly showing his interest and obviously his confidence in the position going forward. But the other point I want to make is this kind of harmonious story that I think is possible with software and AI, and that's what we're seeing with this Project Glasswing story.
Okay, the other group that's up a lot, Joe was talking about the chips. The chip equipment names are up a bunch. Lam, Applied, Marvell, KLA, take your pick. They're all running. You own most, if not all, of these. This is on some war relief specifically too, right?
Absolutely, yes. And it's also some of the optical names like GLW. It's the memory names as well. But remember, again, that's where the momentum resided. Jay, respectfully, Palo Alto, CrowdStrike, I'd love to get back into these names. I look at these names today, Palo Alto, I'm somewhat disappointed. It's only up 1.3%, trading at the bottom of the range. So what Scott's identifying with those industries, that's where the momentum was embedded. And when that momentum kind of maintains itself like it has, you see investors quickly make a dash and return to memory, to optical, and to the semi-equipment names.
Guys,
It'll
get there. Something?
No, I was just going to say it's going to get there. I hear exactly what you're saying, but again, when I hear about this tool that Anthropic has obviously developed, and I just see that story. There's more fire to that story, and I think that will continue.
All right, let's do this. Let's just take a break. Let's do that. We got the markets rip. We'll come back. We got more committee moves ahead to tell you about. Jason and Steve are selling out of a couple of trades that they had, and we have our calls of the day ahead as well. at another committee move we have for you today. Weiss, you sold FTAI. You're out of that completely now?
I'm out of it completely, and I didn't sell it today. I sold it yesterday, and the reason why I did it is I have so much beta in my portfolio with the other names. The stock has not been acting well, not recovering well, obviously today aside. So it was a relatively small position, and I didn't want to hedge and go short the market because I thought this would sort of happen, didn't have enough conviction, obviously, to have a lot of exposure that it would happen. So there was sort of a hedge in taking off a highly volatile beta-like position.
Okay.
Obviously, it's a mistake, but that's what hedging and
Well, I mean, it's
about.
hard to time anything.
It was the right move at that time.
Okay. General Dynamics today cut to a hold from buy at Deutsche, target to 387 from 404. Valuations challenged, they say, and they say that the growth advantage to their peers is, quote, likely to shrink over time. Joe T, what do you think?
We established a position in this name back in October. If we could broaden out that chart and show a year to date, what's interesting about it is General Dynamics actually peaked in January. You would think, Scott, that with the conflict in the Middle East, a lot of these defense stocks would rally. That's the opposite of what has happened. So there has to be a coordinated global effort to increase defense spending. Yes, we know here in the U.S. we are going to increase that spending. Logically, you would seem to think that the fundamentals would align themselves with the defense names actually moving higher, but in fact, they are not. We're still maintaining the position. Technically, it looks good. You're getting 10% revenue growth, but you're going to have to see a coordinated increase in defense spending to get the stocks going.
All right. GE Vernova, target to $1,008 from $923 at Baird, outperform Weiss. You have that name.
Look, I mean, I hope it gets there. I own this. It's a mid-sized position. It's been very good to me, but I still believe it's overvalued. But I'm riding this, particularly having got rid of FTAI, which is in a related business, power for data centers. This one more advanced, more shots on goal. But I'm sticking with it for now.
Okay, Eaton, target to 439 from 407 at RBC. Jason Snipe.
It's been a great stock all year, right? That's up 21%. I mean, it sits in this place of these mega trends, energy transition, digitization. Quarter over quarter, data center orders are actually up 200%. So I continue to like this name. I was kind of on the value play early part of the year, but I think that story continues to run.
Travelers, 331 from 312 at Barclays. You have this one, right?
Yep, and I would imagine we'll maintain the positioning, and I think those that are allocated towards specifically insurers and property and casualty should do the same. The comps for catastrophic losses in the upcoming earnings report are going to look really good.
Okay, got some calls on Staples today. Piper has cut the price target on Colgate-Palmolive. That's number one. It was 96, now it's 92. Wells Fargo has cut the target to 92 from 100. Goldman cuts the target to 98 from 100 just by a couple bucks. You have the stock.
Yeah, I mean, volume pressures, raw material costs, I think is part of the story there. I think the focus for me is they continue to focus on the analytics, online sales, efficiency on supply chain. So I think it's up 7% year to date. So it's obviously outperformed in the tough tape. So I continue to like this one for some of the productive reasons in terms of what's going on with analytics.
They also lowered the price target on Procter, which you have as well.
Yeah, so that stock hasn't performed nearly as well. It's roughly flat for the year. I think they're really focusing on product innovation, product improvements, and better advertising. I think that's the story for them. But again, when there's 1 to 3% in organic growth, it's always a tough tape when it's trading at 20 plus times forward earnings. So I think this is always a tough one when kind of the narrative is starting to shift.
Staples are up more than 7% year to date. We think they're too expensive? Or no?
Probably in an environment where we're expecting kind of a recovery in the equity market and less defense, more offense. They're probably overspending for that. And we still have inflationary impacts. Those aren't going to go away overnight.
You're not worried about that?
No, I definitely am.
Like if Joe's right with his general market view, isn't that just an absolute negative for Staples names?
It is, but I believe in the efficiencies of, the objectives of it and the focus on efficiencies for these stories. I think they can manage through.
Okay, Christina Partsenevelos has a CNBC News update for us. Hi there.
Hi, Scott.
Cassidy Hutchinson, the former White House aide and star witness at the January 6th hearings, is reportedly being investigated by the Justice Department's Civil Rights Division. That's according to the New York Times, which says the probe actually began a few weeks ago when the DOJ received a referral from a Trump ally who accused Hutchinson of lying during her testimony. The DOJ's Civil Rights Unit usually focuses on abuses such as police misconduct as well as racial discrimination. Democratic-backed candidate Chris Taylor won a seat on the Wisconsin Supreme Court yesterday, growing the liberal majority of the court. Taylor is a former Democratic state legislator and focused her campaign on abortion rights. Her win ensures a 10-year term, and it's the fourth straight victory for liberal court candidates in Wisconsin, dating back to 2020. And Greece's prime minister said the country will ban social media for kids under 15 years old starting in January 2027. The Greek government has already outlawed mobile phones in schools and set up parental control platforms to limit teen screen time. Greece's parliament will legislate the ban in mid-2026. Scott.
All right. Christina, thanks. Christina Partsinevelos. Coming up, Jason just made a big move in a stock that had its best day since August. We'll tell you what it is next.
As America celebrates its 250th anniversary, CNBC spotlights the companies that rose with the nation and continue to shape its future.
I'm Craigie Zildjian, owner and president of the Avida Zildjian Company, a manufacturer of musical instruments. The company was originally started in 1623 in Istanbul by Avida Zildjian I. Avidas was an alchemist, and what he created was a unique alloy that produced beautiful, clear-sounding cymbals. Then in 1929, my grandfather, Avidas III, relocated the company here in America. We've been proudly made in America ever since. America is the largest market for musical instruments, and the birth of jazz in America provided an opportunity. Being in America gave us access to these artists. They could come into the factory and we could make new sounds together. My grandfather was unstoppable. His resilience and deep passion led us through the Depression and World War II, where we had the War Production Board putting metal on allocation. When Ringo Starr and the Beatles performed on the Ed Sullivan Show in the 1960s, overnight everyone wanted to be a drummer. That created a back order of about 90,000 cymbals. It made Zildjian the symbol of choice for rock and roll drummers. Being a multi-generational company, we're focused on stewardship and the legacy of the brand. What makes a family business overall so successful is the long-term perspective that is unique to private companies. I think it's exciting to see that next generation of Zildjian family members learning the business and carrying on the core family values that have been passed down for generations. We're excited to see where the music takes us.
we have another move to tell you about, and it is United Health, which Jason Snipe has now sold completely.
Completely.
Yesterday.
Completely, yesterday.
Why?
So obviously we got some good news on from the CMS on reimbursement rates, which at 2.5%, and in January, basically that number was flat. So the stock is up almost 13% in the last 5 days. But for me, I don't think that's enough in the short run. Elevated medical cost trends are going to still be very challenging going forward. Hemsley is a known commodity. I love him as a CEO, and I think he'll ride the ship. But I think in the next 6 to 9 months, this is dead money for me. I know there was a story early on where a lot of people got to the exits early. I wasn't one of them, so I decided to get out now.
What do you think?
Disagree.
Tell me more.
Wow.
Very
confrontational today.
I am.
I love it.
So it's hard to argue. You know, you go from 0% to 2.5% when medical costs are probably running at twice that, 2x that, if not more. But the reality is that this is a supportive sign for the government in terms of being more realistic in terms of Medicare Advantage reimbursement rates. The other thing is that there is likelihood for UNH to continue to expand margins. They're getting a handle on MLRs, medical loss ratios. This is not just a UNH story, this is a managed care story. And so our view is that we're constructive on managed care, and we believe that there is room to run. This is just another kind of notch in terms of support from the government for that view.
I just think it's going to take a
Mr. Snipe,
right. I just think it's going to take a lot more time for them to kind of get running. I do, to your point, and I think that's the most salient point. Reimbursement rates, medical cost trends double what the reimbursement rates are, and I think it's just going to take too much time to catch up.
Weiss, don't you still have UNH?
I still have UNH, and it is going to be a tough year. Okay, there's no doubt about it. You still have V28 coming in, which changes their coding and things like that. But nonetheless, they are spending $1.5 billion on AI for enhancements on the cost structure, which I think will be very, very helpful. They still are the biggest. Hemsley got them to a record stock price before. He's back fully engaged. So I'm riding it out. You know, could it fall back? Yeah, it's got a history of being very volatile, but I like it. You know, bottom line.
Okay.
And I'm speaking with my feet. It's in the portfolio.
Okay, let's go some healthcare calls. Merck target goes to 150 today at Wolf. It was 142. Joe, you have that, right?
Yeah, that would make it an all-time high, and I do think it could get to that price point sooner rather than later. We're pressing up against the high for the year at around 125. I think the 1 year, going back 2 year high rather, is 134. They're diversifying the model. They understand the patent expiration as it relates to Keytruda, which is literally 50% of their overall sales. They're diversifying. They made a recent acquisition. Now they're in the leukemia treatment. So the company is doing the right things, anticipating that patent expiration.
Okay, what about Amgen, which Truist took to 325 from 319? They have a hold on it. They're only looking for a modest revenue beat for the quarter. So what do you think about that?
So the market, when it does go and search for growth, as I believe it is right now, it goes to biotech in the healthcare sector. And large cap biotech in particular, Amgen is a clear leader in that regard. I think that price target is somewhat low. I think you should, I would increase that. I think the stock is, if you pull that back over the last 1 year, you could see that it is breaking out, and they are delivering in terms of revenue and strengthening the balance sheet.
That would be good for your IBB, right?
Without a doubt. And I think, you know, the other part of the story is patent cliffs are obviously coming off the boil, and I think that's going to be continued. Now, rates have risen recently, but I think that's also going to be a catalyst for IBB going forward.
What about AbbVie, which got the target cut by $10, 240 from 250 at Cantor?
Yeah, and it's down modestly for the year, and I think the story has really been this new J&J/Protagonist drug that is competing directly with Skyrizi, one of my favorite drugs, right? But I think that's really this overhang on the stock currently.
Okay, Santoli and his midday word on this very big day in the market is next.
Every core computers now have primary control of critical vehicle functions.
Our senior markets commentator and overtime co-anchor Michael Santoli joins us now with his midday word. Does this have enough going right for it that it's believable, or do we need to see something else in your mind to go along with it? What do you think?
I think it's got a little bit to prove. I would say, first of all, it's believable in the sense that it's all quite rational to get up, 2.5%. You're slicing off, I think, some of the sort of more outsized risk scenarios you might have been facing 24 hours ago. And so the market's going to kind of go station to station to its next test. If you're kind of looking tactically at a lot of the metrics you'd want to see if this was going to be a real momentum stampede to the upside, not quite making the grade on that. It's like 75% upside volume in the New York Stock Exchange. The rally has kind of halted exactly where you might have expected it would take a pause. It sort of went up, to the 50-day moving average, just sat there for most of the day. So I do think all that is sensible, but it's not something that tells us that you're achieving escape velocity today. And maybe that makes sense, right? You have oil's off the lows of the morning. Yields are also off the lows of the morning. So it feels as if it's wait and see. I think you can assume a tactical low is in from a couple of weeks ago. And now it's a matter of trying to prove it, and also to decide if, in fact, it was all Iran and oil in the first place, and whether we've kind of dealt with the other issues that we were contending with since October, frankly.
For those who don't follow it quite as closely, when you say 70% upside day is not exactly what you would really love to see, it's more like 90 or so.
90
and can you
is,
tell people why that's important?
Yeah, I mean,
beyond the obvious.
Sure. No, 90% of volume 2 in advancing stocks is historically correlated with one of these real buying frenzies that tends to insulate the market, along with some other measures. Now, if this is a thing called a breadth thrust, which did fire shortly after the low in April of 2025. And what that really means is, historically, it's insulated the market from significant downside over the next few months. It basically gives you a 6 to 9 month, 12-month runway to say you're almost always higher over that span. And we're somewhat shy of that. And by the way, that sort of makes sense because we weren't coming from as deep a hole and we weren't as washed out. You didn't get as oversold as you often do in these really deep correction. So I think it makes sense that we didn't necessarily have quite as much fuel. I mean, you have plenty of negative sentiment and oversold conditions to burn off and go higher from here, but it's just not quite as tightly wound as you sometimes are.
All right, great insight. I love you dropping that knowledge on us and our viewers. Michael, thank you. I'll see you later. Mike Santoli. Delta shares flying higher today along with the travel trade. No big shock, but we did have Delta earnings. Joe's in it. He'll tell you what to do next. All right, Delta shares are popping today. You see 6%, no big surprise. A lot of the travel names are, obviously. But this company did have earnings. You own the stock. So what's your read through on this? Just obviously the news of the moment, but plus the earnings, plus still cautious commentary related to energy prices and the drag that it's going to be on these companies.
And there should be. I still think you should have a cautious outlook as it relates to all travel names. I think this is an idiosyncratic story. This is about premium and pricing power in the front of the plane. And really what Delta has done, which I believe every airline should be pursuing, is the 2012 acquisition of a refinery in Philadelphia, which basically cost them less than $250 million. It was $150 million in a purchase price from Phillips 66. The state gave them back $30 million. They invested $100 million in it. And if you look going forward, Ed Bastian told you today that they're going to see probably about a $400 million fuel cost savings in the second quarter from that. That does not mean they're not going to have a higher fuel cost in front of them. He guided to billion as we approach through the end of June. So that's still there. I think it's idiosyncratic with Delta. As you said, I think you still have to be cautious on travel. I don't think you have the all clear there.
I mean, cruises are up a bunch today, casinos.
Relief rally.
Yeah, of course.
Yeah, more than anything else.
Potentially has legs, though. I mean, if there's reason to have such strong relief.
Well,
that's part of the point.
Royal Caribbean has been a really strong name. It's a momentum name, so it's participating in that momentum story and rebound that we're seeing today. Again, Royal Caribbean's idiosyncratic. I don't think you could have this universal assumption that all travel is going to be good.
Okay. We're back right after this. Show Robinhood for us, guys, because the stock's up 10%, or at least it was. Now it's up 5%. But you get the idea. Big pop in that name today. Relief rally for certain. Robinhood, the retail investor engagement, got to be good. Bitcoin's bounce, got to be good, right? Bitcoin's been up a bunch today, too, so that one's up. Just wanted to show you that. And let's talk about gold for a second as well today, because the gold trade is working today, too, up 2%. The miners are getting a lift. Weiss, you own the GLD. What do we do for a trade that's been kind of volatile of late?
It has. I personally think you hold gold, and there's a place in it for the portfolio. I didn't always think that, and I'm not always going to think that either. But right now, I think it's going to move back up to where the highs were. You've shaken out a lot of the tourists, and it'll gain some traction.
Now you're a believer in gold. I think you said you
for the moment.
No intrinsic value. You couldn't value.
No,
Bitcoin. You couldn't value
Bitcoin
it.
has no intrinsic
But you
value.
said in gold for a long time you couldn't value it.
Gold is.
That's why you said you haven't always been a believer.
No, I haven't. And gold is difficult to value because, like oil, it's difficult to value. There's a lot of speculators and traders, commodity traders in it. But nonetheless, I think it regains its footing and moves higher.
It's risk on. It is at the end of March.
Gold's risk on?
I think gold is risk on now. The end of March, I bought the GLD at 404. That's for a trade. It's not for some strong fundamental belief on monetary policy or any of that stuff.
Let me know when you get out before you get out.
Why is that, Steve? You want to lose
I want
money?
to be able to sell first, maybe.
we'll do finals next. All right, 3 o'clock today, closing bell. It's going to be an active final hour of trade with Tom Lee, Mina Flynn, Jeff DeGraff, Mark Okada, and Sonali Basak. And I hope you'll join me then. See what this market does over that last hour of trade. Mr. Weiss, final trade to you.
Leidos, it's lagging in terms of performance today. It's up less than 1%. There is a slight software overhang here, but I think they'll be able to overcome it because they are an AI leader in the space.
Okay, who's got Goldman?
Goldman, that's me. Goldman Sachs reports on Monday. I think capital markets revenue will continue to surge.
Shan.
Consumer discretionary, not all of the tax refund increase will be cannibalized by higher energy prices.
All right, you talked about GLW, right?
Benefits from the relationship with Meta, building out AI infrastructure.
Meta's ripping too. I'll see you at 3.
Thank you very much, Scott. Stocks are still surging this hour as the U.S.-Iran ceasefire has sent oil prices tumbling. Welcome to the exchange. I'm Kelly Evans. And the Dow's up 1,200 points this hour. 2.5% gain for the S&P, better than 3% for the NASDAQ and Russell. We're still near session highs, matter of fact. This all comes as crude oil is having its worst day in 6 years with a 16% plunge now, 94 and change. That's low compared to the levels we were used to over the past week or so. And yields, the same story, the 10-year back below 4.3%, and we'll get an auction result in just a few moments. In terms of the stocks, the semis and the memory names are among the outperformers today, as is the travel trade, the global jets ETF, up 7%. When the market opened, we saw some of those names, the oil, the airline names, the travel names like Carnival Cruise were up 15%. But let's begin with the latest developments out of the Middle East. With the ceasefire between the U.S. and Iran in place, but attacks continuing in the region. Iranian media reporting that all passage through the strait has been halted once again after Israel struck Lebanon. We also heard of an attack near Saudi Arabia's east-west oil pipeline. And my next guest says we shouldn't expect a quick return to normal for oil prices. Let's bring in Amrita Sen. She's Director of Market Intelligence at Energy Aspects. Amrita, welcome to you. Just to remind people, before this conflict broke out, you were much more bearish on oil prices. I just want to remind everyone of that, because it's not as if you've been out here pounding the table saying oil prices are always going higher. It sounds like, though, this is leaving some lasting impact on the market. What do you think happens next?
Oh, absolutely. And I'm glad you raised that. Look, we've been talking about, oil prices averaging, in the low 60s prior to the conflict for the year, because we were expecting stocks to build. And now we weren't nearly in the same bearish camp as some of the others who were calling for 4 or 5 million barrels per day of builds. We were more in the 1.5 to 2. But these are sizable builds, right? This was not going to be a market, sure, not going to $30 or $40, but still $60 is a low price. But now what we're looking at is a market where we have lost sustainable volumes of supply. We are currently, we've just redone our numbers with all the latest production numbers coming through, 13 million barrels per day of shut-in production.
13?
Which is a huge number, right? And 1.3, yeah.
Okay.
And that number has kind of gone up week on week, because some of the numbers we're getting through from the countries just show a larger shut-in production, partly because, they just precautionary shut in some of these volumes. We are looking at storage data from, Kairos, and you can see tanks are not full. So it's not that any of this volume via exports or production will be able to come to the market overnight. It is going to be a very slow process. And like you say, quote unquote ceasefire, extremely fragile, if that, because attacks have continued all the way through today.
What do you make of, how would you describe they or us or both are now taking a toll on the passage of ships through that waterway?
Yeah, I wish it was that simple, right? I think the challenge we have right now is we've counted about 250 odd vessels that are within the strait. Let's say that's able to get out. The vessels that are needing to come in, there's two issues with that. One, shippers are charging $40 per barrel, 40, as a charge to get in there. Iranians are saying, well, you can't come in without our permission. We've also heard the Iranians are asking for a fee, and imagine paying the Iranians, given a lot of this is sanctioned entities, so you have to go via Chinese or the Hong Kong entities that they've created. And the bigger issue is, because of the straits being closed, most of the vessels are now in or pointing towards the US or in Europe, Atlantic Basin, taking oil from the US to Asia. So for the ships to even go back to the Middle East will be at least June, right? So it's a complete mess. And this is why I'm not surprised the market sold off, because that's a headline move. But the physical crude market is trading anywhere between $40 to $60 higher than where the price that you and I are looking at. And I think that's the reality on the ground.
And I wanted to show the futures prices so we can look out to kind of the summer and fall months, where these were, as you said, a month ago, these prices were 60. Even when the war first broke out, maybe they were creeping up towards the 70s, 80s. What's the level, Amrita, that you think we're likely to settle at based on everything that you described?
I think, look, we might still get a little bit of a drift lower, because when you have these sell-offs, just on a technical basis, is never over in a day. And people were quite long. There was a lot of positioning around this. But I think once this is over, as in by over, I mean that once the dust settles, people realize the ceasefire actually doesn't mean we're going to get a material flow of oil out of the Hormuz. We think prices will go back up again, especially because unless we reverse the 13 million barrels per day of shut-ins, we are losing that much volume just on crude, let alone of products, every single day. And that means you just need higher and higher prices ultimately to balance the market through demand curves.
So you think we're going to be higher in a couple of weeks or a month than where we are now?
Yes, I do believe that, even if we first go lower. The other thing I'd say is that the higher prices is probably more important on the product side. So it's gasoline, it's diesel. Diesel's already trading above $200 per barrel. Jet fuel is as well. That's where ultimately the price impact needs to be, because that's where demand needs to come off. So yes, you could still have this situation where crude prices, call it $120 on the screen. Physical crude is another $60 above that. But then it's products prices, what you and I consume, is where the real pain is.
And quickly, when we talk about the price on the screen versus the physical price, is that because one is ultimately going to translate to the other? In other words, who's paying the 120 or the, let's call it 90 something you're seeing today? And is that going to creep higher or not? Is that more of a financial market price?
Yeah, I mean, look, historically, we've never had this divergence, and it's a real head scratcher, right? Usually the physical market is what drives the futures price, and, roughly they converge. But I think what's going on right now is the curve is so backwardated, and futures is a different beast, right? Different speculators, hedge funds are trading this. Ultimately, the people who are buying the crude, which is refiners, they are having to pay that top dollar. Like we heard today, a West African cargo landed in Asia at $170 per barrel.
Wow.
Imagine then you refine that, then your products prices is even higher. So what you and I pay on the products price is reflecting the physical crude price, but the futures market is it's more of a financial price mechanism rather than what's really impacting the world economy.
Then finally, as we look at the national average today at the pump, it's $4.16, so it continues to creep higher even as the oil price falls. Is it possible that gasoline prices in this country could still go higher even as we've seen this 15% reset per barrel?
Yes, and look, I think that's absolutely our view that, again, short term it might come off a little bit, but ultimately the products shortage that we're talking about because of refineries can't getting oil in Asia or refineries in the Middle East being stuck and can't get their products out, we are looking at well over 300 million barrels of product losses across gasoline, diesel, and jet. That will take probably 2 years to recover in terms of just the supplies unless demand comes off sharply. And there's only one way demand can come off, much, much higher prices. So I wouldn't be surprised, let's say May or June, we see $5 plus gasoline prices in the U.S.
Wow. I mean, that's fascinating. If that's, like I said, Amrita, you know this better than anyone. So really appreciate it today to help us understand what might and might not come to pass as a result, of what we've seen. Amrita Sen with Energy Aspects. We just had a 10-year note auction. Let's bring in Rick Santelli for those results. Rick, a beneficial day, I guess we could say, for it to happen.
Yeah, yields are down a little bit. They're really not down all that much. What's significant is where they're down from. We'll get to that in a minute. This was a $39 billion auction of 9-year, 10-month securities. Originally, they were auctioned off in the first couple of weeks of February. So this is a reopening. The yield for these $39 billion, 4.282, which was a smidge higher than the when issued market. So only a very small tail. All the metrics were pretty close to 10 auction average. My grade, a straight C as in Charlie. There was nothing really special about the auction. I thought it would go a little bit better just for the headlines that you were thinking of when you threw to me. But when you look at a 377 in a 2-year, that's down, 2 basis points. Right now we're at 428 in a 10-year. That's only down 1 basis point. What's significant is it's the first close yesterday, barely below 430 in the 10. Yesterday, the first close below 380 in a 2-year. That is technically significant, and potentially we might be able to build on that. But really, if you look at the entire month to date, considering all the volatility in both directions, Treasuries have been rather calm, all things considered. Tomorrow's the last leg of this trifecta of offerings from the U.S. Treasury with $22 billion, 29-year, 10-month, or 30-year bond securities. Kelly, back to you.
They've been incredibly calm, Rick. If I just saw the numbers on paper, especially after what we've seen for requests for the Pentagon, that's up 40%. Medicare reimbursement rates are up. It's, interest. I'm surprised that the Treasury market is taking all this as well as it is. I don't really know what's going to happen, with the payments through the Strait, if they're going to continue to try to, de-dollarize, and how that might affect kind of future global demand for Treasuries. But everywhere you turn,
everything's so complicated.
It just
so
seems like there's fewer buyers in the market.
Just think about smart money in the Middle East. Smart money in the Middle East is definitely not making crude oil go much above 95. I think out of all the sources and all the guests, I still think crude oil has given us the most honest opinion of what's going on. Unlike our last guest, I really doubt if the gasoline markets or the crude oil markets are going to be higher than they are right now in 2 weeks. I don't think they're going to go back to where they were super quickly. but ultimately I think it is going to go back more quickly than many experts think. You want to know why? Because producers are pretty clever. There's a lot of different workarounds that are being discussed in a variety of publications and websites, and I put some stock in that. And I think that the notion of the limited life of its current condition for the Straits of Hormuz, I think that's a huge story.
I know, but is the deficit a huge story or no?
Oh, the deficit's going to continue to be. And you know how I feel about that. So when you said you're amazed, when I look at a chart of the entire Treasury complex going back to last summer and seeing yields higher last summer, you're right. When I look at the one-year chart, there's no way I could ever look at that and say, oh my goodness, we have a Middle East war going on there. It just doesn't show up. But debt and deficits, listen, this administration has policies I agree with in many ways, but I do think we're not making much progress in lowering some of that red ink.
Right, exactly. And that's what I meant, that the market's so calm in the face of that. It's just interesting. Rick, for now,
well,
thanks.
You know, it's going to be a two-parter, Kelly. It's going to be a two-parter. I think the good news here gives us a bit of a rally potentially, but ultimately it's going to be back to business. And I'll say this for the 9,000th time. We're not going to spend much time under 4% in a 10-year due to debt and deficits, and I still think closer to 5% is a possibility for 2026.
Yeah, it feels right. You know more about it than I do, but I appreciate the extra color. Rick, thanks. Rick Santelli.
Thank you.
And our next guest just lowered his year-end price target on the S&P to 7,500 from 7,700 prior to the Iran war. That's still a solid rally from here, though. Let's bring in David Lefkowitz. He's head of U.S. equities at UBS Global Wealth Management. This, I believe, was yesterday, David. What are you pricing in for the slight downgrade, and then why do you think we might still, be able to come out of this somewhat unscathed?
Yeah, thanks, Kelly. So, in our base case, we still think that eventually we're going to be on the de-escalation path, and obviously we got some news last night that bolsters our confidence in that path. And then ultimately, we will see energy flows through the Strait of Hormuz. It's going to take some time. A lot of the ships have to get into the right place. The oil fields need to get repressurized and things like that. But we do think that we will see the energy flows resume. And I think the market's going to start to anticipate some normalization. That also is going to take some time. But, ultimately, I think oil prices will be a little bit lower. And the economy can sort of weather through this, especially with some fiscal stimulus that's helping. And therefore, stocks can move higher as earnings move higher. So we still think earnings will grow, double digits this year. 11% is our number. And given that everybody is de-risked at this point, if the conflict de-escalates, which we think it will, that's sort of the dry powder to propel us higher.
There's the dip on the screen there. We are showing what's been the trading pattern since the Iran war began. We're only down 1% since that, matter of fact. And there's this brief dip about better than a week ago, because last week we had the 3% rally. So when we ask, is the bottom in? Well, the bottom might have already been in, about 10 days ago.
Yeah, look, I mean, there's no way around this. It really comes down to what is the oil price? I mean, that has been what the market has been laser focused on. And so, our view, it's not going to be a straight line. I mean, this is probably not the last story here in the last chapter, but we do think oil prices will be lower over time. And that's going to pave the way for stocks to continue to move higher. Again, not in a straight line, though.
Tech leading today. Small caps are showing some life. They're more economically sensitive. I have to imagine that's why. Any thoughts there on market leadership?
Yeah, I mean, I think, not surprising to see the areas that have been sort of most beaten up are getting the biggest bounce today. That's pretty common and not surprising. I think it'd be helpful as we're thinking about what the world looks like over the next, say, 6 to 12 months. I think oil prices will be higher. I think there's going to be greater focus on energy security, resource security, and we still have the AI build out that's going on. So that leads us to a lot of some of the industrial areas. We have a list of stocks that's aligned to that. We call it power and resources. I think that's going to be a lot of the focus in terms of market participants going forward. So that's definitely an area that I would focus on.
Sure, and then I guess it would just be a question of whether the consumer the reason we keep mentioning the AAA fuel price is because even as for us, the price of oil is down 15%. People today are paying still the most they've been paying in recent months for fuel. And I don't know at some point if that's going to actually bite the consumer more than we realize, or if these levels are still relatively low by historical standards. They were $5, as we remember, during the post-COVID era just a couple of years ago.
Yeah, Kelly, I think that's a great point. I think, look, if we did see gasoline prices sustainably above $5, I do think that changes the complexion a little bit of consumer spending. But, around $4, I think it's digestible, especially given that we have the additional fiscal stimulus coming in with the higher refunds and things like that. And we still have this K-shaped economy, right? So the higher end consumer is less insulated, or more insulated, I should say, from gasoline prices. And as long as the stock market is doing well, I think you're going to see, middle and higher income consumers are still going to be spending. So I think the $5 level is an important marker in our mind.
All right, and we're well below that for now. David, thanks very much. Appreciate it.
Thank you.
David Lefkowitz of UBS. Coming up, Asian markets are ripping higher following the 2-week truce with Iran. Again, they're a big user of fuel from the Strait region. My next guest says these moves don't come along often in one's career, but are they overdone or overdue? We'll talk about that next. Plus, the ceasefire putting a Fed rate cut back on the table. But our guests are divided on whether the market is getting that one wrong. That debate ahead on The Exchange.
This is The Exchange on CNBC.
Asian markets are surging on the 2-week ceasefire between the U.S. and Iran. India up nearly 4%. South Korea's Kospi surging almost 7%. The Nikkei up close to 6%. China up 4% as well. The Strait of Hormuz, a vital artery for energy delivery for all of those nations. But with reports now of $2 million tolls per passage if the strait reopens, are these rallies premature? Let's bring in Brendan Ahern. He's the Chief Investment Officer over at Crane Shares. Brendan, it's good to see you, and just kind of walk us through this step by step here. A region that we saw suffering as the Iran war went on is now snapping back quite sharply.
Yeah, 100%, Kelly. In general, Asia is highly dependent upon Middle East oil and natural gas. In the case of, say, Japan and the Philippines, they're virtually completely dependent on oil coming out of the Strait of Hormuz. You then have Korea, Taiwan, and Malaysia, about 2/3 dependent. China's about, call it 50%. So just in general, the Asia region was highly dependent and is obviously cheering the truce that we've seen put in place for the next 2 weeks.
Right. That said, it makes sense to kind of ask the question of, is it premature? But as you also know, more often than not, when we look at these turning points, the market is pricing in, the fact that it's more or less over. It doesn't, do the details really matter here? Or is the larger point that, we're avoiding the worst case outcome? There's going to be perhaps some messiness, but, that this is the moment, this is the turning point.
Yeah, definitely the market is a probability indicator, and so it's pricing in the higher probability for obviously lower oil, lower natural gas, and all the issues that the higher oil, higher natural gas comes with it. So yeah, I think there's a lot unsettled. There's attacks taking place as we speak within the Middle East. So hopefully we're just on a path for things to settle down, and I think markets are anticipating better outcomes versus more negative.
It feels like the moment this goes to a back burner, what happens? Alibaba's surging because of a new AI video tool. That narrative comes back to the fore, and China has been a place where we've seen a lot of these AI startups and IPOs get some traction. The Hong Kong market, obviously the memory names in Korea. Is that trade part of the reason why we're seeing such strong performance there?
Yeah, I think you had a real relief rally across Asia, including both China and Hong Kong. Hong Kong reopening for the first time in they had a 5-day weekend. But yeah, I think there's some other factors at play. You had some very positive signs from Chinese regulators about the importance of e-commerce and their efforts to raise domestic consumption. You also had a new AI video from Alibaba released. So there's some net positive. I think there's arguably some real green shoots for China's economy and capital markets, and they've really suffered due to some of the AI picks and shovels trade, really TSMC, Samsung, SK Hynix. That's where a lot of the Asia tech money, so we're kind of constructive on our book that we see a little bit of a grind higher from what's been a pretty tough pullback over the last 6 months.
What else would you say is going to be lasting reverberations, whether it's the relationship China has with Iran now getting oil out of the strait, perhaps the Chinese yuan being involved with some toll taking there? Those are based on reports. I'm not sure if any of that's been confirmed yet. And also, again, just the focus now shifting to the president's meeting with Xi Jinping that's coming up in a few weeks' time.
I agree. The latter is really the key points, Kelly, that you have President Trump going to China in a little more than a month's time. China, as well as Pakistan, clearly played an integral role in coming to this truce. The foreign minister of China spoke 26 times between the U.S. and Iran. President Trump acknowledged that. So I think it sets a path for better U.S.-China relations. And certainly there's a lot of U.S. corporate interests in China. We know there's things that we can anticipate will be announced when President Xi and President Trump meet in a little more than a month's time. So we think that potentially dampen some of the geopolitical headwind that's really weighed on some of the investor sentiment in our space.
All right, Brendan, for now, thanks. Appreciate it. Brendan Ahern with Crane Shares. You can see the large cap Chinese shares there, up about 2% year to date, or today, I should say, still lower about 4% year to date. That's kind of the bird's eye view of the situation in China. But let's drill down a little bit more on the Chinese tech and how companies are advancing their AI stacks, with NVIDIA, despite its strong performance today, not necessarily anywhere in sight. Christina Partsinevelos is here with more of those details. So this is this a deep seek? Are we continuing this narrative that there are competitors coming out of China here?
Oh yeah, there's a news hook for today, and it involves Alibaba, which is why the share price is up almost 5% after, and also helping Chinese tech across the board after the company launched a data center in southern China. Okay, not huge news, but it's powered by 10,000 of its own AI chips. And to your point, no NVIDIA anywhere in the picture, and that's not an isolated move. So DeepSeek is a Chinese AI startup. It's about to release its next model V4, and it's going to run entirely on Huawei's Ascend chips. According to the information, the model could have come out sooner, but DeepSeek spent months rewriting its code with Huawei engineers to get it working on domestic hardware, which means more of the stack is becoming Huawei. Alibaba, ByteDance, Tencent have all placed bulk orders, hundreds of thousands of Huawei chips, not necessarily American ones, ahead of that launch. That's a big deal. And Huawei is now trying to push those chips beyond China's borders. Malaysia recently said it would deploy Huawei Ascend chips as part of a sovereign AI program, the first time outside of China. Brazil has become another important market for Huawei, especially because of all the AI developers over there. So the risk for NVIDIA is no longer just lost sales in China. I know analysts and everyone said, China's not part of the equation. It's not in estimates anymore. It's that parallel ecosystem that's forming around Alibaba, Huawei, DeepSeek, one that gives Chinese AI firms something they haven't had before, and that's an exportable alternative.
And yet, look at NVIDIA shares. They're a little bit off session highs today, but after having treaded water for the past 9 months or so, people are waiting to see if this one will break out, especially as some of these concerns recede.
Yeah, the problem is it's been stuck in a range. It did dip below that 170 technical level, but to your point, compute names have climbed higher. AMD is also in that mix today. More specifically with China and all of these names, that's a bigger threat. I would say that you would feel longer term with NVIDIA as if Huawei and these Chinese firms start to grow market share outside of China. And so that's when countries decide they're going to use these Chinese offerings as opposed to American offerings. And so that's the major risk, and one that NVIDIA will use as leverage in D.C. when they say, hey, you shouldn't put these export controls because look what's happening.
Right. Let that market stay open to us. And of course, investors look at the dollar signs there potentially with excitement. Christina, thanks. Christina Partsenevelis. Still ahead, energy, different story. The only sector in the red today. In fact, it's on pace for its worst day in nearly a year. Our trader trimmed his winners in energy and was expecting a broader market bounce today. We'll have his latest moves coming up. And a fun fact about today's market. It's the 25th time in the Dow's history it's gained more than 1,000 points intraday, according to Carson Group's Ryan Dietrich. 23 of them under Trump. As far as 1,000-point declines, Trump has 23 of those as well, to President Biden's 11 and President Obama's 1. We'll be right back. Welcome back to the exchange, where we're keeping an eye on this market rally still right near it's almost like the markets are pegged up at the levels we opened at 9:30 a.m. Eastern time. We're just a little bit below that right now. Solid gains across the board, less than 3% now technically for the NASDAQ and for the Russell. Again, impressive in light of the headlines that we've been receiving over the past several hours. The market's clearly looking at much more of a resolution than you might be led to think by those news events. In any case, here are some of the movers that we're seeing, and we'll start with Levi's. The shares are up 12% on better than expected results. Best day in a year for that name, and putting the stock back in the green year to date. And then the cruise stocks rallying as oil plunges. The sector's been beaten up since the start of the Iran war, thanks to higher energy prices and travel restrictions. Now Norwegian, Viking, and Royal Caribbean are popping at least 6%. Carnival's up 11%, making it one of the top performers in the S&P today. Which brings us to Delta. Those shares are up 6% as the airline reports strong demand despite higher fuel costs. CEO Ed Bastian told CNBC Delta will still have to meaningfully reduce its capacity growth plans in the near term, thanks to that higher fuel bill. So keep an eye out for the fallout, even as the stocks move beyond these near-term events. Let's get to Mackenzie Sigalos now for the CNBC News Update. Hi, Mackenzie.
Hey, Kelly. North Korea fired several short-range ballistic missiles toward the sea today, according to South Korea's military. One of the missiles traveled more than 400 miles off North Korea's coast and followed a separate launch yesterday. It comes as the regime has made clear it has no intention of improving ties with Seoul, with an official saying South Korea would always remain the country's most hostile enemy state. France plans to add $39 billion to its defense spending between now and 2030 under an updated military planning law. The country says it hopes to increase its number of nuclear warheads and earmark billions for rebuilding stocks of artillery shells and air defense interceptors. And the former architect, accused of a serial killing spree on Long Island over almost 2 decades, changed his plea today, pleading guilty to 8 murders. Rex Heuermann, alleged to be the so-called Gilgo Beach killer, told a Suffolk County judge he was waiving his right to testify on his own behalf and the right to appeal after maintaining his innocence since his 2023 arrest. Kelly, back to you.
Such a troubling story, Mackenzie. Thank you. Coming up, the financials are surging today. A rate cut could be back in play. The big banks are all up 3% or more, cities up 5%. But should the Fed lower rates? We'll debate that next. And as we head to break, the Alta assets are also rallying, even as Moody's cuts Blue Owl's fund outlook to negative on surging redemption requests. BlackRock, one of the top performers, up nearly 5% today. More after this. Welcome back to The Exchange. The U.S.-Iran ceasefire is putting a rate cut back in play. The markets now see about a 31% chance of a cut in December and only a 1% chance of a hike. But my next guests say this doesn't change their very different views on what the Fed should do. One still calling for a hike this year, the other pushing for a cut, perhaps more in the near term. Let's ask them. Let's bring in Barry Knapp. He's director of research at Ironsides Macroeconomics, along with Adam Posen, who is president of the Peterson Institute for International Economics. And I don't mean to set this up like a boxing match, but you are two intellectual heavyweights. And I hear from people all the time who they'll hear from Barry and then they go, I agree with him and now I agree with him. So let's just settle this once and for all. Barry, why do you think and to what extent do you think that we should cut rates at this point?
Because I think, in essence, I think that we should cut 50 basis points. The policy rate should be set at 3. I believe that the policy rate setting is about 50 basis points too restrictive, but the balance sheet's providing 50 to 75 basis points of accommodation. So if I had my druthers, and Governor Moran detailed this in his recent paper that he constructed with some Fed staffers, as well as the speech that he gave a couple of weeks ago in Miami, you have to make the transition slowly, but by getting that policy rate down to 3, you'll do a number of things. First of all, you will boost small bank, regional bank return on equity above where it needs to be to completely reopen the small bank credit channel. That, if we use the 3-month bill to 10-year Treasury as a proxy for rough bank profitability, that spread is averaged 100, or median is 140 basis points since 1940. It's currently 60. That's why their ROE is 3% lower than the big banks, who are more fee-based and not as spread sensitive. If we were to steepen that yield curve out, that will open the credit channel for small real estate developers. You know, last time I was on, I was debating this with Steve Leisman. I think we need that credit to flow to those small developers, to small businesses.
In this view, the long end, the 10-year yield might go up if the Fed starts releasing.
Correct. Yeah. The problem is less on the demand side for housing than it is on the supply side. So, sure, could it push the mortgage rate up, all things equal? Yes, absolutely it could. Though if you do, you conduct this process over time, the way I view the broader plan here that Treasury Secretary Bessent would detail, Moran would certainly agree with, it seems Waller, Bowman all agree with, and Warsh likely as well. You steepen out the yield curve, you lower that policy rate, you start mitigating the problems on the bottom side of the K-shaped economy for small banks, small businesses, small business employment is decidedly weak. It's running negative 40 basis points, whereas large businesses is more like plus 80 basis points or so. That's annualized growth. So you start resolving that problem. You go through with Bowman's bank regulatory relief plan. She spelled out things like lowering the capital requirements for small bank C&I lending and small bank business lending last week in a speech. And then, in time, second half of the year, you start unwinding that balance sheet. Now, you obviously need to change liquidity requirements and all to do that, but you start shrinking both the liabilities and assets of the Fed's balance sheet. And so now policy is a little bit more balanced between big banks, small small businesses, large businesses, and that would get us to a better, more fair, lest I use that word.
A loaded word, but sure.
Set of policy. So I'm not saying that overall policy is too tight. I'm saying the rate policy is too tight. The balance sheet policy is too loose.
All right. So Adam, do you have any issue with that, or would you say that's
I got,
okay? Go ahead.
I got several issues with that. First one is monetary policy shouldn't be used to bail out particular sectors like small banks or small business. Part of what Secretary Bessent and Chair nominee Warsh have complained about the last few years was when they tried to use monetary policy for distributive purposes, and they're right on that. Shouldn't be doing it in this direction either. Second, it's not going to work. I agree with your guest that worrying about where the policy specifically transmits is important, but if you're jerking up the long end of the curve and steepening the yield curve, maybe you improve profitability for banks, but you make credit conditions harder across the whole economy for everybody else. And if he says, on balance, monetary conditions are about right, I don't think they are, but anyway, you certainly don't want to tighten. But third, and most importantly, if you go into the actual data, the reason that small businesses and small business lending are so bad is because the Trump administration has created enormous uncertainty, not just through its trade policies, not just through its undeclared war policies, but through its investment policies, its regulatory policies, some of which are good but have been left too arbitrary, even if they're in the right direction of deregulation, and its anti-migration policies. And you can look at the data and look at the individual companies and industries, and the lowest employment growth was in those areas that most reliant on migrant workers. If you look at investment, there's been no investment outside of AI, as you and I have discussed previously, Kelly. That's because there is this pall of uncertainty over the economy.
What would
Meanwhile, my point, one last point, my point of view is that as the labor market shows, the economy is actually still much more resilient. And so we're going to have inflation from all of this, and it's going to get worse if the Fed continues to loosen.
So you think we're going to get inflation from all of this? And so what would your policy, if you were Fed chair for the rest of the year, Adam, what would your policy response look like?
Well, realistically, you cannot raise rates close to the election. But I think what should be happening is there should be a hike in the last meeting before Chair Warsh takes over. I think you could get a majority of the committee for that. At a minimum, you should get a clear lean in statements for a tightening direction. And I think realistically, in terms of forecast, they're going to be hiking at the December and January meetings because they're going to do nothing between now and then.
Barry?
I actually have a question for Dr. Posen, Adam, whatever you prefer.
You can speak to him over here.
Adam is fine.
Okay.
Adam
well,
is fine.
we met back when I worked at BlackRock, but anyway, it doesn't matter. One of the points you made in your paper that you wrote with Peter Orszag was you were worried about deficits potentially contributing to inflation. You had 4 points, as I recall. But I would argue that the thing that facilitated government spending to going to 24% of GDP from its median since 1981 of 20.3% of GDP, one of the facilitating factors was the Fed's purchases of longer duration assets. And so the fact that the term premium is half of its long-term median, that 3-month 10-year curve is less than half of where it's been historically, all those purchases in the long end is actually what fueled the government spending that fueled, the inflation, right? The checks that were sent out, the 1.9 trillion stimulus, all that stuff. So I'm not sure how hiking the policy rate is going to act as any kind of a check or a regulator on government spending. Where I'm going with all this rebalancing of policy over time is if the Fed doesn't hold $6.5 trillion of assets, the banking system holds a bigger percent of assets. You now have price-sensitive private sector buyers that will act as a regulator or a check on profligate government spending. And that's sort of where I'm going with the whole argument here.
This is fascinating, Brett, because you're being the theorist and I'm being the practical person. So you're asserting a theory that somehow budget policy gets made in the U.S. by Fed balance sheet, budget policy gets made in the U.S. by small business, by banks. Budget policy gets made in the U.S. by the president and the Congress, and they don't give a rat's bleep for interest rates. If you try to run a regression, they don't tend to be more deficit sensitive or less deficit sensitive as interest rates go up and down. It's just not correct. It's not good either. It's not a good thing.
Well,
we
we've
wish
had
we
our
had a Congress
episodes
that
of
was more responsible. But all these things you're talking about playing with will have no effect on the actual deficits because that's a question of Congress and the president.
Adam, I'll give you a final last word on this then. As you'd say, you would hike rates in the very near term because you view this economy as not having enough workers fundamentally. Is that what you think is going on?
I think 3 things are going on. Your other guest kindly cited the thing with Peter Orszag and I wrote, and again, there's room for debate, obviously. I think the labor market's much tighter than people think because we've had so little net migration and because of demographics. So therefore, inflation risks are higher. I think, and here's where I agree with him, monetary policy is not as tight as people think it is. And so credit conditions are more toppy. And I think that we've got these inflation pressures, which are seen in the services, including Chair Powell just recently saying, hey, it actually has been more persistent than we thought. And so there's inflation momentum. So all of those together, along with the fiscal.
Well, I'd love to do this again sometime. Viewers, write in with whom you're siding with. I love hearing the full thing. I know we get into the weeds, but it does help. Gentlemen, thanks. Really appreciate it. Barry Knapp and Adam Posen. Coming up, a harassment campaign that's driven by ego, jealousy, and a desire to slow down a competitor. That's what OpenAI called Elon Musk's ongoing lawsuit against the company, and CEO Sam Altman in a social media post will have the latest and the bold ask Musk's legal team made. That's coming up next. Elon Musk is escalating his legal battle with OpenAI founder Sam Altman in a new court filing ahead of a trial set to begin later this month. Kate Rooney has the latest in Tech Check. Hi, Kate.
Hi, Kelly. So in a filing on Tuesday, Elon Musk's lawyers asked to have CEO Sam Altman and president of that company, Greg Brockman, removed from their roles at OpenAI. As a legal remedy, they now ask to strip those executives of what they call authority and personal financial benefits they extracted from OpenAI's illicit for-profit operations and conversion. The backdrop here, Kelly, Musk sued OpenAI, which he also co-founded, alleging that he was manipulated and deceived after OpenAI explored converting to a for-profit. Jury selection for that trial kicks off in a few weeks here in San Francisco, and Musk is now seeking more than $100 billion in damages from OpenAI, and co-defendant Microsoft now says he would actually return what he calls ill-gotten gains to OpenAI's nonprofit arm. It does come just a day after OpenAI penned a letter to the California and Delaware attorneys general accusing Musk of anti-competitive behavior, including possible collusion between the Tesla CEO and Meta CEO Mark Zuckerberg. This all has to do with text messages where Musk asked Zuckerberg for help acquiring OpenAI. Meta had already sided with Musk in this fight, sent a letter to the California AG a couple of years ago asking to block the company's for-profit conversion. Musk left OpenAI back in 2018 after trying to merge that company with Tesla, later launched xAI, which now competes directly with Altman's firm And then that firm recently merged with SpaceX. The drama, Kelly, comes as OpenAI and Musk's SpaceX look to go public in record listings expected this year. Back over to you.
Yeah, there's going to be scrutiny. I mean, the New Yorker article, there's so much more scrutiny that's going to come on these companies, even as we're using the tools more than ever. Kate, thanks very much. Kate Rooney.
Thanks, Scott.
24 hours ago, he said buy the market. He's back to take a victory lap and tells us what he's doing next with Jeff Kilberg. He's up right after the break. While the Dow was tracking for its worst day in nearly 2 weeks yesterday, KKM's Jeff Kilberg was telling us here on the exchange it was time to buy. That call clearly paying off today. So what's the next move? Let's bring him back. CNBC contributor and KKM Financial CEO Jeff Kilberg. Not just to give you a victory lap, but it's fun when people make a bold call against the grain. My real question, Jeff, is seriously, what do you do now? Once you say, okay, we get the initial move. Is it just off to the races? We never have to worry about this again? Or could we be in for disappointment and kind of a chronic, churn through oil and stock trading patterns we've experienced the past couple of weeks?
Well, Kelly, my glass is still half full. And I don't want to tear a rotator cuff, patting myself on the back, because the market has its way to humble you very quickly. But we have been bullish here as we saw the market put in a bottom last Monday. We saw that options volume spike. Remember last Monday we saw unusual option activity. We saw a lot of puts being bought. Well, today we see that gamma squeeze. We had that 2 to 3% gap up. I think there's more room to run. We're only about 20 handles off of the overnight high. So I think the S&P is going to continue to move higher. Yes, the next 2 weeks, Kelly, will probably be littered with potholes as we are now in this Iranian conflict off-ramp. But I am optimistic, and I love seeing the VIX go lower.
Okay, what else? What else do you look at and feel itchy to buy or sell or follow or anything like that?
Well, the AI component, I know it's not getting any love. We want to talk about lawsuits with Elon Musk more than actually what he's doing with Terafab. But if you look at Tesla, it's down about 20% year to date. What Intel has done, and Intel was the big call yesterday, right? I talked about Intel having more room to run. I believe it's going to go up and touch $70, another $12 higher from where it is after being up 10% today. But that's because Intel now has Foundry as a business, and that's thanks to Mr. Elon Musk. So there's a ton of cost savings going on by building everything, packaging all those chips inside of their Austin office in Giga, Texas. So that's where I think Tesla is an opportunity. But we're also looking at Applied Materials. Look at Lam Research. All these different names that have the AI centric, I think they regain their focus and we run to new all-time highs. But don't forget, Kelly, earnings season right around the corner. There's optimism. There's light at the end of the tunnel. We can get all emotional in the next 2 weeks, but I think we're going to see markets move higher.
What about energy?
Energy, I think you have to trim, but I'm not walking away from energy. Marathon Petroleum, ExxonMobil, those are two names we really own. Anchor tenants in our Essential 40 ETF. But at the end of the day, I want to see the confirmation on the all clear. We talked about this yesterday. Confirmation all clear is when we see crude oil go under $83, $85 to be precise. That will allow energy to obviously come off and get some profit taking, but we still want to own those big blue chip names.
But you want oil below 85 for the broad all clear.
I do, and I think there's going to be a lot of confusion between now and the next ceasefire deadline, but I think there's a path to peace, and that's what's really optimistic, and it's a lonely view, Kelly, but I have to embrace it.
All right, Jeff, thanks. Good to see you again.
Thanks,
Jeff
Kelly.
Kilberg.
Thanks for having me.
And that's it for us. Thank you for watching The Exchange. I'll join Brian Sullivan for Power Lunch right after this quick break.
Time in nearly a decade, Mark Chaikin and I are teaming up again, and we're doing it because something unusual is happening in Wall Street financial data right now.
John and I don't do this often. In fact, it's been more than 8 years since we last appeared together in a presentation like this. We've both got plenty going on, and neither of us needs the attention. But when I saw a very specific pattern show up in the trading system that I've been perfecting for the past 40 years, I immediately called John and asked if he was seeing the same thing.
And at the moment I looked at it, I knew exactly why he called, because this is the kind of thing you rarely see. And when you do, it usually means a big market shift is already underway. Now, for those of you who don't know us, that's completely fine. I spent 25 years as a floor trader in Chicago, helped manage billions of dollars in capital, and was brought on regularly by CNBC to break down the markets.
And I've spent more than 50 years in the investment world. I created one of the first systems for analyzing the way money moves on Wall Street. And my tools eventually ended up in Bloomberg terminals and on the desks of institutional investors across the country.
Right now, the same system is flagging a set of opportunities that, frankly, most people aren't even paying attention to.
We've recorded a full breakdown where we walk through exactly what the data is showing, how to interpret it, and why this moment could be so important for investors, regardless of your level of experience.
And once you've seen it, once you understand how the system works and what it's pointing to right now, there are really no excuses. You either act on the opportunity or you don't, but you can't say you didn't know.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Your money is soaring on Iran peace talk, but is the real risk really over? Welcome to Power Lunch, everybody. Alongside Kelly, I'm Brian. The markets are moving up, but questions remain. Luckily for you, Stephanie Link is here for the entire hour, and Keith Lerner also on set as a potentially fragile 2-week ceasefire between the U.S. and Iran, bringing in the buyers. One of the biggest updates in years, Kelly, but oil and energy stocks having one of their biggest down days in years.
Flip sides of the coin. Plus, we have two key voices coming up. Ian Bremmer is the founder and president of the Eurasia Group. He'll join us to break down the high-stakes dynamics in the Middle East right now. And Stephen Bird is Morgan Stanley's global head of sustainability research. We'll talk through power demand with him, grid investment, the next phase of the energy transition. Hard to determine the way oil price is swinging around right now. Let's get to Eamon Javers. In the meantime, he is at the White House with some breaking news from the press conference that just wrapped up. Eamon.
Kelly, that's right. The press secretary here at the White House saying that the Vice President, J.D. Vance, will be heading to Pakistan along with a negotiating team this weekend to open in-person negotiations with the Iranian side. The Vice President allegedly going to go there along with Jared Kushner and Stephen Witkoff. Also to participate in those talks. The press secretary here at the White House saying, guys, that the White House believes that the Strait of Hormuz should be opened without any conditions. And that's an important point because this gets to this question of whether the Iranians will, at the end of this, be able to charge tolls for transit through the Strait of Hormuz. I asked the press secretary if that's an acceptable outcome to the United States. And what Caroline Leavitt said was that the president wants the Strait open without preconditions, and that means without tolls. So for now, the U.S. position, guys, is that the Strait needs to be opened and the Iranians need to not be charging tolls for transit. I'm going to send it back over to you, having a little audio problem here, but send it back over to you guys.
All right, Eamon Javers. Eamon, we appreciate it. Even though you can't hear us, we can hear you. And in fact, we do have some new reporting on that exact topic, the Strait of Hormuz and shipping. I was in touch minutes ago with German shipping giant Hapag-Lloyd, and they sent me this quote. Based on our current risk assessment, we are currently refraining from transiting the strait. At the same time, we are continuously and very carefully assessing when a passage will once again be possible. That from Hapag-Lloyd, just one shipper, but it's a big one. They're still not comfortable going through that Hormuz area. That lines up with some marine insurance sources that have told me today that as of a few hours ago, there has been little to no increase in actual shipping activity. In fact, only 2 bulk carriers have crossed the strait. That, according to Marine Traffic by Kipler. Now, those bulk carriers carry dry cargo, not oil. Most of it's not flammable. That's key. Some of the issue being not just the fear of what may happen, but also that thing that Eamon talked about, the potential toll that Iran or some in Iran may be trying to charge. There is a live look, Kelly, of the Strait of Hormuz, and you can see that very tip. There is still no tanker activity in the strait.
Critically important what you just reported, Brian, as well. And yet, even throughout the day, as we've been hearing more updates about whether or not the strait is reopening, the market remains undeterred by this rally that we're seeing. In fact, the Dow's up 1,300 points right now, very similar to what we saw when the bell rang at 9:30 a.m. A notable bounce today. All 4 major averages are rallying by more than 2% as the temporary ceasefire between the U.S. and Iran is sending stocks soaring. Will it last, though? And what should investors do in the meantime as we try to figure this all out? As Brian mentioned, on set with us for their takes, Keith Lerner is the Chief Investment Officer at Truist Wealth, and Stephanie Link is the Chief Investment Strategist at Hightower and a CNBC contributor. Welcome. Keith, take it away. Are you surprised by the market reaction?
Well, it's been a big move, but I would say heading into this week, the market was the most oversold on many metrics since the tariff shock. And by the way, just an interesting factoid for today. Today is the 1-year anniversary of the low following the tariff shock from last year. So
almost to the day. This actually brings up a big point of discussion and debate in the market. Some say this is going to be exactly like that event. The president backed off, markets rallied, never really looked back. Others say because the price of oil is different, we had our Amrita said laying out the case an hour ago for $5 gasoline, still higher prices for diesel, that shock will be harder to reverse in one fell swoop, and same for the market impact. I don't know if you fall in one of those two camps.
Yeah, well, the first thing I would say is also think about last year. We were down almost 20%. This correction was only about 9%. So it's not the same exact situation. And as people say, it takes takes 2 to tango. So it probably is a bit more challenging. I will say, though, I think investors and corporations have adapted over and over time as far as all these shocks that have been coming. And each time, what do we see? We see that profits eventually come back to new highs, profit margins come to new highs, and companies adapt. And I think that's part of the reason why so far the market has actually taken all these concerns somewhat in stride.
We have to break away, but Stephanie, quickly before we break, which of those two camps, are you in the kind of off to the races or the let's wait and see a little bit?
I think we're off to the races because I think the economy is a lot stronger than headed into the war. And I think it's going to resume the momentum. And by the way, earnings have been going higher, and earnings are going to grow 14% this year, and multiples are down 17%.
Wow.
But yet you just sold Chevron, and we're going to get to that in a second.
Okay.
But we've got some breaking news that we have to break away from. We're going to come back. You're not going anywhere. We're not going to drag you here and then send you on your way. But we are going to send our audience to D.C. for moments for some breaking news with the Fed Minutes and Megan Casello.
Guys, that's right. We just got the minutes of the Fed's March meeting just a few moments ago. Now, remember, these are about 3 weeks old at this point, but what the minutes reflected was a Fed that was keeping its rates steady for now, while noting that the outlook was very uncertain and that war in the Middle East was impacting both sides of the Fed's dual mandate. So on rate policy, all but one member, that was Stephen Myron, voted to keep rates unchanged. Participants emphasized the importance of being nimble in their policy stance, saying that a rate hike could be appropriate if inflation were to remain at above target levels. Now, on the economic outlook, there was uncertainty about the economic outlook remaining elevated. Economic activity, they said, was expanding at a solid pace. Job gains remained low. The employment rate remained little changed. Inflation remained somewhat elevated in their outlook. They said progress in reducing inflation had been absent in recent months, but that the labor market remained broadly in balance. February jobs data, they said, was impacted by the healthcare strike and winter weather, holding down some of those numbers. There was a lot of discussion even 3 weeks ago about the impact of the developments in the Middle East on the outlook and the policy stance. The Fed said that the implications of those developments in the Middle East for the economy were uncertain at that point. Several participants noted near-term inflation expectations were higher due to rising oil prices. And then as for long-term expectations, some participants noted that longer-term inflation expectations could be more sensitive to those higher energy prices. Several participants also noted that a prolonged conflict was likely to lead to more persistent increases in energy prices, and that a majority of participants noted that risk to inflation and employment increased with those Middle East developments, guys. So again, about 3 weeks old here, but still seeing some discussion of how this conflict, this war that we're talking about so much today, was impacting the Fed in March. Guys?
All right, Megan Casello in D.C. Stephanie Links, we'll go back to that. You believe that earnings are still going to be strong. You're not worried about the inflationary aspect of what's going on, at least not in a macro sense.
It's always been the length of the war. If it was going to be short, then we could resume the strength in the economy. This would be a blip. There's no question about it. Atlanta Fed tracker's at 1.3 right now, right? But it's a blip because we had so much momentum headed into the war. And I think if it's short, if it's this 6-8 weeks kind of thing, not 6-8 months. If it's 6-8 months, I'm totally wrong, because that will feed into the economy and into the consumer. But I want to just highlight one thing. Gasoline is only 3% of household budgets. So it's not so much about the gasoline prices per se, because cars are so much more efficient, right? And we have EVs and all that. Yeah. But it really does feed into so many other parts of inflation. And I think if you get oil down and some of the commodities down, I think you'll continue to be able to.
I'm not saying it doesn't. Gasoline matters, but I want to just highlight what we said it yesterday. Just quickly, the average American uses 30 to 50 gallons of gasoline a month. So that's $50 a month, $30 to $50 to $60 a month extra they're going to be paying. To some families, that's going to matter. But for macro consumer spending, I don't know how much that matters, because you've already got beef, groceries, health insurance, car insurance, everything is already up. Maybe it makes it worse, but to your point, it's never been lower as an input cost to the economy.
And it's K-shaped.
Thank you for coming to my TED Talk.
And it's a K-shaped economy.
I'm just curious to pick up on what you said, which is, if this isn't over in 6 or 8 months, forget it. But when we say is the oil price the determinant? In other words, just last hour, someone said, it's got to get below 85 for this to kind of be the all clear. So I don't know if we're ever going to get someone waving a flag and say, the strait's open, or it's closed, or it's semi-open, or it depends. But is it going to come down to the oil price to tell us that this is definitively over or not?
I think it's all about the straight. I think is it going to get open or is it not? And even if it's partially open, that's better than where we are today. And it's not going to happen overnight by any means.
Well, it hasn't happened.
We have 150 ships.
We just reported that. There's nothing happening right now. I want to be very clear. That's where bring up that live chart again, that graphic again. And Keith Lerner, I want to get your take. You're a macro strategist. In fact, you just upgraded energy today because the sell-off. I think you think maybe it's cheap. Get into that. Are you and your team looking at this map every day? If not, tell us. How much does, because we're treating that like it's pretty sacrosanct.
It is. It's very important. But I would also remind folks, right now, all we're talking about is Iran. And as we go back the last 5 years, I would just say each time we have this different thing on the carousel of concerns, and eventually we move to the next thing. So I would also say what's happening is important, but it's not the only thing that matters. I mean, at this point, to the broader point, we're still seeing, is tech AI spending going to stop all of a sudden because of this? Probably not. Is this going to cause day-to-day movements in the market? Yes, but we also remember we had the highest inflation since the 70s, the fastest rate hikes since the 80s, supply chain disruptions, and each time our corporations have adjusted. Here's an interesting stat that I've been sharing with some of our clients recently. Since the global financial crisis, we've had over about 200 months since then. Out of that 200 months, how many months have we been in recession? 2 months. So 1%. So my point is not to say that this doesn't matter, it can't get worse, is that our companies have adapted, and I think that this bull market and the economy continues to earn the benefit of the doubt.
Yeah, no, Steph, I mean, I know you say much the same thing. Why have earnings been going up this year? The estimates for kind of the quarters to come.
Well, for the most part, it's technology, and it's the AI boom, and it's also the AI food chain that I know we're going to talk in a little while about. Not only is it AI, but it's data centers, it's grid, it's power, and that is fueling a lot of the growth. It's also consumer. The consumer is actually consuming, and I think it goes right back to the economic data. I mean, last week alone, every one of the job reports that we got, whether it was Challenger Gray, ADP, claims, or non-farm payrolls, all beat expectations. And so the consumer, if they have a job, they're spending, and that's what they're doing. And in the meantime, ISM Manufacturing and ISM Services, yes, I know it was a disappointment.
Why did you sell Chevron?
Because I thought I was buying a lot more technology.
Because he just upgraded energy today.
Yes.
You sold Chevron, which is the Stephanie Link version of a downgrade if you sell it.
It is a downgrade.
That's the ultimate downgrade is the sell.
First and foremost, I still own SLB, and I'm really big in that position, and I like the services companies better. The other reason is simply I'm up 35% in the name, and I wanted to take some profits. 21 times earnings for a company that's going to see production growth in the upper single digits. It's just not that exciting to me, but I did take that money and I bought a whole bunch of technology names. New names.
New names.
We can talk about it.
We should. We have you the whole, but you just upgraded energy today. So relate that to what Stephanie just said. You don't seem concerned about 21 times earnings.
Don't pit me against Stephanie.
This is what we're doing here.
I see that.
It's a pit fight, man.
I see that.
I'm sitting over here.
Stephanie and I were talking about this earlier. So our perspective, we're overweight industrials, we're overweight tech. And because of what you just outlined with the straight, there's still a lot of uncertainty out there. So we've had an 8% pullback in energy. And from a portfolio diversification standpoint, let's say things start to escalate again. What's going to outperform? It's going to be energy. And also, if you zoom out on energy since 2008, it's only up about 50%. The S&P is up well over 300%. So it's lagged. Technically, it looks great. And I think oil is likely to stay somewhat higher than what was happening before. So put that all together, I think this is a good opportunity to add energy on weakness. And I think it may look like it's expensive, but those earning estimates are likely to move up in a meaningful way.
There we have it. Keith, thanks. We'll let you go. Keith Lerner of Truist. Stephanie, stick along with us. As we mentioned, we'll see you in just a little bit.
All right, so we are just getting started and ahead on Power Lunch. After a huge start to the year, is it time to sell more energy? Maybe we should just have Keith stick around. We're going to stick around. We're back right after this. All right, let's talk more now about energy, the markets, the ceasefire, because markets overall, they are booming. Most energy stocks, they are not, having one of the worst days in years. James West is the head of energy and power research at Melius Research, one of the most followed analysts on the street. And I know the markets are ripping today, James. Good news. We want it to hold. You may have heard my reporting just minutes ago that Hapag-Lloyd, one of the biggest shippers in the world, has told me that as of now, they're not putting ships through the strait. We haven't seen a lot of activity. There's been a reported attack on a Saudi pipeline, attacks on Lebanon as well. Why then is the market reacting like this when what we're seeing and what we're reading and hearing doesn't necessarily equal the market reaction today?
Yeah, I think the market's been complacent this entire time during this conflict. I think oil prices have been too low given what's happened. I think oil prices are off too much today, given that really nothing has happened in the Straits and we're not really reopened. In fact, the ceasefire is not holding at all at this point, as you point out.
Yeah, and so what does that mean? Let's assume, well, we want to assume the best, okay? So I don't want to be negative, but we're one errant drone attack or missile attack away from a $10 pop in oil. I feel comfortable saying that. I think you would agree, and if you don't, tell me why. What does that mean then for the companies and the stocks that you follow? Because while oil is down big today, it's still at 95. It's not at 65.
Right. So I think you're right. One errant drone, and we're up another $10, maybe even $20 at that point, because it signals the conflict will go on for much longer than the market is anticipating today. But I think, though, also we're moving into a new normal. So let's say the conflict does end at some point in the near term. Oil prices are not going back to the 60s. They're going to be in the $80 to $90 per barrel range, which is good for these stocks. All these earnings estimates are way too low, particularly for the service stocks. We're going to see the recovery, of course, in the Middle East and then drilling elsewhere, but also for the major oils, the E&Ps as well, because they're going to benefit from the higher price.
Yeah, and in fact, so I'm trying to figure this out. Doing a piece maybe on Friday, James, so maybe you could help me out.
Sure.
Looking back 2021 to 2022, when Russia invaded Ukraine, we saw oil spike. And in the subsequent quarter, we saw a 250% average gain in big oil earnings per share. And Stephanie, you can chime in because I know you just sold Chevron. Stephanie Link is here on set with us, James. So how much in the second quarter, not the first quarter, but second quarter and third quarter, whatever, do you think we will see earnings per share rise on average?
I think we'll probably see at least a 15 to 20% increase for kind of the major oil companies. I think much bigger increases for the E&Ps. In fact, we've talked to Exxon, we've talked to many of the majors here in recent days and the service companies in recent days. The only place earnings are going down near term is services because they're under pressure in the Middle East and their operations have been disrupted. But everything else is going up and up to the right and up very quickly. And I think the out years, 27, 28, 29, that's where you're going to see the much bigger rises in the earnings expectations.
How long, in terms of the oil services segment, is it going to take for them to get their facilities back up and running? That was one of my concerns about SLB, because 30% of their revenues are tied to the Middle East, and a lot of the infrastructure has been destroyed. So maybe it's been destroyed. So how long do you think that's going to take? And do you think that's an opportunity today to be buying these names in anticipation of a recovery?
So the good news is none of the oil field service infrastructure has been damaged or destroyed. There might be little pieces here and there. Most of the workforce is localized in the Middle East by law in the Middle East. And so we're not moving a bunch of expats back into the country, and that takes a while. So as soon as the conflict is resolved, we can get back to work pretty quickly. In fact, we're working on land in Saudi right now. We're not working offshore in Saudi. We're working in Oman. We're not working in Kuwait or parts of Iraq, but there is some activity happening. And so we can get very quickly back to work. It kind of depends on the customer, whether, Aramco or the Kuwait Oil Company, how quickly they want to get back after they assess. But most likely you would assume they want to get production back up. They want to see what the impact has been on their reservoirs because they shut in the production, so there will be some damage there. So it'll be production-related work that comes quickly, and then new drilling follows after that. So we see a fairly swift recovery. The supply chains are getting set up right now to do that. They're talking to the customer base. They know kind of what the timing should be and when the conflict ends, when they want to be back up and running, and it's fairly quickly. So we see a swift recovery, but a lot of momentum really for a company like SLB as we exit the year and go into 27 and 28, where we would have thought exploration and production spending, so call that revenue for SLB, would have been, let's say, up high single digits. It's probably low double digits, if not higher now, because we're going to see more activity in the Middle East and more activity globally.
And that's a stock you like, right, James, SLB?
Absolutely.
All right.
That's one of our favorites.
James West, Melius Research. James, thank you very much.
And speaking of oil, that's the subject of today's power poll. With prices back in the mid-90s, the big question is whether you think WTI crosses above 100 again this year. Scan that QR code on your screen now to vote. We'll reveal the results later in the show. For now, let's bring in Andy Lipow, president of Lipow Oil Associates. Andy, we heard Amrita Sen last hour say she thinks that prices at the pump could still go to $5 based on the fact that 13 million barrels a day of oil are still shut in. There's going to be a lot of problems kind of getting product where it needs to go. Do you think that's a realistic view?
Well, I think that $5 a gallon gasoline is still quite a ways away. That's about $40 a barrel. But it is really possible to see WTI prices rally back to its recent highs, especially if this ceasefire doesn't hold and the strait continues to be shut and we see missiles flying from the U.S. into Iran and Iran back into its neighbors. So I'm certainly not going to rule it out.
What, at this point, do you think is going on with the disconnect between the physical markets and kind of where we're seeing markets in the financial world trade? In other words, WTI in the mid-90s, we normally think, okay, that's a certain number at the pump, but this time is a little different because of these physical shortages, or is it?
Well, certainly the physical crude oil market is pricing far higher than the futures prices in order for refineries to get their hands on a physical cargo. If you look at what WTI is selling for into Asia, in July, it's $40 a barrel over Brent prices. So there is a very large shortfall on the physical market. And I do agree with Amrita Sen that the supply shortfall today is somewhere between 13 and 14 million barrels a day. And that's not going to come quickly back, even if the strait is reopened. We have to think about it this way. Not only are tankers bottled up inside the strait, you need empty laden tankers to go back into the strait in order to load crude oil in order to get that production to start coming back.
Let me, instead of leading the witness, ask you what you think on the question of $100 oil, Andy. Are we headed back above that level or no?
I think we are, because I'm really concerned about this ceasefire. We've got the U.S. 15-point plan versus the Iranian 10-point plan, and each of these plans have items in it that the other side just simply won't agree to. So my biggest concern is that the ceasefire falls apart, oil prices go up.
Okay, and then for those then who think, no, this is, you know, the height of the panic is over, what are they missing?
Well, I think they may think that if the conflict ends, you know, where will the prices go down to? And I think that they would go down to the mid-70s to $80 a barrel range, because the market is now going to price in additional geopolitical risk. If Iran was able to shut down the strait once, they can do it again into the future.
All right. Andy, for now, thanks. We'll leave it there. Circle back soon. Appreciate it. Andy Lipow with Lipow Oil Associates. Coming up, does the volatility in the energy space change the calculus for powering data centers? We'll get into that with Morgan Stanley's head of thematic research right after the break.
All right, let's stay on the energy story because while the markets overall are moving higher, oil is crashing. But let's stay realistic. Crude oil is still $30+ per barrel, more than just 45 days ago. Some countries have already seen product shortages, things like jet fuel and more. All this further highlighting the world's dependency, some might say dangerous dependency, on oil and natural gas. Could this boost investment in other types of power like solar, wind, nuclear, storage, and more? Some of those stocks, not just oil and gas, up double digits since the start of the war. Let's talk about that and bigger themes, and also get some stocks that Stephanie Link likes. Joining us, Stephen Bird. He is Global Head of Thematic and Sustainability Research at Morgan Stanley. And Stephanie as well. A lot of S's in there. I did the best I could. It's been a long couple days. It's been a long couple weeks, to be honest with you. Give me a break.
It has.
All right, so Stephen, there is this theme, and Stephanie, chime in because I know you like some of these names as well, that what we're seeing now is going to push people more toward a lot of the stocks that you and your team cover because we're going to realize, whoa, things can get cut off.
I do see that, though renewables by itself is simply not reliable enough for nations to say, this is my path to energy independence. It's part of the picture. I would say nuclear is a big part of it. Energy storage is a big part of it. But we just cannot move away from natural gas. I see reallocations, different approaches. So yes, it's good for clean energy. I just don't want to overstate that in terms of the grand scheme of things. And when I think about data centers, it's really not the big solution for data centers. That's still mostly natural gas and nuclear that's going to be.
When you mentioned nuclear, you mentioned wind, or maybe you didn't. We mentioned wind, you mentioned natural gas. One company that crosses in all of those is a company called GE Vernova.
Yes, indeed.
You might have, I think Stephanie Link owns. See how that, it's amazing how that works on television. Talk to us about GE Vernova, and then Stephanie, why do you like them as well?
Yeah, great company across the entire value chain. So when you think about renewables, you think about grid upgrades, you think about data centers, you think about just the absolute demand for energy we need. That's GE Vernova. They're at the center of all of it.
Do you know that their backlog was up 66% last quarter alone on a year-over-year basis? So everyone talks about orders, but orders can get canceled. Backlog is real revenue dollars, and so that's the thing that I pay so much attention to. But I want to just ask you a question about natural gas.
Yes.
Do we have enough pipelines? Because that's the bottleneck, right?
In the U.S., we need more.
Yeah.
What I like to see is big companies like Williams are at the heart of that. They're now tied with the AI trade. I see them doing more and more pipeline activity. That's going to lead to more GE turbines.
Yeah.
And the data center community loves that. So that's the biggest part of the solution.
Are we really likely? So when's the last time we built out? My assumption is there's no pipeline construction happening. But maybe I'm wrong about that. Maybe that's happening.
Up here, I'd say in the Mid-Atlantic, Northeast, absolutely correct. Down south, it's easier to build laterals, add additional supply. It's a very different picture down there. And we see a lot of activity down in Texas, Louisiana, places like that. That's an area of tremendous growth.
Is that why we're seeing data center capacity come on?
Yes.
To come to market in those
Big
locations?
part. I'd say also regulation is a little more friendly. The politics are a little more favorable down there compared to up here. But yeah, natural gas availability, that's absolutely huge.
But what Williams is doing is pumping. They're doing arteries and veins. They're going right to the data center from the power source.
Yes.
Kind of a unique view as well. And then when you make power, you have to get the power. Another big problem is power lines. The average power line in America is like 70. It's older than me even, like 70 years old.
Yes.
They're not very efficient. There's a lot of power loss. Quanta Services, PWR, another company. Oh, that's Stephanie Link.
Yay.
It's amazing how this all works out. That is trying to solve that by installing billions of dollars in power lines.
Yes, and Quanta is great because we need more labor. We need the folks who actually know how to build stuff. Quanta is brilliant at building. That is one of the biggest bottlenecks we have right now in terms of data center infrastructure. I'd say labor, grid access, power turbines, backup power transformers. We need all of it. I'd say labor in particular. Those types of players will see greater and greater premia for their content.
They had an analyst day last week, and they increased their total addressable market between now and 2030, $2.4 trillion from $940 billion. Wow. They are in so many parts of the whole food chain. So it's data centers, yes, it's about 10, 15% of their business. Grid, upgrade the grid. 75% of the grid is over 25 years old. We need to upgrade the grid, and it takes a long time, and you need the people exactly for that. And of course, the power story. So they're part of every different segment, which is why I like it so much. And it is the people that makes them so different, right?
Yes,
Is that a name you could literally buy, lock it up, forget about it for 5-10 years?
Easily a decade.
Really? You think
Easily.
GE Vernova, because a little bit when we talk about what's happened, this microcosm of the past 5 weeks, fine, that's one business to be in, is try to anticipate whether we're going to be in old energy or new energy names. But I'm curious who you think are going to be the compounders, not to go so far as to say the tech-like returns, but you never know.
Well, look, I think the easy way to play it is NVIDIA or Broadcom, the technology side of things. I think less popular are all the names that you're tracking and that I'm tracking. And so, like, Vertiv is also a name that I like very, very much. Eaton is a name that I like very much. So I own a boatload of these things. And it does trade, they do trade like NVIDIA, though. I mean, but they're
not cheap relative.
They're not, but the backlogs
okay, well, hold on.
are
Let's
huge.
talk about Eaton.
Yeah.
Art up there in Cleveland, Ohio. Been around 118 whatever years.
Wow.
Okay. They kind of were a company that was just in everything, but you never thought about them.
Right.
And I know NVIDIA is the sexy data center name, but you're not building a data center unless Eaton is probably in it, right?
That's
or
right.
Vertiv in some cases too. They're getting no love and attention, maybe a little love from the smart money like yourself, Stephanie, but you can jump in as well, Stephen. Eaton, you can't build a data center without them.
No, you can't. And actually, their electricals, America, their backlog was up 200%. I mean, the numbers are just staggering. And I just don't think that they're the obvious choice. I think everyone thinks of like Vertiv and GE Vernova, right? I mean, Vertiv, who doesn't want to invest with Dave Cote, right? I mean, he's the executive chairman. He was at Honeywell, and he was a rock star, right? And they make the cooling systems, which you'd absolutely need. And they have the services piece. Everyone thinks of Vertiv or GE Vernova, which is also popular. I think Eaton is kind of an off the beaten path a little bit.
Just to bring it back to what you said about Chevron, too. Look, I understand you're up 35% year to date. Why not take some money off the table? But you could ask kind of a similar question for some of these names which have done so well. I'm just curious what your thought process is there.
I think the growth is more. I think they're more expensive, but I think the growth, again, the backlogs, all of these companies are enormous, and that gives me more visibility. Nothing wrong with Chevron, guys and gal. Nothing wrong with it at all. I just made money, and I wanted to put it elsewhere. That's being a portfolio
We're giving her
manager.
such a hard time about it.
Leave us with
How
a-
could you
listen,
sell Chevron?
I don't know
Buy low,
when
sell
you-
high.
By the way, Stephen, I don't know when you and your team have all this time because you write like 100-page reports.
Yeah, you do.
I'm going to lie to our audience that I read every word you write. I don't have the time.
I understand.
But you do great work. Leave us with another name or two that you love.
So the big deal here is the growth in AI is nonlinear in terms of the capabilities. So I would say a Bitcoin name like TeraWulf is going to turn themselves into a host of data centers, and the upside is tremendous. So that's the name I'm leaving you with.
Paul Prager's been on this program many times, and I've seen him in Easton, Maryland, that he is single-handedly rechanging the city of Easton, Maryland.
I worry there's going to be like the people in the credit pipeline to some of these data center build-outs. Is that a reliable business?
It's a great question. So nowadays we're seeing the hyperscalers guarantee everything. So when TeraWulf builds or Riot or some of these others build the data centers, all of the lease revenue is being guaranteed by the hyperscalers. That's the new normal. It's a great question.
Because we've seen already people being, but they're not the latest and greatest chips. We're not going to. So, but if it's guaranteed,
we're good to go.
It's a pretty sure thing, I guess.
Power Lunch, Cleveland edition. We're going. Kelly, you ready?
You're going.
You're ready. We're all going. Stephen Bird, you're going. We're going to say goodbye, but we appreciate you coming in. Thank you very much. All right, folks, quickly sign up for my forthcoming energy-related newsletter called Power Insider. I will not write nearly as much as Stephen and his team, but we're going to steal his ideas, put it into the newsletter ourselves. We'll meet power players and more to launch next Wednesday, April 15th. We're doomed. Let's use the QR code and sign up today. And by the way, Stephanie, you've got a huge Women in Wealth event also coming up soon.
We do, May 28th. I can't wait. And you are invited. It's not just for women. We're opening it up to everyone, but we have $100 trillion in wealth transfer coming over the next 25, 30 years. And a lot of that money is going to women, and a lot of the women investors are just getting started. So we want to help educate them in any way that we can. So we've got the best team, all CNBC contributors, women. And I think
but men are invited. We can go.
You are invited, yes.
I can
you
go.
just can't speak.
That's impossible. All right. We just got the hook in our ear.
There you go.
Patty jumped in. We gotta go. We got it. When you get the gotta go, you gotta go. Coming up, we're going to talk more about the maybe multi-trillion-dollar question. Can we actually have a ceasefire if we really aren't sure who's actually running Iran? Ian Bremmer is next. All right, let's get to Eamon Javers. Got some breaking news on the ceasefire agreement between the U.S. and Iran, and maybe it's not related to a ceasefire at all, Eamon Javers.
Yeah, Brian, just wanted to flag this social media post for you that just dropped from the Speaker of the Iranian Parliament as we watch whether or not this ceasefire, as fragile as it is, can hold. In this social media post, the Speaker is alleging that the United States has violated 3 of Iran's principles for a ceasefire already so far. They say that the Iranians say that the United States has non-compliance with the first clause of its 10-point proposal, that the entry of a drone into Iranian airspace violates the terms of the ceasefire, and denial of Iran's right to enrichment, which was included in Iran's framework, they say, also violates the terms of the ceasefire. Now they say now the very workable basis on which to negotiate has been openly and clearly violated even before the negotiations began. In such a situation, a bilateral ceasefire or negotiations is unreasonable. So you have here the Speaker of the Iranian Parliament now saying that a ceasefire and negotiations are unreasonable due to what they say are American violations of terms that the Iranians have laid out there. And this is one of those situations, Brian, where you might want to look at sort of deeds more so than words, watch what the Iranians do over the next minutes and hours to see if there's anything behind this. But just wanted to flag that we are seeing this kind of skeptical language now from the Iranians around the ceasefire.
We have Ian Bremmer standing by, but I want to reiterate what we're talking about here, Eamon, because something you and I have talked about a lot on air. I've been talking about it. Is it clear right now who's actually in charge of Iran? Because we seem to get conflicting statements, and it would appear, and people I've talked to and people you've talked to, it appears that there is no Iran per se, that there's no one voice, and that there's a lot of people that seem to be chiming in with sometimes conflicting messages.
Yeah, I mean, I think that there is some of that going on, Brian, but we do have a sense of who this official is. This is the Speaker of the Parliament in Iran, somebody who's been very outspoken on social media and clearly has designed his social media posts in many ways in English to find an American audience, very casual sometimes, very trollish sometimes on social media, designed to provoke a response in the United States. So clearly this piece of sort of the propaganda and messaging effort by the Iranian government is intact. The question is, to what degree is it all being coordinated behind the scenes? And that's the piece that we can't quite see.
All right, Eamon, we appreciate, again, keeping an eye on the markets, a little teensy bit off the highs. Dow's still up 1,100. Let's bring in Ian Bremmer. He's the founder and president of the Eurasia Group. Stephanie Link still with us as well. Ian, the headlines, if you just had them in front of you today, you'd think, geez, wow, I guess, so much for that. And then you'd look at the stock market, and the stock market's like, yeah, no, it's almost like it's saying, we're not buying it. This thing is ending. They're going to work it out.
Well, look, yesterday morning, people had their hair on fire because they thought that Trump was about to launch a genocide against Iran. That's obviously not happening. So the big picture is that the single person who decided to start this war and has been willing to escalate consistently over the last 5+ weeks has now decided he's had enough and he wants to de-escalate. And he's announcing victory, and he's announcing regime change, and he's saying we're going to work together, a joint venture with the Iranians on the Strait. And I mean, the markets correctly understand that if Trump is oriented towards de-escalation, then that takes a lot of unpredictability away from the future of this conflict. Doesn't mean the war's over. Doesn't mean the ceasefire is going to stick. Doesn't mean that we're suddenly going to have all tankers going through the Strait unmolested. But it does mean the likelihood that the Americans will unilaterally further escalate has gone down significantly. And you still have all of these thousands of troops that are steaming their way into the Persian Gulf. So that matters a lot.
Right. So what is your advice then at this point? Who's got it right? I mean, and I don't mean who. I just mean it sounds like what you're saying is yesterday the market went too far in assuming the worst. And today, do you think it's gone too far in assuming it all clear?
I'm not really, I know this is the wrong show to say this on, I'm not really that interested in the day-to-day assessment of whether or not the vibes are correct in where we are. I'm more interested in whether the global economy is going to take a pandemic-sized hit because
right, but the market's interested in that too, and look, with all due respect, it has a lot of data points on that. There's a lot of people who have trillions of dollars at stake in answering that question, and their bet today is they don't have to worry as much about it as they thought.
Is that their bet today? Is that really their bet today, or are we thinking about how the corporations are or are not going to invest in the Gulf long term? Are we thinking about whether we're going to have financial crises in these countries? Look, I mean, we're talking about the same thing. I'm just trying not to give you a response from the headlines, and rather talk about where I think the war is going. And here, the United States is climbing down, and that really matters. But Israel is still a belligerent. The biggest piece of contraindicating news to Trump is that after the Pakistani prime minister said that there's a deal that includes Lebanon, not only did the Israeli prime minister say, no, there isn't, but actually in the last 12 hours, you've had over 250 people killed by Israel in what is clearly the biggest escalation in the 40 days of the Israeli war in Lebanon. And that comes right on the back of Trump announcing de-escalation. So that's a problem. There's also the reality that there have been strikes on Iran since this was announced, not by the United States, probably by the UAE, and they're responding. And then there is the question that you just asked, which is, do we know who's in charge of Iran? And certainly in the same way that they were able to militarily respond to the U.S. even when they had their command and control structure under deep question, because they allowed this mosaic structure of decentralized decision-making by individual military commanders. Well, that also plays out when you're trying to adhere to a ceasefire. And we're going to see some strikes that weren't necessarily ordered by the IRGC.
We also had some reported strikes on the East-West pipeline in Saudi Arabia. And I think sort of Stephanie Link agreeing with Ian Bremmer, I think his macro premise, I don't want to speak for him. How much credence are you putting in to today's market reaction? And here's why I say that. As I said on Squawk Box this morning, there's a lot of positioning in markets. Futures contracts for oil, short, long, stocks, leverage, whatever. Today, you're going to get a lot of people getting short covered, margin called, faces ripped off, fortunes will be made, fortunes will be lost today. When something moves 15% like oil, people are going to go bust today and they're going to get rich today. But how much credence do you put in today's market move?
It's
if any.
It's encouraging today. It might be short covering, but rallies always start with short covering. That's number one. Number two, if you think that this is going to be a short-lived thing, which I am believing to be the case, whether the straits,
we all want it to be, by the way.
Whether the straits open up 100%, I'm absolutely not thinking that, but just some sort of improvement. It's the incremental change that I'm expecting, and I think we will make progress. I'd love to ask Ian, if I can, what do you want to see in the short term that would make you feel a little bit better?
Yeah, I'd like to see additional agreements between the Iranians and other countries to get significantly larger numbers of tankers actually through, and non-tankers, just ships carrying fertilizer and petro and petrochems and all the rest. And that is super important, because I want to understand how the Americans are going to react to this continued toll taking by the Iranians in the Strait. Is Trump going to? Can the Iranians get those deals done? And then are the Americans prepared to live with the consequences of that? Because that's a very different reality, but it's a reality that the markets will be more comfortable with.
Do you, Ian, quickly think it will be significant? And this was earlier reports a few days ago. I don't know if this is intended to be the state of affairs going forward, if the Iranians want those payments in Chinese yuan.
No, I don't think that's significant. I think what's significant is that there's a great likelihood, given all of the different actors in play here, whether it's the Houthis in Yemen, or it's Hezbollah, or it's Israel, and it's the Iranians, who are less than a fully unitary actor here. The potential that this still blows up is really high. Following actions, again, the U.S. still has all of these military plans and all these ground troops. Now, they're not ready today, but they probably will be in the next 2 to 3 weeks when this ceasefire, even if it sticks, is up. And I wouldn't want to try to guarantee that Trump is going to feel the same way if the markets go down and oil prices are a little lower, but he doesn't feel like he's getting the position he wants to with the Iranians, he might change his mind on this, and the Israelis and the Emiratis might change it for him. So for all of those reasons, I want to be a little less ebullient here, even though I'm feeling much better than a lot of people were at, sort of 6 p.m., 5 p.m. yesterday.
Understood. Ian, thank you. Appreciate it today.
Sure.
Ian Bremmer with Eurasia Group. Dow's still up near up 1156. Treasury yields on the move as well in the wake of this temporary ceasefire. We've got more in the bond report after the break.
Just stocks that are moving, bonds are moving as well. Let's get more to Rick Santelli in Chicago to talk about what is happening. What's the word in the bond market?
Well, the word is near unchanged. I guess that's two words. If you look at a week to date of a 2-year, you can see sideways. We drop. We hit 370 intraday low today in the session earlier, but now we're near unchanged. 10-year, same look to the chart. We early hit 422, but now we're near unchanged. And we did have an auction that was very mediocre in 10s. It didn't really make a huge difference. The 10-year and the entire Treasury complex really will, at some point, pay attention to debt and deficits again. And I think the way they're moving looks a lot different than the next chart. Here's crude oil. First of all, it touched the low today of 91.05. That's the lowest level in 2 weeks, going back to March 26th. There's no bounce to the ounce there. It's down and out and sideways. Listen, if you believe that markets whisper, it's whispering pretty loudly that it's telling us, if it was an expert, that prices are probably going to continue to move lower. That's my interpretation. I know many guests don't agree with that, but I don't know. I like following the markets. Sully, back to you.
We like following our bet, Rick, and you're looking good on it. So, Rick Santelli. Dow's up 1,135 points. Power lunch to a close after the break.
Another reminder of the CNBC Pro Wealth Foreman event, May 28th, New York City. Scan that QR code on your screen. Stephanie Link will be there. Look at that great lineup, Stephanie, that you want to add in the 4 seconds we have left.
It's going to be a lot of fun. Really smart women, way smarter than me, but I think we're going to teach people a lot about investing.
And before we go, let's reveal the results of today's power poll. We asked you whether you think crude will cross above 100 again this year. 87% of you say yes.
Ooh.
Wow.
That's right.
Maybe a little skepticism on the ceasefire. Let's hope for the best.
Put that on Polymarket. Kelshi.
Yep. Hey, thanks for watching Power Lunch. I will see you on Fast Money at 5 p.m.
And Closing Bell starts right now.
All right, guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with today's relief rally. Let's just get right to the scorecard here with 60 to go in regulation. There it is, better than 2% across the board. The ceasefire sending about 70% of stocks higher today. Every sector in the market is green, with the exception, of course, of energy, which is red because of that plunge in oil prices really across the board there. Standouts today include the airlines and cruise companies, casinos, and really anything pegged to the consumer. Take a look at Meta. Rolled out its first model from its super intelligence team, and that is a super gain for that name, up better than 6% today. Amazon and Alphabet are also up nicely for the mega caps. The chip equipment names, nice in the green today. Take a look at that. Lam Research up 8%, so is ASML, Applied Materials, KLA, all having a very strong session. Takes us to our talk of the tape today. How best to position now with this major move to de-escalate the war? Let's first go to the White House, our own Eamon Javers, who has the latest. And I guess we're learning, Eamon, that this ceasefire could at times appear to be a bit dicey.
Yeah, Scott, a lot of issues still out there to be decided. We heard from White House Press Secretary Caroline Leavitt here at the White House just within the past hour or so, and she confirmed that the United States is sending a delegation under J.D. Vance to go to Pakistan and negotiate face-to-face with the Iranians. Also included in that delegation, Jared Kushner and Steve Witkoff, who've been in part of the negotiations all the way along. J.D. Vance being there in person kind of elevates the stature of those negotiations. We'll see what they're able to come up with. But one of the key questions in all this, Scott, is this issue of whether the Iranians post-war will be able to charge, in effect, tolls for ships going through the Strait of Hormuz. I asked Caroline Leavitt that in the press briefing, whether that was an outcome that would be acceptable to the United States or whether that would be a red line for the president. And here's what she said.
I think the president was very clear and simplistic in his language last night in his Truth Social post, where he said that this ceasefire is subject to the free, safe, and immediate reopening of the Strait of Hormuz. That's very plain language, and it should be taken at face value. Carrie, go ahead. Without limitation, including tolls, yes.
So you heard her there saying without limitation.
All right, we've lost Eamon, as you obviously saw there, from some technical issues on the north lawn of the White House. Bottom line is the markets are taking this for what it is today, a significant relief rally. Certainly have seen the oil market react positively today in terms of the move lower. Pippa Stevens has more on that for us as well. Hi, Pippa.
Hey, Scott. So we saw just 3 ships transit the waterway today. That's according to Lloyd's list, which said all had current or past links to Iran and weren't oil tankers. The firm added that 3 additional ships are heading to the detour around Lyric Island. Now, vessels aren't rushing to exit given all the confusion about what exactly is happening in the Strait of Hormuz. Shipper Maersk saying the ceasefire may create transit opportunities, but, quote, it does not yet provide full maritime certainty, and we need to understand all potential conditions attached. Now, crude's drop perhaps indication that traders believe the worst might be over, but CIBC Private Wealth's Rebecca Babin attributing some of the move to positioning, especially in Brent, noting that prices pushed through downside option strikes where exposure had built up over the last month. And the bottom line is that at this point, traffic is still 90% below pre-war levels, and it will take weeks, if not months, to clear the backlog. Scott?
All right, Pippa, thank you. We'll see what happens with this trade. Thank you, Pippa Stevens. We did mention big moves in travel names like the airlines today. Phil LeBeau has more on that for us. Hi, Phil.
And one of the biggest movers, Scott, Delta Airlines, after beating on the top and the bottom line for the first quarter. But it's really the outlook for the second quarter. That's the strength of the follow through, if you will, in terms of investors saying, okay, we kind of like what we're seeing here for the second quarter. Strong corporate and leisure demand. The bookings have been solid, according to Ed Bastian, the CEO. But fuel is a cost headwind. How much? They will be spending approximately $2 billion more in the second quarter compared to their original plan, which they set up back in January. Capacity, as a result, they're going to cut it down to flat year over year, was going to be up 3.5%. Here's Bastian talking with us this morning on Squawk Box.
We're pulling capacity down to accommodate and try to get ahead of some of that potential weakness, but we're not seeing it. The last 30 days, our bookings are up double digits every day for the last 30 days, the strongest period that we've ever seen.
We talk about strong demand. Look at the revenue numbers for the first quarter from Delta. Premium products, not just the front of the plane, but all of the premium products, up 14% year over year. Domestic revenue up 8%. Main cabin, there was an inflection, used to be negative. This quarter, or first quarter, it swung into the positive, up 1%. Take a look at the other airline stocks today, and what you're basically seeing is they all are moving higher, primarily on the jet fuel prices coming down. But you also see more optimism that perhaps, Scott, the demand will remain strong, given all of the headwinds that are out there.
Yeah, big relief rally, no doubt. Phil, thanks. That's Phil LeBeau. Now let's bring in Fundstrat's head of research, Tom Lee, also a CNBC contributor, and as you see here with us at Post 9. It's good to have you back.
Great to see you.
Now what for these markets?
I think the bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down. So that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs, and I think maybe get to that 7,300 that we were expecting this year.
Wow. So let's just remind and refresh people's memories a bit. You were looking for a strong start to the year, stocks falling into potentially a bear market.
Yes.
Most of that you pegged to a new Fed chair coming in and some of the issues that might revolve around monetary policy. Couldn't foresee the outbreak of this war and the conflict, et cetera. Does it matter what caused the bear market for how you project your outlook for the year, or are you confident that we had this event, an existential event for the market, it reacted negatively, and now we're going to rebuild our way back?
Yeah, I think things have possibly changed, Scott, because this war pulled forward a lot of repositioning. You know, we know people have gone flat or raised cash, and they were ready to own defensive positioning. And we also had a rolling bear market last year in energy and financials, and this year in Mag 7 and software. So something like 70% of the S&P's already been through a rolling bear market. So I think the possibility is that the summer lull that could happen won't be as deep because we've already fallen 8%.
What's the makeup of the move back towards record highs like you just said you thought we would do? What does the makeup of the market look like in that scenario?
I think the leadership has been revealed in the last 6 weeks because since the war started, the number one performing asset class has been crypto, Ethereum, and then energy stocks, Mag 7 software, financials. So to me, that's the group that's leading us up. You know, energy went up for obvious reasons.
Sure. Isn't it going to go down now for obvious reasons?
Yes. And then the negative correlation to oil was the highest in almost a decade for the Mag 7, Ethereum, and software. So I think that as oil flattens or cools, or the curve flattens, those names are going to get a bid, and they've gotten already cheap. We know the Mag 7 is trading almost at a market multiple.
When you know that we sort of banked on the broadening trade, you know, there was a bent towards value, which it had outperformed growth. Is that mostly over now? Because even with oil elevated, we're still going to ask ourselves questions about a slowdown in the economy, right?
Yeah,
or no?
And there's still a shock rippling through the economy.
Which we maybe haven't felt quite yet?
Correct. Yeah, I think there's an inflation shock still coming. I think that the broadening is taking place. The narrowing is, I think, more investors are going to buy U.S. because the U.S. has proven its resilience in this wartime period. Plus, the U.S. makes more money in a war. But the broadening is that more U.S. stocks rise.
Yeah, but if you're telling me the inflation shock is coming, isn't that going to negatively impact the broadening trade?
Yeah, I think it is out there. We just don't know amplitude because, you know, it's like a wave. Like when it hits shore, is it going to be diminished and are people bracing for it? But there should be some inflation shock coming. It sounds like the Fed is already thinking about, you know, still leaning towards cuts, which is good. We'll get some signal.
Well, right now they feel like they're leaning towards doing nothing for the foreseeable future. And if they believe what you just said and believe, then you must believe that they're going to remain on hold for potentially even longer.
Yeah, and it really depends on if consumers and corporates view this as temporary or a change in inflation. So the surveys will matter a lot, as will the incoming reports. But the Fed Fund futures show the market's shifting back towards cuts.
All right, so the mega caps have had a better go of it of late. Is that a sign of anything bigger that lies ahead? And will we, with the multiple compression, by the way, right? The stocks have come in a lot. Does that make them even more attractive now because you already had the better earnings growth in most other parts of the market, and now if you can couple multiple compression with that?
Yeah, I think the Mag 7 bottomed on bad news because they were leading in the middle of the war. AI demand will go up because inflation risk means companies want to find productivity, and U.S. is still a leader in AI, and I think as the world worries about growth, they want to own growth stocks, which is the Mag 7.
So the Mag 7's back. Tom, it's good to talk to you as always. It's Tom Lee of Fundstrat. Speaking of the mega caps, now to that massive move we saw in Meta today, or we are still seeing. Julia Boorstin is with us for more on why the stock looks like that today. Julia?
Well, Scott, Meta's long-awaited new AI model, Muse Spark, is rolling out across its apps and AI glasses. This is the product of Alex Wang's 9 months building Meta Superintelligence Labs, as well as hundreds of billions of dollars invested in AI to help address the disappointment of prior Meta AI models. Now, instead of launching with a sophisticated model to top rival frontier models, this is a slow release, initially focused on uses for Meta's apps, with a special mode for shopping, surfacing ideas from creators and content from public posts. Now, Meta seems to be trying to lower expectations and address concerns about its AI spending, saying that this is only the start. Now, notably, Meta is opening the door to a potential new revenue stream, saying they're planning to eventually offer paid access to the model's API, like ChatGPT and Gemini do. Scott?
It's a big day for that name. Julia, thank you very much. That's Julia Boorstin. Dan Ives covers Meta for Wedbush, among other big names. Joins us now. It's nice to have you. Is this a significant inflection point?
Well, it's a massive move. I mean, because look, the reality is Llama fell short, right? And that was a huge disappointment. They need to find success with this initiative. And it also goes back to the Scale AI deal. And look, right now, the stars of the show are Anthropic and OpenAI. Meta needs to make sure within their install base, they have a model that's going to monetize, and it's one that developers want to ultimately go after. That's the key right now for Meta. This is a very, very important 3 to 4 months to get developers on board.
So you don't sound to me as though you're fully sold on whether they can deliver simply based on what they've brought forward today that has the stock on the move.
Yeah, look, I think it's the first step, and it's optimistic. It's the first time you could be optimistic, given what we saw with Llama over the last 6-9 months. Been disappointment after disappointment. But there's more wood to chop. They need to be successful. They need to prove it to developers. And ultimately, it comes down to monetization. And I think so far, so good. But it all comes down to, like, in this AI arms race, they need a model that's going to monetize. And this has to be it.
Who's got the lead now among the mega caps, right? Because the way you answer some of these questions, you're like, everybody seems to be chasing OpenAI or Anthropic. Who's running the fastest to be able to catch them?
I think it's Google. I mean, I think they're the one, and it speaks to how that stock's, I think stood out relative to others in terms of what they've done with Gemini. And look, when you think about software AI developers in the world, a significant piece of them actually work at Google. And you're starting to see with Gemini more and more, that's the one that I think investors have the most confidence in when it comes to these models. Obviously, Meta, it's approved me. You look at Microsoft, we believe they're going to be very successful on the hyperscale side, but where are they on the model side? And Apple, that's sort of approved me that we think ultimately starts to come out WWDC with right now, if this is a Broadway show front and center, it's Anthropic and OpenAI.
It feels like Microsoft got out of the gate so fast in what is, I guess, a more of a distance race. And because they sprinted, now I feel like they ran out of gas. And now they're trying to figure out whether they have this next leg in them, or at least investors are certainly questioning whether they're about to get out of the race in any large degree.
Yeah. And I think that to go down that, I think they're kind of at the rest stop. And investors are trying to figure out, is this a Ferrari or is it, sort of a car in the right lane going 45 miles an hour? I believe, Scott, like as we look at first quarter results, they'll prove themselves in Azure, capacity will increase. And I continue to think Microsoft, of all Mag 7, is the most oversold here relative to the software goes trading expectations. But look, as Tom talked about too, in this backdrop, this is such an important quarter because there's a lot of confusion and you're going to have clear winners. But I believe this is going to be for Mag 7. It's going to be a prove it moment. I continue to believe tech will see all-time highs this year.
Okay, lastly, Apple. The news yesterday of the delay in the foldable phone that really hit the stock unusually hard, if that in fact was the major catalyst. How significant is that?
Look, it's significant in terms of obviously you want to see the foldable, you want to see that come through later this year. But Scott, I think that the reason it's sold off, it's just right now, it's snake bitten. Investors are just so frustrated about continued delays. You need to see Siri AI. You don't want to see delays when it comes on the hardware side, which speaks to all the buildup in the WWDC. And right now it's a glass half empty stock, but I believe that will be the opportunity as they monetize AI. But this now is time for them to step up. And I think Cook knows it, and I think everyone else in Cupertino knows it as well.
All right, we'll talk to you soon. Dan Ives, thank you very much. Wedbush. What a relief. They are the words of the day for these markets, no doubt about that, following news of that 2-week ceasefire. For more on what it all means for the investing road ahead, we're joined now by Mina Flynn of Goldman Sachs. She's Global Co-Head of Private Wealth Management and One Goldman Sachs. It's good to have you back.
Thanks, Scott.
So of the prior two guests declared that the market bottomed and that tech's going to reach new highs. Let's take one before two. Do you believe that we had the bottom in the market and now we can build on what we're seeing today?
I don't know that we can either call the bottom or the top, but I will say that we are relatively constructive on the S&P from here into year end as our base case. I think the more important thing is we are pretty methodical as it relates to investing for our clients. And so what we've seen year to date with our clients is that they haven't really de-risked, nor are they rushing today to add a lot of risk. And so we're constantly rebalancing. And given the amount of uncertainty that we have right now, we still have a lot of uncertainty. We're taking a longer term approach to investing public market capital. So that's instead of 6 to 12 months, that's 12 to 18 months. On the alternative side, we're continuing as usual because our clients predominantly invest in drawdown funds, which have a multi-year investment cycle.
Are you as constructive as you are because you expect the S&P base case mid 7,000 by year end because you are a big believer in the durability of the earnings story? We're still like 14.5% prediction on that or expectation, and the fact that the economy still looks pretty good. So you have all that, and as I was saying with Tom Lee, not only have you had the mega cap multiples come in, but the overall market has too. So that's a lot you have going for you.
We do have a lot going for us, but the number one question that we've been getting from our clients year to date is why hasn't the S&P moved more going into, for example, last night, given the amount of negative news flow? And I think this plays both ways, whether it's to the downside or whether it's to the upside. And from my vantage point, that comes down to the earnings durability, as well as the composition of the index versus GDP. So the index, as we know, is more than 30% technology, but it's only 6% of GDP. So yes, how the economy is doing matters to the index, but at the same juncture, the number one thing is earnings. And we are anticipating that earnings are going to be roughly 10 to 12%. But to your point, you've got to have multiples re-rate through more confidence, whether that's confidence in the AI investment spend or whether that's confidence because the geopolitical pressures are coming off.
Do you have added confidence that the mega caps are back, for lack of a better word, and then because of what you're going to see in earnings season, right? They're going to provide you the best earnings growth within the market, and then plus again the compression that we've seen in their own multiples.
Yeah, so I think the Mag 7 looks pretty attractive right now, just if you look at multiples being really at market multiples despite pretty high growth earnings rate. I think the thing that's really interesting about the S&P 500 is that a third of the earnings are coming from the Mag 7 and 40% of the earnings growth is coming from AI investment. AI investment is a multi-decade, a multi-year investment cycle.
And you still believe in that? Like we're like early, so we're early still in that cycle.
We're still early in that cycle, but I will say you don't really know who's going to be disrupted yet, nor do you, and you also still have concerns in terms of all of this CapEx spending by the hyperscalers. Is that going to turn into the revenue that the market wants? And that's why the multiples have come down. And I do think that as we go through earnings this cycle, as you see the guidance, potentially see buybacks, that's going to give investors more confidence to have that re-rating.
Okay, how are the tone? How's the tone of the conversations you're having with your clients, wealthy clients, about private credit? Are they watching what's happening and saying, now I'm a little concerned and maybe I'm rethinking my allocation to alts as a result of that?
So our clients have roughly 70% of their clients in risk assets. Of that 70, roughly 25 to 30% is in alternatives. Private credit is a portion of those assets. Our clients are invested and, quite frankly, looking at this market opportunity to say, I probably want to invest more.
In private credit?
In private credit.
Really?
Why is that? That is because they know that it's predominantly a liquidity issue with some of the evergreen funds. It's not really a credit issue. So if you look at non-accruals, if you look at PIK rates, they're in line with historical averages. You could get those defaults picking up because of AI disruption if the economy slows, but you're looking at 10% yields and your first lien in the capital structure. So you'd have to have a lot of negative things happen to impair that capital. So our clients are looking to invest new capital into private credit through these drawdown funds.
Wow, that's an interesting bit of insight. Thanks for being here again.
Thank you.
All right, Nina Flynn, Goldman Sachs. Right here at Post 9, we're just getting started. Coming up next, more on those private credit fears. Those stocks are sitting out today's rally. Coming up next, Sycamore Tree Capital's Mark Okada is with us. He gives his take next. All right, welcome back. One of the big questions hanging over stocks not related to the war is what's really happening in private credit. Mark Okada is co-founder and CEO of Sycamore Tree Capital. He's here with us once again at Post 9. It's good to have you back.
Hey, Scott.
We don't really talk that much about private credit, you and me, but we're going to today because investors are worried about what's happening. What do you see?
Well, I mean, there's, I guess today's a better day. I like Taco Tuesday versus World War Wednesday.
All right.
So
you and a lot of other people.
But yeah, so now we can focus on credit. I think there's, like, we came in the year. I told you in January when I was here that the cycle had already started. We've seen that in pricing across credit.
Had started to turn.
Yeah, and everyone was saying no, credit spreads are tight, the market's good, everything's great, and so everyone was totally bullish. And we said no, that's not the case. So if you think if the topic is private credit, there are concerns about two big things. It's market construction. Right? It's how the market has structured itself, and then credit quality. So, I said that we were going to see credit quality deterioration because it had already started last year. But let's start with market construction because that's what's on everybody's mind. So if you think about the credit markets, there's four big credit markets. There's high yield bonds, there's loans, there's the IG market, and then there's private credit. And they're all sizable. But the difference between the public credit markets and the private credit markets is we've had 30, 40 years to figure it out. We've spent all this time restructuring the way markets come in and out. Investors can access the market, how managers can manage risk within the market.
We're learning on the fly a little bit here, right?
And this is the first cycle. And we've said this for years, that at some point we would have a cycle in private credit, and they're going to have to learn from the lessons. And so the first thing that's happened, right, is we have all of this sort of liquidity seeking in an asset class that has no liquidity. And so people are trying to get out. And then they're looking at NAVs where they say, I don't believe the NAVs. And you have a classic structure where, should I redeem at NAV if I think the NAVs are too high? Yes, you're a smart investor if you're doing that, and you're supposed to be doing that. Is the manager in a situation where they can actually manage that properly? Some are, and some are not. And so, I look at the proof in the pudding is the way the markets are structured. So CLOs fund bank loans. CLOs are all locked up capital, long-term capital. And even the retail money we have in high yield and bank loans, it's been fine. We've had 18 billion of redemptions across high yield and bank loans. You haven't written a story about that. There's been nobody coming on to talk about that. They've had 13 billion of outflows, and they can't meet 5 of it, and it's the world's end.
Well, because the incredibly dramatic rise in the growth of private credit, and now with the added access of the retail investor, it's more topical. It's more on people's minds because we're talking about having more exposure into alts at a time when people who have gotten more exposure through various platforms and whatever are wondering to themselves, what did my advisor do? Why am I in this stuff that I thought I knew enough about? And now I'm not so sure. And it sounds to me like you are suggesting you think it could get worse from here. I didn't say systemic because most people who have opined on it don't think so, and you can opine yourself too. But worse is different than systemic.
Yeah, it's not systematic, it's problematic. So the problems are twofold. We talk about liquidity, and look, I think I'm not here to talk my book or their book or anybody's book, because that's all I hear when people talk about this is everyone's talking their book. It's fine, it's horrible, it's whatever. But fundamentally, right, most of private credit got it right. They're in these institutional locked up funds. You can't get out. The only way you can get out is secondaries, and the secondary market's going to explode. I mean, you're going to see a lot of trade happen in secondary LP activity, and that's great. But most of the market, if you're the manager of a private credit book, you don't have to sell. You can sit there and ride this out, and that's the way it's supposed to be. 30% though of that market is what we're talking about here, and so it's meaningful. It's big enough so that people should care. We should be talking about it. So last year, defaults across private credit was over 5% last year. versus and in public credit we have issues too. It's 3.4%. So it's not like everybody's like, this isn't roses for everyone. Everyone's got issues, but how do you manage those issues? And then the whole thing about software is just totally wrong. That what's going on in private credit is not about software yet. I mean, they've got much more software exposure. It's to much smaller companies. They're 8 times smaller, or our issuers are 8 times bigger. And we scrubbed our whole book, so we don't have credit problems in our book. But it's like those maturities don't happen until 27, 28. And the disruption from AI hasn't started yet.
No, but the market is assuming that a large number of these software companies that have taken loans are going to be displaced to the degree that they're not going to be able to pay them. So the market's trying to get ahead of it. You're right. Use the word yet.
Yeah.
Yet's the key word.
Yeah.
But the market doesn't wait around for the yet.
Right. So look, I think the credit quality question is, you sat there and you went into these funds because you were making these great returns. You were making bank loans plus 200, 300 basis points year in, year out with no vol. Now, I argued 2 things. You had to turn to leverage, right? And you took more credit risk. If you're a CFO of a company and you're borrowing money and you're going to borrow from the private credit guys or the public credit guys, and this money costs 300 basis points more than this money, are you going to pick this money or this money? You would rather have the cheaper money, but you end up here because of your credit quality. So I argue that at some point the credit quality would catch up to them. You've exploded the amount of private credit debt in the world from 2020 to today at a 16% CAGR. It's grown dramatically. So when you issue that much debt, you have credit quality issues, but it has nothing to do with software yet, and that's coming. And so I say that this cycle will be long. We are in the beginning of it. It's early. And so it bothers me that people talk about opportunity and they're talking about, it's a great opportunity. All they talk about is opportunity. I'd rather talk about risk. I think in the beginning of cycles, it's all about capital preservation. It's about alpha by avoidance. It's what you don't own. And so, Scott, if you're in public credit and you can trade and you made a mistake and you can get out of it, good for you. But if you're stuck in private credit, there's no secondary market. You got to work it out. And that's going to be the reality if I'm right and there's a real credit cycle that's already started. And we haven't mentioned all this other stuff going on in the world. I think the big takeaway from the macro, Scott, is that the cost of capital has to rise across all markets. Government markets, currency markets, commodity markets, credit markets, equity markets. The cost of capital just have to be bigger because there's more risk. There's more counterparty risk. If you can't trust what someone's telling you from one day to the next and it comes down to some deadline that's at 8 o'clock at night, I mean, there's got to be more risk premium in all of this. So I just think it's early and it's going to lead to more of a credit cycle than that feels like it's priced in.
All right, we'll talk more. I'm sure of that. Mark, thanks for being here.
Good to see you.
It's Mark Okada of Sycamore Tree. Coming up, top technician Jeff DeGraff. He breaks down the key levels he's watching now with this rally today. We're back right after this.
I think the bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down. So that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs.
Okay, that was Fundstrat's Tom Lee moments ago calling the market bottom. Let's find out if our next guest agrees with that. He's Jeff DeGraff. He's chairman and head of technical research at Renaissance Macro. It's good to have you back. So, I mean, we're back, speaking of, above some critical technical levels on the S&P. Are you a believer in what Tom Lee had to say as a result of that?
No, I don't think the levels are going to do it, Scott. I certainly wouldn't use the narrative and rate of change of war. That's just going to lead you down possibly a primrose path, or at least a faulty path. So I'd be careful with that. I think there's two things that we're watching today that I think are important. One, our bond yields, which are essentially flat, but more importantly, what's happening to real yields, which are essentially flat. You're going to need real yields to come in for Tom's story to play itself out, and that hasn't really happened in a meaningful way here. Real yields are basically the nominal yields minus the inflation premium, and so they're elevated and they remain so. And I think the reflection of that is in gold. Gold is down about a little over 1% today, and that's suggestive that those real yields are not coming in. So I think it's premature to say that it's all done. I think today's a good day, but we're right at the 50-day moving average, which is descending. It's kind of a natural resistance point. If I look at the breadth today, it's about 80% advancers. That's an okay day. It's certainly not a game changer in our view.
I have gold higher. You just mentioned gold. You said it was. Yeah. You said it was lower, didn't you? I have it higher.
The spot rate, but it's not right. It's not moving. The spot rate is from the day before, so it's not moving as much as what we'd expect. But you're right on that. On that front, you're there, but it's still not the real yields.
Why? Just tell me why you would expect it to be moving even more than it is today?
Because if real yields are coming in, that means the risks are coming off and other assets aren't that attractive, right? And so you're willing to basically buy gold, which is not a yielding or a cash flow asset. And that's one of the reasons why it was doing so well, in the last 6 months up until about 2 months ago. So that's going to be part of that story, we think, and we're just not seeing it. I would say if you're, go ahead.
I'm sorry. No. My apologies. You go ahead.
Well, if you're looking for the brightest spot of the day, when I look at breadth amongst sectors in the market, the best one is financials, which in terms of up names versus down names is 94%, and that compares to, I'm sure everybody's interested in tech. Tech only has 63% advancers here, so I like the fact that financials are helping to drive it in terms of the breadth, and then industrials behind that. So I think there are some interesting things that are developing, certainly more bullish than not. But for me to jump into the Tom Lee camp of, hey, we're going to go right back to the highs, I think it's premature there collectively from what we're seeing.
Yeah, I mean, Mike Santoli was saying earlier, right, we got about 70% up stocks today. You'd really like to see 90-ish% for some degree of confirmation.
I would say 90 changes the game. At 80, it's just another. I mean, if you ask me to script out a day where it's like, okay, that was good, but it doesn't really change anything, today's a pretty close carbon copy of what I would have jotted down to kind of make it feel like it feels better, but not really under the surface is it much better.
We're going to, given what's happened recently, we're going to take it for what it is today and go from there.
Fair enough.
Yeah, Jeff, I'll talk to you soon. Jeff
Sounds good.
Still ahead, the major averages sharply higher as we head towards the close today. The aforementioned Mike Santoli gives us his view next.
has cleared the tower. Every core computers now have primary control of critical vehicle functions.
All right, we're now in the closing bell market zone. Mike Santoli and iCapital's Sonali Basak are here to break down these crucial moments of the trading day. Plus, Pippa Stevens is watching the move in metals, and Christina Partsinevelos is tracking the action today in chips. So, Mike, I'll start with you. It's hard to hate on what we're seeing today, but some of the really tight market watchers are not ready to say all good from here until they see a little bit more.
For sure. I mean, look, when the market did what it did for 4 weeks and broke through previous support levels, and you had former leadership groups that kind of weren't able to perform, what that means is the burden of proof goes up on the bulls and on any rally. We're 7% up already in the S&P from the intraday lows a couple of weeks ago. It's not as if we're just kind of bouncing around the worst levels. And so I do think you have to scrutinize the character of any rebound rally to say, does this say there's an urgency among buyers to get back in of a sort that's going to last us a while and is going to be able to power this market much higher? I think today is one of those constructive but not decisive type days. The rally, it got to the current level right after the open, and it kind of sat there most of the day, and it was stopping right at a level where you might expect it to. 6,800 was the floor on this market in the S&P for months, and we're just underneath it. So I do think that says, guess what? We have some constructive developments. We have a higher probability of a resolution of the crisis in Iran, but we don't necessarily have an all clear on that front. We have to wait and see and get confirmation. It's exactly how the market would perform if that was the setup.
At risk of being the master of the obvious here, I get it, but you need to see follow through, I would assume, Mike, as Jeff DeGraff was saying, not just in this rise in stocks, but in the fall in yields.
Yes. Yeah, you want to see everything kind of unwind, whatever you had in terms of those stress moves that we got in the market. Obviously, that was oil. Obviously, it was the VIX, and then Treasury yields as well. You want to see that relax and see the tension come out of those areas in a way that says some version of normalcy is back and we can trade on that basis.
What's coming up in about 5 minutes?
Well, we're going to actually get at a lot of these issues. On the tactical front, we are going to have Jonathan Krinsky, your friend, who's got some pretty strict parameters for what a real breakout might represent and whether we're there or not.
He's got some specific numbers on his mind, and we'll tease that ahead to see you guys at 5 o'clock and look forward to 4 o'clock, excuse me, and go through that. Mike, thanks.
Yep.
Pippa, tell me more about metals today.
Hey, Scott, so gold is off the best levels of the day, but still up 1%, with Commerzbank attributing the move to the fall in oil prices, leading to easing inflation risks and therefore a downward adjustment in interest rate expectations, with Citi adding that the headwinds in March that impacted gold, including higher rates and a strong dollar, now are partially alleviated, and global fragmentation could drive reserve diversification, which does benefit gold. The move is lifting the miners, with the GDX up better than 3%. Newmont, Barrick, and Wheaton all outperforming. And keep an eye on silver and copper, both up more than 3%, perhaps on optimism around a shorter-term war impact on the global economy. Scott?
All right, Pippa, thank you very much for that. To Christina Partsinevelos with more on that chip rip today, because it is just that.
Yeah, the compute leaders like NVIDIA and Broadcom are up, but mostly in line with the broader market. The real outperformance, though, is in memory and storage names, though that's not really unusual given how momentum-driven these names are. For example, Micron, you can see on your screen, 7.5, SanDisk almost 10% higher. A reopening of the Strait of Hormuz really eases pressure across the semi supply chain, from energy costs to helium, which is used in chip production. Taiwan Semi, though, you can see on your screen, is an interesting one. It's up almost 5.5%, acting more like a levered bet on the supply chain names than the actual compute leaders. Intel, another big name, up, last I checked, about 11%. I was going to say 10, extending its run after the company joined Elon Musk's Terafab project to build AI chips for Tesla, SpaceX, and xAI, although we don't know the details of that deal. Intel on track for its highest close since June 2021. And Scott, we do have a big week ahead in the chip world. ASML and Taiwan Semi's earnings are on deck, which will really set the tone for semi sentiment heading into the rest of the quarter.
All right, Christina, thank you. Christina Partsinevelos, Sonali, it's good to have you back. So we're moving a little bit higher as we get, ever closer to the end of the trading session today. Are you a believer, for lack of a better word, in how this market's reacting?
I think it's going to be a little volatile. It's going to be volatile through earnings season because not all companies will react the same to the price pressures we've seen throughout March. Christina made a good point there about Taiwan Semi because, of course, the helium prices, they've already said that there's no near-term impact as of now. They're keeping an eye on it. But remember, it looks good that we're seeing a relief in energy prices. We still have Brent at 95. This is kind of what I was saying here, that still you have energy prices elevated, even if we're seeing a cooling off here. And there could be an impact the longer that goes on. We were living, remember, in a sub-70-80 world.
How much do yields hold the key for how this market trades from here? 10-year at 4.28. Now, there was a moment during the earlier stages of the war where we're saying to ourselves, like, is 4.50 going to happen on the 10-year? Because we got close.
Yeah.
So we're significantly lower, but how close are you watching yields?
We were at 380 last year. We have to remember that. Being at 420 and being excited that we're not 30 basis points off the highs of this year is not a lot to speak for the bond market yet. When we look at that long end of the curve, we have to keep an eye on it because we have to expect whether we'll see more fiscal pressure in the second half of the year as we head toward the midterms. So, of course, we're keeping an eye on it. But, of course, as critical as I am about the bond market sometimes, I look at that long end and actually believe it's been somewhat orderly. I don't think that we're going to have a whole lot of upside when we look at the bond market on the long end of the curve here, but I also don't think that we need to get into a tantrum either.
You confident that earnings are going to hold in?
I do, but you look at what the first quarter looks like, you look at expectations running in, we all know that they have been riding higher.
Yeah,
but
and rising.
And rising.
Right.
So perhaps some of that is already baked in. I will also point out, too, even though financial loan growth is expected to grow, it's supposed to just start tapering off after the first quarter of this year. So a lot of investors will be keeping an eye on the banks on how much loan growth can grow from here. And then remember, BDCs report after that. So everything we're seeing in private credit, we expect one more wave of nervousness before we see a flush out of the nervous sentiment we've seen of late, because you might see some dividend cuts.
All right,
there.
good points. We'll get the banks coming up soon. Sonali Basak, thank you very much for walking us right up to the close. Bell's going to ring momentarily, and we do have stocks maybe not quite at the highs of the session, but we have moved a little bit higher now as we hear the bell ring today. Dow, S&P, NASDAQ, all good for at least 2.5%. The Russell, almost 3%. I'll see you tomorrow, and I'll send it into overtime.
The bell's bringing an end to the trading day at the NYSE. HumanX ringing the bell, and at the NASDAQ, Daktronics doing the honors. Welcome to Closing Bell Overtime, live from Studio B at the NASDAQ market site. I'm Mike Santoli. Melissa Lee is off today. A big rally on Wall Street as the U.S. and Iran agree to a 2-week ceasefire. The Dow up 1,300 points, having its best day in nearly a year. The S&P 500 and NASDAQ extending their winning streaks to 6 days. The S&P up 2.5%. But this only brings us back to the same index levels from early March, shortly after the war began. Over the next hour, we'll be talking to market watchers, technicians, and political strategists, asking the questions you want to know. Can you trust this rally? And can you trust this ceasefire? But we begin with the numbers. Seema Modi is looking at some of the big movers on the day. Hello, Seema.
Hey, Mike. A nearly 3% gain for the NASDAQ today. Tech stocks really witnessing a sharp reversal. Details of the U.S.-Iran ceasefire agreement are emerging, and investors responding with hyperscalers like Meta, Alphabet, all gaining on the day. Memory names like Micron up nearly 8%. And with today's gains, Intel now higher by 32% just in the month of April, following news of its partnership with Elon Musk's Terrafab. Industrials with energy exposure also joined the market rally today. This as investors count down to earnings from Caterpillar, Cummins, and Boeing. Unofficially, earnings season getting kicked off next week. The plunge, though, in oil prices sending airlines and cruise lines higher. We saw Carnival, the best performing stock on the S&P 500 today, up over 11%. William Blair analysts believe it's best positioned than its competitors on hedging oil. There was also Delta out with earnings, a $1 billion pre-tax profit this quarter, higher than what analysts had expected. Shares up about 4% on the day. United higher by 8%. Cybersecurity stocks, one pocket of strength within software. CrowdStrike, Palo Alto Networks gaining after Anthropic revealed it is previewing its latest AI model, Mythos, with leaders in security. So that calms some concerns. CrowdStrike ending the day higher up just fractionally on the day. The losses highly concentrated in energy as suspected, given the drop we saw in oil. Marathon Petroleum, Exxon, and Valero all lower on the day. Mike?
Seema, thank you. Well, oil plummeting on hope's passage through the Strait of Hormuz will be normalized. Pippa Stevens watching all that for us. Hi, Pippa.
Hey, Mike, a little bit more hope than reality at this point, with just 3 vessels transiting the Strait of Hormuz today. That's according to Lloyd's List. That is fewer ships than were transiting prior to the ceasefire. There are currently 304 vessels in the Persian Gulf with about 172 million barrels of oil and products. At full operational capacity, it would take 13 days to clear the backlog, notes Kepler, but at a reduced rate of 25%, which is still well above where current transits sit, it would take 51 days to clear. Now, I did speak to a shipping executive today who has ships stuck in the Persian Gulf and who told me that they have no information about how they could currently transit, and they are not in touch with Iranian authorities. Still, WTI seeing its biggest drop in 6 years, with Brent shedding 13% to settle at $94.75. Now, dated Brent, which is a better indicator of current prices, falling to $124.68 per barrel today. That's according to Platts, but still a roughly $30 premium to the front month. Mike?
Yeah, Pippa, I guess that's your best real-time gauge of physical scarcity when it comes to crude. What would that spread normally be? Would it be right in tune with, let's say, front-month Brent normally?
It can normally be a little bit different, say $3 to $5, but it usually converges when the contract rolls. But I think that the futures market is not quite accurately pricing what is happening on the ground and those physical shortages, especially since those final cargoes have just been delivered. It is really now crunch time in terms of refineries being able to get those barrels. And then there's also questions about whether this ceasefire then kind of, kicks the can down the road, in the sense that if refiners then think that maybe they can get a cheaper price in a few weeks' time, maybe they won't buy right now, and then they won't have any oil to refine into products, further tightening those already tight products. And so in some ways, this kind of lack of clarity, this 2-week ceasefire that hasn't really seen a meaningful uptick in ship transits, could actually exacerbate the situation further. And then finally, I would note that we're so focused on ships that are exiting the Persian Gulf, but equally important is ships that are entering, because in order to get oil fields restarted, and in order to get any LNG out of Ras Laffan, you need ships that are empty to offload onto. And so without that portion, we're not going to see a normalization of flows anytime soon.
Yeah, I was just saying, it could be weeks and weeks before we have any